Section 56 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 10. Citigroup, I do not believe we were powerless. While the hedge funds were betting against the housing market in 2005 and 2006, Citigroup's CDO desk was pushing more money to the center of the table. But after writing $25 billion in liquidity puts, protecting investors who bought commercial paper issued by Citigroup's CDOs, the bank's Treasury Department had put a stop to the practice. To keep doing deals, the CDO desk had to find another market for the super senior tranches of the CDOs it was underwriting, or it had to find a way to get the company to support the CDO production line. The CDO desk accumulated another $18 billion in super senior exposures, most between early 2006 and August 2007, which it otherwise would have been able to sell into the market only for a loss. It was also increasingly financing securities that it was holding in its CDO warehouse, that is, securities that were waiting to be put into new CDOs. Historically, owning securities was not what securities firms did. The adage, "We are in the moving business, not the storage business," suggests that they were structuring and selling securities, not buying or retaining them. However, as the biggest commercial banks and investment banks competed in the securities business in the late 1990s and on into the new century, they often touted the balance sheet that they could make available to support the sale of new securities. In this regard, Citigroup broke new ground in the CDO market. Citigroup retained significant exposure to potential losses on its CDO business, particularly within Citibank, the $1 trillion commercial bank whose deposits were insured by the FDIC. While its competitors did the same, few did it as aggressively or, ultimately, with such losses. In 2006, Citigroup retained the super senior and AAA tranches of most of the CDOs it created. In many cases, Citigroup would hedge the associated credit risk from these tranches by obtaining credit protection from a monoline insurance company, such as Ambac. Because these hedges were in place, Citigroup presumed that the risk associated with the retained tranches had been neutralized. Citigroup reported these tranches at values for which they could not be sold, raising questions about their accuracy and, therefore, the accuracy of reported earnings. Quote, as everybody in any business knows, if inventory is growing, that means you're not pricing it correctly, unquote. Richard Buchstaber, who had been head of risk management at Citigroup in the late 1990s, told the FCIC. But keeping the tranches on the books at these prices improved the finances for creating the deal. Quote, it was a hidden subsidy of the CDO business by mispricing, unquote, Buchstaber said. The company would not begin writing the securities down toward the market's real valuations until the fall of 2007. Part of the reason for retaining exposures to super senior positions in CDOs was their favorable capital treatment. As we saw in an earlier chapter, under the 2001 recourse rule, one of the attractions of AAA-rated securities was that banks were required to hold relatively less capital against them than against lower-rated securities. And if the bank held those assets in their trading account, as opposed to holding them as a long-term investment, it could get even better capital treatment under the 1996 Market Risk Amendment. That rule allowed banks to use their own models to determine how much capital to hold, an amount that varied according to how much market prices moved. Citigroup judged that the capital requirement for the super senior tranches of synthetic CDOs it held for trading purposes was effectively zero, because the prices didn't move much. As a result, Citigroup held little regulatory capital against the super senior tranches. Citibank also held unfunded positions in super senior tranches of some synthetic CDOs, That is, it sold protection to the CDO. If the referenced mortgage collateral underperformed, the short investors would begin to get paid. Money to pay them would come first from wiping out long investors who had bought tranches that were below AAA. Then, if the short investors were still owed money, Citibank would have to pay. For taking on this risk, Citi typically received about 0.2% to 0.4% in annual fees on the super senior protection. On a $1 billion transaction, it would earn an annual fee of $2 million to $4 million. Citigroup also had exposure to the mortgage-backed and other securities that went into CDOs during the ramp-up period, which could be as long as 6 or 9 months, before it packaged and sold the CDO. Typically, Citigroup's securities unit would set up a warehouse funding line for the CDO manager. During the ramp-up period, the collateral securities would pay interest. Depending on the terms of the agreement, that interest would either go exclusively to Citigroup or be split with the manager. For the CDO desk, this frequently represented a substantial income stream. The securities sitting in the warehouse facility had relatively attractive yields, often 1% to 2.5% more than the typical bank borrowing rate, and it was not uncommon for the CDO desk to earn $10 to $15 million in interest on a single transaction. Traders on the desk would get credit for those revenues at bonus time. But Citigroup would also be on the hook for any losses incurred on assets stuck in the warehouse. When the financial crisis deepened, many CDO transactions could not be completed. Citigroup and other investment banks were forced to write down the value of securities held in their warehouses. The result would be substantial losses across Wall Street. In many cases, to offset assets, underwriters placed collateral from CDO warehouses into other CDOs. A factor that made firm-wide hedging complicated was that different units of Citigroup could have various and offsetting exposures to the same CDO. It was possible, even likely, that the CDO desk would structure a given CDO. A different division would buy protection for the underlying collateral, and yet another division would buy the unfunded super senior tranche. If the collateral in this CDO ran into trouble, the CDO immediately would have to pay the division that bought credit protection on the underlying collateral. If the CDO ran out of money to pay, it would have to draw on the division that bought the unfunded tranche. In November 2007, after Citigroup had reported substantial losses on its CDO portfolio, regulators would note that the company did not have a good understanding of its firm-wide CDO exposures. Quote, "The nature, origin, and size of CDO exposure were surprising to many in senior management and the board. The liquidity put exposure was not well known. In particular, management did not consider or effectively manage the credit risk inherent in CDO positions." Unquote. Citigroup's willingness to use its balance sheet to support the CDO business had the desired effect. Its CDO desk created $11 billion in CDOs that included mortgage-backed securities in their collateral in 2005 and $22 billion in 2006. Among CDO underwriters, including all types of CDOs, Citigroup rose from 14th place in 2003 to 2nd place in 2007, according to FCIC analysis of Moody's data. What was good for Citigroup's investment bank was also lucrative for its investment bankers. Thomas Maheras, the co-CEO of the investment bank, who said he spent less than 1% of his time thinking about CDOs, was a highly paid Citigroup executive, earning more than $34 million in salary and bonus compensation in 2006. Co-head of Global Fixed Income, Randolph Barker, made about $21 million in that same year. Citigroup's chief risk officer made $7.4 million. Others were also well rewarded. The co-heads of the global CDO business, Nestor Dominguez and Janice Warna, Each made about $6 million in total compensation in 2006. Citi did have clawback provisions. Under narrowly specified circumstances, compensation would have to be returned to the firm. But despite Citigroup's eventual large losses, no compensation was ever clawed back under this policy. The corporate library, which rates firms' corporate governance, gave Citigroup a C. In early 2007, the corporate library would downgrade Citigroup to a D, quote, reflecting a high degree of governance risk, unquote. Among the issues cited, executive compensation practices that were poorly aligned with shareholder interests. Where were Citigroup's regulators? While the company piled up tens of billions of dollars of risk in the CDO business, Citigroup had a complex corporate structure, and as a result, faced an array of supervisors. The Federal Reserve supervised the holding company, but, as the Gramm-Leach-Bliley legislation directed, relied on others to monitor the most important subsidiaries. The Office of the Comptroller of the Currency, or OCC, supervised the largest bank subsidiary, Citibank, and the SEC supervised the securities firm, Citigroup Global Markets. Moreover, Citigroup did not really align its various businesses with the legal entities. An individual working on the CDO desk on an intricate transaction could interact with various components of the firm in complicated ways. The SEC regularly examined the securities arm on a 3-year examination cycle, although it would also sometimes conduct other examinations to target specific concerns. Unlike the Fed and OCC, which had risk management and safety and soundness rules, the SEC used these exams to look for general weaknesses in risk management. Unlike safety and soundness regulators, who concentrated on preventing firms from failing, the SEC always kept its focus on protecting investors. Its most recent review of Citigroup's securities arm preceding the crisis was in 2005, and the examiners completed their report in June 2006. In that exam, they told the FCC, they saw nothing earth-shattering, but they did note key weaknesses in risk management practices that would prove relevant. Weaknesses in internal pricing and valuation controls, for example, and a willingness to allow traders to exceed their risk limits. Unlike the SEC, the Fed and OCC did maintain a continuous on-site presence. During the years that CDOs boomed, the OCC team regularly criticized the company for its weaknesses in risk management, including specific problems in the CDO business. Quote, earnings and profitability growth have taken precedence over risk management and internal control, unquote, the OCC told the company in January 2005. Another document from that year stated, quote, the findings of this examination are disappointing in that the business grew far in excess of management's underlying infrastructure and control processes, unquote. In May 2005, a review undertaken by peers at the other Federal Reserve banks was critical of the New York Fed, then headed by the current Treasury Secretary, Timothy Geithner, for its oversight of Citigroup. The review concluded that the Fed's on-site Citigroup team appeared to have, quote, insufficient resources to conduct continuous supervisory activities in a consistent manner. At Citi, much of the limited team's energy is absorbed by topical supervisory issues that detract from the team's continuous supervision objectives. The level of the staffing within the Citi team has not kept pace with the magnitude of supervisory issues that the institution has realized, unquote. That the Fed's 2005 examination of Citigroup did not raise the concerns expressed that same year by the OCC may illustrate these problems. 4 years later, the next peer review would again find substantial weaknesses in the New York Fed's oversight of Citigroup. In April 2006, the Fed raised the holding company's supervisory rating from the previous year's fair to satisfactory. It lifted the ban on new mergers imposed the previous year in response to Citigroup's many regulatory problems. The Fed and OCC examiners concurred that the company had made substantial progress in implementing CEO Charles Prince's plan to overhaul risk management. The Fed declared, quote, "The company has completed improvements necessary to bring the company into substantial compliance with two existing Federal Reserve enforcement actions related to the execution of highly structured transactions and controls," unquote. The following year, Citigroup's board would allude to Prince's successful resolution of its regulatory compliance problems in justifying his 20% compensation increase. The OCC noted in retrospect that the lifting of supervisory constraints in 2006 had been a key turning point. Quote, "After regulatory restraints against significant acquisitions were lifted, Citigroup embarked on an aggressive acquisition program," unquote. The OCC wrote to Vikram Pandit, Prince's replacement, in early 2008. Quote, "Additionally, with the removal of formal and informal agreements, the previous focus on risk and compliance gave way to business expansion and profits," unquote. Meanwhile, risk managers granted exceptions to limits and increased exposure limits instead of keeping business units in check, as they had told the regulators. Well after Citigroup sustained large losses on its CDOs, the Fed would criticize the firm for using its commercial bank to support its investment banking activities. Quote, "Senior management allowed business lines largely unchallenged access to the balance sheet to pursue revenue growth," unquote. The Fed wrote in an April 2008 letter to Pandit, quote, "Citigroup attained significant market share across numerous products, including leveraged finance and structured credit trading, utilizing balance sheet for its originate-to-distribute strategy. Senior management did not appropriately consider the potential balance sheet implications of this strategy in the case of market disruptions. Further, they did not adequately access the potential negative impact of earnings volatility of these businesses on the firm's capital position," unquote. Geithner told the Commission that he and others in leadership positions could have done more to prevent the crisis, testifying, quote, "I do not believe we were powerless," unquote. End of section 56. Section 57 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. AIG, I'm not getting paid enough to stand on these tracks. Unlike their peers at Citigroup, some senior executives at AIG's financial products subsidiary had figured out that the company was taking on too much risk. Nonetheless, they did not do enough about it. Doubts about all the credit default swaps that they were originating emerged in 2005 among AIG financial products executives, including Andrew Forster and Gene Park. Park told the FCIC that he witnessed financial products CEO Joseph Cassano berating a salesman over the large volume of credit default swaps being written by AIG financial products, suggesting there was already some high-level uneasiness with these deals. Told by a consultant, Gary Gorton, that the multi-sector CDOs on which AIG was selling credit default swaps consisted mainly of mortgage-backed securities with less than 10% subprime and Alt-A mortgages, Park asked Adam Butnick, another AIG employee, for verification. Butnick double-checked and returned to say, according to Park, "I can't believe it. You know, it's like 80 or 90%. Reviewing the portfolio and thinking about a friend who had received 100% financing for his new home after losing his job, Park said, quote, "This is horrendous business. We should get out of it," unquote. In July 2005, Park's colleague, Andrew Forster, sent an email both to Alan Frost, the AIG salesman primarily responsible for the company's booming credit default swap business, and to Gorton, who had engineered the formula to determine how much risk AIG was taking on each CDS it wrote. Quote, "We are taking on a huge amount of subprime mortgage exposure here," unquote, Forster wrote. Quote, "Everyone we have talked to says they're worried about deals with huge amounts of high-risk mortgage exposure. Yet I regularly see deals with 80% high-risk mortgage concentrations currently. Are these really the same risk as other deals?" Unquote. Park and others studied the issue for weeks, talked to bank analysts and other experts, and considered whether it made sense for AIG to continue to write protection on the subprime and Alt-A mortgage markets. The general view of others was that some of the underlying mortgages were structured to fail, but that all the borrowers would basically be bailed out as long as real estate prices went up. The AIG consultant Gorton recalled a meeting that he and others from AIG had with one Bear Stearns analyst. The analyst was so optimistic about the housing market that they thought he was out of his mind and must be on drugs or something. Speaking of a potential decline in the housing market, Park related to the FCIC the risks as he and some of his colleagues saw them, saying, quote, "We weren't getting paid enough money to take that risk. I'm not going to opine on whether there's a train on its way. I just know that I'm not getting paid enough to stand on these tracks," unquote. By February 2006, Park and others persuaded Cassano and Frost to stop writing CDS protection on subprime mortgage-backed securities. In an email to Cassano on February 28, Park wrote, quote, "Joe, below summarizes the message we plan on delivering to dealers later this week with regard to our approach to the CDO of ABS super senior business going forward. We feel that the CDO of ABS market has increasingly become less diverse over the last year or so, and is currently at a state where deals are almost totally reliant on subprime/non-prime residential mortgage collateral. Given current trends in the housing market, our perception of deteriorating underwriting standards, and the potential for higher rates, we are no longer as comfortable taking such concentrated exposure to certain parts of the non-prime mortgage securitizations. On the deals that we participate on, we would like to see significant change in the composition of these deals going forward, i.e., more diversification into the non-correlated asset classes. As a result of our ongoing due diligence, we are not as comfortable with the mezzanine layers, namely BBB and single-A tranches, of this asset class. We realize that this is likely to take us out of the CDO of ABS market for the time being, given the arbitrage in subprime collateral. However, we remain committed to working with underwriters and managers in developing the CDO of ABS market to hopefully become more diversified from a collateral perspective. With that in mind, we are open to including new asset classes to these structures, or increasing allocations to others, such as collateralized loan obligations and emerging market CDOs, unquote. AIG's counterparties responded with indifference. Quote, "The day that you, AIG, drop out, we're going to have 10 other people who are going to replace you," unquote. Park says he was told by an investment banker at another firm. In any event, counterparties had some time to find new takers because AIG financial products continued to write the credit default swaps. While the bearish executives were researching the issue from the summer of 2005 onward, the team continued to work on deals that were in the pipeline, even after February 2006. Overall, they completed 37 deals between September 2005 and July 2006. One of them, on a CDO backed by 93% subprime assets. By June 2007, AIG had written swaps on $79 billion in multi-sector CDOs, 5 times the $18 billion held at the end of 2005. Park asserted that neither he nor most others at AIG knew at the time that the swaps entailed collateral calls on AIG if the market value of the referenced securities declined. Park said their concern was simply that AIG would be on the hook if subprime and Alt-A borrowers defaulted in large numbers. Cassano, however, told the FCIC that he did know about the possible calls, but AIG's SEC filings to investors for 2005 mentioned the risk of collateral calls only if AIG were downgraded. Still, AIG never hedged more than $150 million of its total subprime exposure. Some of AIG's counterparties not only used AIG's swaps to hedge other positions, but also hedged AIG's ability to make good on its contracts. As we will see later, Goldman Sachs hedged aggressively by buying CDS protection on AIG and by shorting other securities and indexes to counterbalance the risk that AIG would fail to pay up on its swaps, or that a collapsing subprime market would pull down the value of mortgage-backed securities. End of section 57. Section 58 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Merrill, whatever it takes. When Dow Kim became co-president of Merrill Lynch's Global Markets and Investment Banking Group in July 2003, he was instructed to boost revenue, especially in businesses in which Merrill lagged behind its competitors. Kim focused on the CDO business. Clients saw CDOs as an integral part of their trading strategy, CEO Stanley O'Neill told the FCIC. Kim hired Chris Riccardi from Credit Suisse, where Riccardi's group had sold more CDOs than anyone else. Riccardi came through, lifting Merrill's CDO business from 15th place in 2002 to second place behind only Citigroup in 2004 and Goldman in 2005. Then, in February 2006, he left the bank to become CEO of Cohen & Company, an asset management business. At Cohen, he would manage several CDOs, often deals underwritten by Merrill. After Riccardi left, Kim instructed the rest of the team to do whatever it takes, not just to maintain market share, but also to take over the number 1 ranking, former employees said in a complaint filed against Merrill Lynch. Kim told the FCIC staff that he couldn't recall specific conversations, but that after Riccardi left, Merrill was still trying to expand the CDO business globally, and that he, Kim, wanted people to know that Merrill was willing to commit its people, resources, and balance sheet to achieve that goal. It was indeed willing. Despite the loss of its rainmaker, Merrill swamped the competition, originating a total $38.9 billion in mortgage-related CDOs in 2006, while the second-ranked firm, Morgan Stanley, did only $21.3 billion, and earning another first-place ranking in 2007 on the strength of the CDO machine Riccardi had built, a machine that brought in more than $1 billion in fees between 2003 and 2006. To keep its CDO business going, Merrill pursued 3 strategies, all of which involved repackaging riskier mortgages more attractively, or buying its own products when no one else would. Like Citigroup, Merrill increasingly retained for its own portfolio substantial portions of the CDOs it was creating, mainly the super senior tranches, and it increasingly repackaged the hard-to-sell BBB rated and other low-rated tranches of its CDOs into its other CDOs. It used the cash sitting in its synthetic CDOs to purchase other CDO tranches. It had long been standard practice for CDO underwriters to sell some mezzanine tranches to other CDO managers. Even in the early days of ABS CDOs, these assets often contained a small percentage of mezzanine tranches of other CDOs. The rating agencies signed off on this practice when rating each deal, but reliance on them became heavier as the demand from traditional investors waned, as it had for the riskier tranches of mortgage-backed securities. The market came to call traditional investors the real money, to distinguish them from CDO managers who were buying tranches just to put them into their CDOs. Between 2005 and 2007, the typical amount a CDO could include of the tranches of other CDOs and still maintain its ratings grew from 5% to 30%, according to the CDO manager Wing Chao. According to data compiled by the FCIC, tranches from CDOs rose from an average of 7% of the collateral in mortgage-backed CDOs in 2003 to 14% by 2007. CDO squared deals, those engineered primarily from the tranches of other CDOs, grew from 36 market-wide in 2005 to 48 in 2006 and 41 in 2007. Merrill created and sold 11 of them. Still, there are clear signs that few real money investors remained in the CDO market by late 2006. Consider Merrill. For the 44 ABS CDOs that Merrill created and sold from the fourth quarter of 2006 through August 2007, nearly 80% of the mezzanine tranches were purchased by CDO managers. The pattern was similar for Chao. An FCIC analysis determined that 88% of the mezzanine tranches sold by the 13 CDOs managed by Chao were sold for inclusion into other CDOs. An estimated 10 different CDO managers purchased tranches in Merrill's Norma CDO. In the most extreme case found by the FCIC, CDO managers were the only purchasers of Merrill's Neo CDO. Market-wide, in 2003, CDOs took in about 13% of the A tranches, 23% of the AA tranches, and 43% of the BAA tranches issued by other CDOs, as rated by Moody's. Moody's rating of AAA is equivalent to S&P's AAA, AA to AA, BAA to BBB, and BA to BB. In 2007, those numbers were 87%, 81%, and 89%, respectively. Merrill and other investment banks simply created demand for CDOs by manufacturing new ones to buy the harder-to-sell portions of the old ones. As SEC attorneys told the FCIC, heading into 2007, there was a street-wide gentleman's agreement. You buy my BBB tranche, and I'll buy yours. Merrill and its CDO managers were the biggest buyers of their own products. Merrill created and sold 142 CDOs from 2003 to 2007. All but 8 of these, 134 CDOs, sold at least one tranche into another Merrill CDO. In Merrill's deals, on average, 10% of the collateral packed into the CDOs consisted of tranches of other CDOs that Merrill itself had created and sold. This was a relatively high percentage, but not the highest. For Citigroup, another big player in this market, the figure was 13%. For UBS, it was just 3%. Managers defended the practice. Chow, who managed 13 CDOs created and sold by Merrill at Maxim Group and later Harding Advisory, and had worked with Riccardi at Prudential Securities in the early days of multi-sector CDOs, told the FCIC that plain mortgage-backed securities had become expensive in relation to their returns, even as the real estate market sagged. Because CDOs paid better returns than did similarly rated mortgage-backed securities, they were in demand, and that is why CDO managers packed their securities with other CDOs. And Merrill continued to push its CDO business, despite signals that the market was weakening. As late as the spring of 2006, when AIG stopped insuring even the very safest super senior CDO tranches for Merrill and others, it did not reconsider its strategy. Cut off from AIG, which had already insured $9.9 billion of its CDO bonds, Merrill was AIG's third largest counterparty after Goldman and Societe Generale. Merrill switched to the Monoline Insurance companies for protection. In the summer of 2006, Merrill management noticed that Citigroup, its biggest competitor in underwriting CDOs, was taking more super senior tranches of CDOs onto its balance sheet at razor-thin margins, and thus, in effect, subsidizing returns for investors in the BBB-rated and equity tranches. In response, Merrill continued to ramp up its CDO warehouses and inventory, and in an effort to compete and get deals done, it increasingly took on super senior positions without insurance from AIG or the monolines. This would not be the end of Merrill's all-in wager on the mortgage and CDO businesses. Even though it did grab the first-place trophy in the mortgage-related CDO business in 2006, it had come late to the vertical integration mortgage model that Lehman Brothers and Bear Stearns had pioneered, which required having a stake in every step of the mortgage business, originating mortgages, bundling these loans into securities, bundling these securities into other securities, and selling all of them on Wall Street. In September 2006, months after the housing bubble had started to deflate and delinquencies had begun to rise, Merrill announced it would acquire a subprime lender, First Franklin Financial Corp., from National City Corp. For $1.3 billion. As a finance reporter later noted, this move, quote, puzzled analysts because the market for subprime loans was souring in a hurry, unquote. And Merrill already had a $100 million ownership position in Own It Mortgage Solutions, Inc., for which it provided a warehouse line of credit. It also provided a line of credit to Mortgage Lenders Network. Both of these companies would cease operations soon after the First Franklin purchase. Nor did Merrill cut back in September 2006, when one of its own analysts issued a report warning that this subprime exposure could lead to a sudden cut in earnings, because demand for these mortgage assets could dry up quickly. That assessment was not in line with the corporate strategy, and Merrill did nothing. Finally, at the end of 2006, Kim instructed his people to reduce credit risk across the board. As it would turn out, they were too late. The pipeline was too large. End of section 58. Section 59 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 10. Regulators. Are undue concentrations of risk developing? As it happened when they faced the question of guidance on non-traditional mortgages, in dealing with the rapidly changing structured finance market, the regulators failed to take timely action. They missed a crucial opportunity. On January 2, 2003, 1 year after the collapse of Enron, the U.S. Senate Permanent Subcommittee on Investigations called on the Fed, OCC, and SEC, quote, to immediately initiate a one-time joint review of banks and securities firms participating in complex structured finance products with U.S. public companies, to identify those structured finance products, transactions, or practices which facilitate a U.S. company's use of deceptive accounting in its financial statements or reports, unquote. The subcommittee recommended the agencies issue joint guidance on, quote, acceptable and unacceptable structured finance products, transactions, and practices by June 2003. 4 years later, the banking agencies and the SEC issued their interagency statement on sound practices concerning elevated risk, complex structured finance activities, a document that was all of 9 pages long. In the intervening years, from 2003 to 2007, the banking agencies and SEC issued 2 draft statements for public comment. The 2004 draft, issued the year after the OCC, Fed, and SEC had brought enforcement actions against Citigroup and J.P. Morgan for helping Enron to manipulate its financial statements, focused on the policies and procedures that financial institutions should have for managing the structured finance business. The aim was to avoid another Enron, and for that reason, the statement encouraged financial institutions to look out for customers that, like Enron, were trying to use structured transactions to circumvent regulatory or financial reporting requirements, evade tax liabilities, or engage in other illegal or improper behavior. Industry groups criticized the draft guidance as too broad, prescriptive, and burdensome. Several said it would cover many structured finance products that did not pose significant legal or reputational risks. Another said that it would, quote, disrupt the market for legitimate structured finance products and place U.S. financial institutions at a competitive disadvantage in the market for complex structured finance transactions in the United States and abroad, unquote. 2 years later, in May 2006, the agencies issued an abbreviated draft that reflected a more principles-based approach and again requested comments. Most of the requirements were very similar to those that the OCC and Fed had imposed on Citigroup and J.P. Morgan in the 2003 enforcement actions. When the regulators issued the final guidance in January 2007, the industry was more supportive. One reason was that mortgage-backed securities and CDOs were specifically excluded. Quote, most structured finance transactions, such as standard public mortgage-backed securities and hedging-type transactions involving plain vanilla derivatives or collateralized debt obligations, are familiar to participants in the financial markets, have well-established track records, and typically would not be considered complex structured finance transactions for purposes of the final statement, unquote. Those exclusions had been added after the regulators received comments on the 2004 draft. Regulators did take note of the potential risks of CDOs and credit default swaps. In 2005, the Basel Committee on Banking Supervision's Joint Forum, which includes banking, securities, and insurance regulators from around the world, issued a comprehensive report on these products. The report focused on whether banks and other firms involved in the CDO and credit default swap business understood the credit risk they were taking. It advised them to make sure that they understood the nature of the rating agency's models, especially for CDOs. And it further advised them to make sure that counterparties from whom they bought credit protection, such as AIG and the financial guarantors, would be good for that protection if it was needed. The regulators also said they had researched in some depth for the CDO and derivatives market the question, are undue concentrations of risk developing? Their answer? Probably not. The credit risk was quite modest, the regulators concluded, and the monoline financial guarantors appeared to know what they were doing. Quote, the Joint Forum's Working Group on Risk Assessment and Capital has not found evidence of hidden concentrations of credit risk. There are some non-bank firms whose primary business model focuses on taking on credit risk. Most important among these firms are the monoline financial guarantors. Other market participants seem to be fully aware of the nature of these firms. In the case of the monolines, credit risk has always been a primary business activity, and they have invested heavily in obtaining the relevant expertise. While obviously this does not rule out the potential for one of these firms to experience unanticipated problems or to misjudge the risks, their risks are primarily at the catastrophic or macroeconomic level. It is also clear that such firms are subjected to regulatory, rating agency, and market scrutiny. Unquote. The regulators noted that industry participants appeared to have learned from earlier flare-ups in the CDO sector. Quote, the working group believes that it is important for investors in CDOs to seek to develop a sound understanding of the credit risks involved, and not to rely solely on rating agency assessments. In many respects, the losses and downgrades experienced on some of the early generation of CDOs have probably been salutary in highlighting the potential risks involved. Unquote. End of section 59. Section 60 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Moody's. It was all about revenue. Like other market participants, Moody's Investor Service, one of the three dominant rating agencies, was swept up in the frenzy of the structured products market. The tranching structure of mortgage-backed securities and CDOs was standardized according to guidelines set by the agencies. Without their models and their generous allotment of AAA ratings, there would have been little investor interest and few deals. Between 2002 and 2006, the volume of Moody's business devoted to rating residential mortgage-backed securities more than doubled. The dollar value of that business increased from $62 million to $169 million. The number of staff rating these deals doubled. But over the same period, while the volume of CDOs to be rated increased sevenfold, staffing increased only 24%. From 2003 to 2006, annual revenue tied to CDOs grew from $12 million to $91 million. When Moody's Corporation went public in 2000, the investor Warren Buffett's Berkshire Hathaway held 15% of the company. After share repurchases by Moody's Corporation, Berkshire Hathaway's holdings of outstanding shares increased to over 20% by 2008. As of 2010, Berkshire Hathaway and three other investors owned a combined 50.5% of Moody's. When asked whether he was satisfied with the internal controls at Moody's, Buffett responded to the FCIC that he knew nothing about the management of Moody's. Quote, I had no idea. I'd never been at Moody's. I don't know where they are located, unquote. Buffett said that he invested in the company because the rating agency business was, quote, a natural duopoly, unquote, which gave it incredible pricing power. And, quote, the single most important decision in evaluating a business is pricing power, unquote. Many former employees said that after the public listing, the company culture changed. It went, quote, from a culture resembling a university academic department to one which values revenues at all costs, unquote, according to Eric Kolchinsky, a former managing director. Employees also identified a new focus on market share. directed by former president of Moody's Investor Service, Brian Clarkson. Clarkson had joined Moody's in 1991 as a senior analyst in the residential mortgage group, and after successive promotions, he became co-chief operating officer of the rating agency in 2004 and then president in August 2007. Gary Witt, a former team managing director covering U.S. derivatives, described the cultural transformation under Clarkson. Quote, "My kind of working hypothesis was that former chairman and CEO John Rutherford was thinking, I want to remake the culture of this company to increase profitability dramatically after Moody's became an independent corporation, and that he made personnel decisions to make that happen, and he was successful in that regard. And that is why Brian Clarkson's rise was so meteoric. He was the enforcer who could change the culture to have more focus on market share," unquote. The former managing director, Jerome Fons, who was responsible for assembling an internal history of Moody's, agreed. Quote, "The main problem was that the firm became so focused, particularly the structured area, on revenues, on market share, and the ambitions of Brian Clarkson, that they willingly looked the other way, traded the firm's reputation for short-term profits," unquote. Moody's Corporation Chairman and CEO Raymond McDaniel did not agree with this assessment, telling the FCIC that he didn't see, quote, "any particular difference in culture," unquote, after the spinoff. Clarkson also disputed this version of events, explaining that market share was important to Moody's well before it was an independent company. Quote, "The idea that before Moody's was spun off from Dun & Bradstreet, it was a sort of sleepy, academic kind of company that was in an ivory tower isn't the case, you know," unquote, he explained. Quote, "I think the ivory tower was really a misnomer. I think that Moody's has always been focused on business," unquote. Clarkson and McDaniel also adamantly disagreed with the perception that concerns about market share trumped ratings quality. Clarkson told the FCIC that it was fine for Moody's to lose transactions if it was for the right reasons. Quote, "If it was an analytical reason or it was a credit reason, there's not a lot you can do about that. But if you're losing a deal because you're not communicating, you're not being transparent, you're not picking up the phone, that could be problematic," unquote. McDaniel cited unforeseen market conditions as the reason that the models did not accurately predict the credit quality. He testified to the FCIC, quote, "We believed that our ratings were our best opinion at the time that we assigned them. As we obtained new information and were able to update our judgments based on the new information and the trends we were seeing in the housing market, we made what I think are appropriate changes to our ratings," unquote. Nonetheless, Moody's president did not seem to have the same enthusiasm for compliance as he did for market share and profit, according to those who worked with him. Scott McCluskey, a former chief compliance officer at Moody's, recounted a story to the FCIC about an evening when he and Clarkson were dining with the board of directors after the company had announced strong earnings, particularly in the business of rating mortgage-backed securities and CDOs. Quote, "So Brian Clarkson comes up to me in front of everybody at the table, including board members, and says literally, 'How much revenue did compliance bring in this quarter?' Nothing. Nothing." For him to say that in front of the board, that is just so telling of how he felt that he was bulletproof. For him, it was all about revenue, unquote. Clarkson told the FCIC that he didn't remember this conversation transpiring and said, quote, "From my perspective, compliance is a very important function," unquote. According to some former Moody's employees, Clarkson's management style left little room for discussion or dissent. Witt referred to Clarkson as the dictator of Moody's and said that if he asked an employee to do something, quote, Either you comply with his request or you start looking for another job, unquote. Quote, when I joined Moody's in late 1997, an analyst's worst fear was that we would contribute to the assignment of a rating that was wrong, unquote. Mark Friba, former senior vice president, testified to the FCIC. Quote, when I left Moody's, an analyst's worst fear was that he would do something, or she, that would allow him or her to be singled out for jeopardizing Moody's market share, unquote. Clarkson denied having a forceful management style, and his supervisor, Raymond McDaniel, told the FCIC that Clarkson was a good manager. Former team managing director Gary Witt recalled that he received a monthly email from Clarkson, quote, that outlined basically my market share in the areas that I was in charge of. I believe it listed the deals that we did, and then it would list the deals like S&P and or Fitch did that we didn't do that was in my area. And at times I would have to comment on that verbally, or even write a written report about, look into what it was about that deal, why we did not rate it. So, it was clear that market share was important to him, unquote. Witt acknowledged the pressures that he felt as a manager. Quote, when I was an analyst, I just thought about getting the deals right. Once I was promoted to managing director and had a budget to meet, I had salaries to pay. I started thinking bigger picture. I started realizing, yes, we do have shareholders, and yes, they deserve to make some money. We need to get the ratings right first. That's the most important thing. But you do have to think about market share, unquote. Even as far back as 2001, a strong emphasis on market share was evident in employee performance evaluations. In July 2001, Clarkson circulated a spreadsheet to subordinates that listed 49 analysts and the number and dollar volume of deals each had rated or not rated. Clarkson's instructions? Quote, you should be using this in PEs, performance evaluations, and to give people a heads up on where they stand relative to their peers, unquote. Team managing directors who oversaw the analysts rating the deals received a base salary, cash bonus, and stock options. Their performance goals generally fell into the categories of market coverage, revenue, market outreach, such as speeches and publications, ratings quality, and development of analytical tools, only one of which was impossible to measure in real time as compensation was being awarded: ratings quality. It might take years for the poor quality of a rating to become clear, as the rated asset failed to perform as expected. In January 2006, a derivatives manager listed his most important achievements in a 2005 performance evaluation. At the top of the list, quote, protected our market share in the CDO corporate cash flow sector. To my knowledge, we missed only one CLO, collateralized loan obligation, from B of A, and that CLO was unratable by us because of its bizarre structure, unquote. More evidence of Moody's emphasis on market share was provided by an email that circulated in the fall of 2007, in the midst of significant downgrades in the structured finance market. Group Managing Director of U.S. Derivatives, Yuri Yoshizawa, asked her team's managing directors to explain a market share decrease from 98% to 94%. Despite this apparent emphasis on market share, Clarkson told the FCIC that, quote, the most important goal for any managing director would be credibility and performance of the ratings, unquote. McDaniel, the chairman and CEO of Moody's Corporation, elaborated, quote, I disagree that there was a drive for market share. We pay attention to our position in the market, but ratings quality, getting the ratings to the best possible predictive content, predictive status, is paramount, unquote. Whatever McDaniel's or Clarkson's intended message, some employees continued to see an emphasis on Moody's market share. Former team managing director Witt recalled that the smoking gun moment of his employment at Moody's occurred during a town hall meeting in the third quarter of 2007 with Moody's management and its managing directors, after Moody's had already announced mass downgrades on mortgage-related securities. After McDaniel made a presentation about Moody's financial outlook for the year ahead, one managing director responded, quote, "I was interested, Ray, to hear your belief that the first thing in the minds of people in this room is the financial outlook for the remainder of the year. My thinking is there's a much greater concern about the franchise," unquote. He added, quote, "I think that the greater anxiety being felt by the people in this room and by the analysts is what's going on with the ratings and what the outlook is, specifically the severe ratings transitions we're dealing with, and uncertainty about what's ahead on that, the ratings accuracy," unquote. Witt recalled, quote, "Moody's reputation was just being absolutely lacerated, and that these people are standing here, and they're not even addressing. They're acting like it's not even happening, even now that it's already happened. That just made it so clear to me that the balance was far too much on the side of short-term profitability," unquote. In an internal memorandum from October 2007 sent to McDaniel, in a section titled Conflict of Interest, Market Share, Chief Credit Officer Andrew Kimball explained that, quote, "Moody's has erected safeguards to keep teams from too easily solving the market share problem by lowering standards," unquote. But he observed that these protections were far from fail-safe, as he detailed in two areas. First, quote, "Ratings are assigned by committee, not individuals. However, entire committees, entire departments, are susceptible to market share objectives," unquote. Second, quote, "Methodologies and criteria are published and thus put boundaries on rating committee discretion. However, there is usually plenty of latitude within those boundaries to register market influence," unquote. Moreover, the pressure for market share, combined with complacency, may have deterred Moody's from creating new models or updating its assumptions. As Kimball wrote, quote, "Organizations often interpret past successes as evidencing their competence and the adequacy of their procedures rather than a run of good luck. Our 24 years of success rating RBMS, residential mortgage-backed securities, may have induced managers to merely fine-tune the existing system, to make it more efficient, more profitable, cheaper, more versatile. Fine-tuning rarely raises the probability of success. In fact, it often makes success less certain," unquote. If an issuer didn't like a Moody's rating on a particular deal, it might get a better rating from another ratings agency. The agencies were compensated only for rated deals, in effect, only for the deals for which their ratings were accepted by the issuer. So the pressure came from two directions: in-house insistence on increasing market share and direct demands from the issuers and investment bankers, who pushed for better ratings with fewer conditions. Richard Michalek, a former Moody's vice president and senior credit officer, testified to the FCIC, quote, "The threat of losing business to a competitor, even if not realized, absolutely tilted the balance away from an independent arbiter of risk towards a captive facilitator of risk transfer," unquote. Witt agreed. When asked if the investment banks frequently threatened to withdraw their business if they didn't get their desired rating, Witt replied, quote, "Oh God, are you kidding? All the time. I mean, that's routine. I mean, they would threaten you all of the time. It's like, well, next time we're just going to go with Fitch and S&P," unquote. Clarkson affirmed that, quote, "It wouldn't surprise me to hear people say that," unquote, about issuer pressure on Moody's employees. Former Managing Director Fonz suggested that Moody's was complacent when it should have been principled. Quote, "Moody's knew that they were being bullied into caving in to bank pressure from the investment banks and originators of these things. Moody's allowed itself to be bullied. And they willingly played the game. They could have stood up and said, I'm sorry, we're not going to sign off on this. We're going to protect investors. We're going to stop. We're going to try to protect our reputation. We're not going to rate these CDOs. We're not going to rate these subprime RMBS, unquote. Kimball elaborated further in his October 2007 memorandum. Quote, ideally, competition would be primarily on the basis of ratings quality, with a second component of price and a third component of service. Unfortunately, of the three competitive factors, rating quality is proving the least powerful, given the long tail in measuring performance. The real problem is not that the market does underweight ratings quality, but rather that, in some sectors, it actually penalizes quality by awarding rating mandates based on the lowest credit enhancement needed for the highest rating. Unchecked, competition on this basis can place the entire financial system at risk. It turns out that ratings quality has surprisingly few friends. Issuers want high ratings. Investors don't want rating downgrades. And bankers game the rating agencies for a few extra basis points on execution, unquote. Moody's employees told the FCIC that one tactic used by the investment bankers to apply subtle pressure was to submit a deal for a rating within a very tight time frame. Kolchinsky, who oversaw ratings on CDOs, recalled the case of a particular CDO. Quote, what the trouble on this deal was, and this is crucial about the market share, was that the banker gave us hardly any notice and any documents and any time to analyze this deal. Because bankers knew that we could not say no to a deal, could not walk away from the deal because of a market share, they took advantage of that, unquote. For this CDO deal, the bankers allowed only 3 or 4 days for review and final judgment. Kolchinsky emailed Yoshizawa that the transactions had, quote, egregiously pushed our time limits and analysts, unquote. Before the frothy days of the peak of the housing boom, an agency took 6 weeks, or even 2 months, to rate a CDO. By 2006, Kolchinsky described a very different environment in the CDO group. Quote, bankers were pushing more aggressively, so it became from a quiet little group to more of a machine, unquote. In 2006, Moody's gave AAA ratings to an average of more than 30 mortgage securities each and every working day. Such pressure can be seen in an April 2006 email to Yoshizawa from a managing director in synthetic CDO trading at Credit Suisse, who explained, quote, I'm going to have a major political problem if we can't make this deal rating short and sweet. Because even though I always explain to investors that closing is subject to Moody's timelines, they often choose not to hear it, unquote. The external pressure was summed up in Kimball's October 2007 memorandum. Quote, analysts and managing directors are continually pitched by bankers, issuers, investors, all with reasonable arguments, whose views can color credit judgment, sometimes improving it, other times degrading it. We drink the Kool-Aid. Coupled with strong internal emphasis on market share and margin focus, this does constitute a risk to ratings quality, unquote. The SEC investigated the rating agency's ratings of mortgage-backed securities and CDOs in 2007, reporting its findings to Moody's in July 2008. The SEC criticized Moody's for, among other things, failing to verify the accuracy of mortgage information, leaving that work to due diligence firms and other parties, failing to retain documentation about how most deals were rated, allowing ratings quality to be compromised by the complexity of CDO deals, not hiring sufficient staff to rate CDOs, pushing ratings out the door with insufficient review, failing to adequately disclose its ratings process for mortgage-backed securities and CDOs, and allowing conflicts of interest to affect ratings decisions. So matters stood in 2007, when the machine that had been humming so smoothly and so lucratively slipped a gear, and then another, and another, and then seized up entirely. End of section 60. Section 61 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Commission conclusions on Chapter 10. The Commission concludes that the credit rating agencies abysmally failed in their central mission to provide quality ratings on securities for the benefit of investors. They did not heed many warning signs indicating significant problems in the housing and mortgage sector. Moody's, the Commission's case study in this area, continued issuing ratings on mortgage-related securities using its outdated analytical models rather than making the necessary adjustments. The business model under which firms issuing securities paid for their ratings seriously undermined the quality and integrity of those ratings. The rating agencies placed market share and profit considerations above the quality and integrity of their ratings. Despite the leveling off and subsequent decline of the housing market, beginning in 2006, securitization of collateralized debt obligations, CDOs, CDO squared, and synthetic CDOs continued unabated, greatly expanding the exposure to losses when the housing market collapsed, and exacerbating the impact of the collapse on the financial system and the economy. During this period, speculators fueled the market for synthetic CDOs to bet on the future of the housing market. CDO managers of these synthetic products had potential conflicts in trying to serve the interests of customers who were betting mortgage borrowers would continue to make their payments, and of customers who were betting the housing market would collapse. There were also potential conflicts for underwriters of mortgage-related securities, to the extent they shorted the products for their own accounts outside of their roles as market makers. End of Section 61 and of Chapter 10. Section 62 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 11, The Bust. What happens when a bubble bursts? In early 2007, it became obvious that home prices were falling in regions that had once boomed, that mortgage originators were floundering, and that more and more families, especially those with subprime and Alt-A loans, would be unable to make their mortgage payments. What was not immediately clear was how the housing crisis would affect the financial system that had helped inflate the bubble. Were all those mortgage-backed securities and collateralized debt obligations ticking time bombs on the balance sheets of the world's largest financial institutions? Quote, the concerns were just that if people couldn't value the assets, then that created questions about the solvency of the firms, unquote. William C. Dudley, now president of the Federal Reserve Bank of New York, told the FCIC. In theory, securitization, over-the-counter derivatives, and the many byways of the shadow banking system were supposed to distribute risk efficiently among investors. The theory would prove to be wrong. Much of the risk from mortgage-backed securities had actually been taken by a small group of systemically important companies with outsized holdings of, or exposure to, the super senior and AAA tranches of CDOs. These companies would ultimately bear great losses, even though those investments were supposed to be super safe. As 2007 went on, increasing mortgage delinquencies and defaults compelled the ratings agencies to downgrade First, mortgage-backed securities, then CDOs. Alarmed investors sent prices plummeting. Hedge funds, faced with margin calls from their repo lenders, were forced to sell at distressed prices. Many would shut down. Banks wrote down the value of their holdings by tens of billions of dollars. The summer of 2007 also saw a near halt in many securitization markets, including the market for non-agency mortgage securitizations. For example, a total of $75 billion in subprime securitizations were issued in the second quarter of 2007, already down from prior quarters. That figure dropped precipitously to $27 billion in the third quarter and to only $12 billion in the fourth quarter of 2007. Alt-A issuance topped $100 billion in the second quarter, but fell to $13 billion in the fourth quarter of 2007. Once booming markets were now gone. Only $4 billion in subprime or Alt-A mortgage-backed securities were issued in the first half of 2008, and almost none after that. CDOs followed suit. From a high of more than $90 billion in the first quarter of 2007, worldwide issuance of CDOs with mortgage-backed securities as collateral plummeted to $29 billion in the third quarter of 2007 and only $5 billion in the fourth quarter. And as the CDO market ground to a halt, investors no longer trusted other structured products. Over $80 billion of collateralized loan obligations, or CLOs, or securitized leveraged loans were issued in 2007. Only $10 billion were issued in 2008. The issuance of commercial real estate mortgage-backed securities plummeted from $232 billion in 2007 to $12 billion in 2008. Those securitization markets that held up during the turmoil in 2007 eventually suffered in 2008 as the crisis deepened. Securitization of auto loans, credit cards, small business loans, and equipment leases all nearly ceased in the third and fourth quarters of 2008. Delinquencies, the turn of the housing market. Home prices rose 15% nationally in 2005, their third year of double-digit growth. But by the spring of 2006, as the sales pace slowed, the number of months it would take to sell off all the homes on the market rose to its highest level in 10 years. Nationwide, home prices peaked in April 2006. Members of the Federal Reserve's Federal Open Market Committee, or FOMC, discussed housing prices in the spring of 2006. Chairman Ben Bernanke and other members predicted a decline in home prices, but were uncertain whether the decline would be slow or fast. Bernanke believed some correction in the housing market would be healthy, and that the goal of the FOMC should be to ensure the correction did not overly affect the growth of the rest of the economy. In October 2006, with the housing market downturn underway, Moody's Economy.com, a business unit separate from Moody's Investor Service, issued a report authored by chief economist Mark Zandi titled Housing at the Tipping Point, the Outlook for the U.S. Residential Real Estate Market. He came to the following conclusion, quote, nearly 20 of the nation's metro areas will experience a crash in house prices, a double-digit peak-to-trough decline in house prices. These sharp declines in house prices are expected along the southwest coast of Florida, in the metro areas of Arizona and Nevada, in a number of California areas, throughout the broad Washington, D.C. area, and in and around Detroit. Many more metro areas are expected to experience only house price corrections, in which peak-to-trough price declines remain in the single digits. It is important to note that price declines in various markets are expected to extend into 2008 and even 2009. With over 100 metro areas representing nearly one-half of the nation's housing stock, experiencing or about to experience price declines, national house prices are also set to decline. Indeed, odds are high that national house prices will decline in 2007, unquote. For 2007, the National Association of Realtors announced that the number of sales of existing homes had experienced the sharpest fall in 25 years. That year, home prices declined 9%. In 2008, they would drop a stunning 17%. Overall, by the end of 2009, prices would drop 28% from their peak in 2006. Some cities saw a particularly large drop. In Las Vegas, as of August 2010, home prices were down 55% from their peak, and areas that never saw huge price gains had experienced losses as well. Home prices in Denver have fallen 18% since their peak. In some areas, home prices started to fall as early as late 2005. For example, in Ocean City, New Jersey, where many properties are vacation homes, home prices had risen 144% since 2001. They topped out in December 2005 and fell 4% in the first half of 2006. By mid-2010, they would be 22% below their peak. Prices topped out in Sacramento in October 2005 and are today down nearly 50%. In most places, prices rose for a bit longer. For instance, in Tucson, Arizona, prices kept increasing for much of 2006, climbing 95% from 2001 to their high point in August 2006, and then fell only 3% by the end of the year. One of the first signs of the housing crash was an upswing in early payment defaults, usually defined as borrowers being 60 or more days delinquent within the first year. Figures provided to the FCIC show that by the summer of 2006, 1.5% of loans less than a year old were in default. The figure would peak in late 2007 at 2.5%, well above the 1% peak in the 2000 recession. Even more stunning, first payment defaults, that is, mortgages taken out by borrowers who never made a single payment, went above 1.5% of loans in early 2007. Responding to questions about that data, CoreLogic chief economist Mark Fleming told the FCIC that the early payment default rate, quote, certainly correlates with the increase in the Alt-A and subprime shares and the turn of the housing market and the sensitivity of those loan products, unquote. Mortgages in serious delinquency, defined as those 90 or more days past due or in foreclosure, had hovered around 1% during the early part of the decade, jumped in 2006, and kept climbing. By the end of 2009, 9.7% of mortgage loans were seriously delinquent. By comparison, serious delinquencies peaked at 2.4% in 2002, following the previous recession. Serious delinquency was highest in areas of the country that had experienced the biggest housing booms. In the Sand States, California, Arizona, Nevada, and Florida, serious delinquency rose to 3% in mid-2007 and 15% by late 2009, double the rate in other areas of the country. See Figure 11.1. Figure 11.1 is captioned Mortgage Delinquencies by Region. Subtitle, Arizona, California, Florida, and Nevada, the Sand States, had the most problem loans. The graph shows that by 2010, mortgage delinquencies in the so-called Sand States were 13.6%. Total delinquencies in the U.S. were 8.7%, and 7% in the so-called non-Sand States. Note, serious delinquencies include mortgages 90 days or more past due and those in foreclosure. Source, Mortgage Bankers Association National Delinquency Survey. The complete graph can be viewed on page 216 of the printed report. Returning to the text. Serious delinquency also varied by type of loan. See Figure 11.2. Figure 11.2, labeled Mortgage Delinquencies by Loan Type, can be viewed on page 217 of the printed report. Subprime adjustable rate mortgages began to show increases in serious delinquency in early 2006, even as house prices were peaking. The rate rose rapidly to 20% in 2007. By late 2009, the delinquency rate for subprime ARMs was 40%. Prime ARMs did not weaken until 2007, at about the same time as subprime fixed-rate mortgages. Prime fixed-rate mortgages, which have historically been the least risky, showed a slow increase in serious delinquency that coincided with the increasing severity of the recession and of unemployment in 2008. The FCIC undertook an extensive examination of the relative performance of mortgages purchased or guaranteed by the GSEs, those securitized in the private market, and those insured by the Federal Housing Administration or Veterans Administration. See Figure 11.3. Figure 11.3, labeled Loan Performance in Various Mortgage Market Segments, can be viewed on page 218 of the printed report. The analysis was conducted using roughly 25 million mortgages outstanding at the end of each year from 2006 through 2009. The data contained mortgages in 4 groups: loans that were sold into private label securitizations labeled subprime by issuers, labeled SUB, loans sold into private label Alt-A securitizations, or ALT, loans either purchased or guaranteed by the GSEs, GSE, and loans guaranteed by the Federal Housing Administration or Veterans Administration, or FHA. The GSE group, in addition to the more traditional conforming GSE loans, also included mortgages that the GSEs identified as subprime and Alt-A loans, owing to their higher risk characteristics as discussed in earlier chapters. Within each of the 4 groups, the FCIC created subgroups based on characteristics that could affect loan performance: FICO credit scores, loan-to-value ratios, or LTVs, and mortgage size. For example, one subgroup would be GSE loans with a balance below $417,000, conforming to GSE loan size limits, a FICO score between 640 and 659, a borrower with below-average credit history, and LTV between 80% and 100%. Another group would be Alt-A loans with the same characteristics. In each year, the loans were broken into 576 different subgroups, 144 each for GSE, Sub, Alt, and FHA. Figure 11.3 graphically demonstrates the results of the examination. The various bars show the range of average delinquencies for each of the 4 groups examined, based on the distribution of delinquency rates within the 144 subgroups for each loan category. The black portion of each bar represents the middle 50%, 25% on either side of the median, of the distribution of average delinquency rates. The full bar, including both dark and light shading, represents the middle 90% of the distribution of average delinquency rates. The bars exclude the 5% at the extremes of each end of the distribution. For example, at the end of 2008, the black portion of the GSE bar spans a 0.6% average delinquency rate on the low end and a 2.4% average delinquency rate on the high end. The full bar for the GSEs spans average delinquency rates from 0.1% to 6%. That means that only 5% of GSE loans were in subgroups with average delinquency rates above 6%. In sharp contrast, The black bar for private label subprime securitizations, or SUB, spans average delinquency rates between 24% on the low end and 31% on the high end, and the full bar spans average delinquency rates between 10% and 32%. That means that only 5% of SUB loans were in subgroups with average delinquency rates below 10%. The worst performing 5% of GSE loans are in subgroups with rates of serious delinquency similar to the best performing 5% of SUB loans. By the end of 2009, performance within all segments of the market had weakened. The median delinquency rate, the midpoints of the black bars, rose from 1% in 2008 to 2.5% for GSE loans, from 29% to 39% for SUB loans, from 12% to 21% for Alt-A loans, and remained at roughly 6% for FHA loans. The data illustrate that in 2008 and 2009, GSE loans performed significantly better than privately securitized, or non-GSE, subprime and Alt-A loans. That holds true even when comparing loans in GSE pools that share the same key characteristics with the loans in privately securitized mortgages, such as low FICO scores. For example, among loans to borrowers with FICO scores below 660, a privately securitized mortgage was more than 4 times as likely to be seriously delinquent as a GSE. In 2008, the respective average delinquency rates for the non-GSE and GSE loans were 28.3% and 6.2%. These patterns are most likely driven by differences in underwriting standards, as well as by some differences not captured in these mortgages. For instance, in the GSE pool, borrowers tended to make bigger down payments. The FCIC's data show that 58% of GSE loans with FICO scores below 660 had an original loan-to-value ratio below 80%, indicating that the borrower made a down payment of at least 20% of the sales price. This relatively large down payment would help offset the effect of the lower FICO score. In contrast, only 31% of loans with FICO scores below 660 in non-GSE subprime securitization had an LTV under 80%. The data illustrate that non-agency securitized loans were much more likely to have more than one risk factor and thereby exhibit so-called risk layering, such as low FICO scores on top of small down payments. GSE mortgages with Alt-A characteristics also performed significantly better than mortgages packaged into non-GSE Alt-A securities. For example, in 2008, among loans with an LTV above 90%, the GSE pools have an average rate of serious delinquency of 5.7% versus a rate of 15.5% for loans in private Alt-A securities. These results are also, in large part, driven by differences in risk layering. Others frame the situation differently. According to Ed Pinto, a mortgage finance industry consultant who was the chief credit officer at Fannie Mae in the 1980s, GSEs dominated the market for risky loans. In written analyses reviewed by the FCIC staff and sent to commissioners, as well as in a number of interviews, Pinto has argued that the GSE loans that had FICO scores below 660, a combined loan-to-value ratio greater than 90%, or other mortgage characteristics, such as interest-only payments, were essentially equivalent to those mortgages in securitizations labeled subprime and Alt-A by issuers. Using strict cutoffs on FICO score and loan-to-value ratios that ignore risk layering, and thus are only partly related to mortgage performance, as well as relying on a number of other assumptions, Pinto estimates that as of June 30th, 2008, 49% of all mortgages in the country, 26.7 million of them, were risky mortgages that he defines as subprime or Alt-A. Of these, Pinto counts 11.9 million, or 45%, that were purchased or guaranteed by the GSEs. In contrast, the GSEs categorize fewer than 3 million of their loans as subprime or Alt-A. Importantly, as the FCIC review shows, the GSE loans classified as subprime or Alt-A in Pinto's analysis did not perform nearly as poorly as loans in non-agency subprime or Alt-A securities. These differences suggest that grouping all of these loans together is misleading. In direct contrast to Pinto's claim, GSE mortgages with some riskier characteristics, such as high loan-to-value ratios, are not at all equivalent to those mortgages in securitizations labeled subprime and Alt-A by issuers. The performance data assembled and analyzed by the FCIC show that non-GSE securitized loans experienced much higher rates of delinquency than did the GSE loans with similar characteristics. In addition to examining loans owned and guaranteed by the GSEs, Pinto also commented on the role of the Community Reinvestment Act, or CRA, in causing the crisis, declaring, quote, "The pain and hardship that CRA has likely spawned are immeasurable," unquote. Contrary to this view, two Fed economists determined that lenders actually made few subprime loans to meet their CRA requirements. Analyzing a database of nearly 14 million loans originated in 2006, they found that only a small percentage of all higher-cost loans, as defined by the Home Mortgage Disclosure Act, had any connection to the CRA. These higher-cost loans serve as a rough proxy for subprime mortgages. Specifically, the study found that only 6% of such higher-cost loans were made to low or moderate-income borrowers or in low or moderate-income neighborhoods by banks and thrifts, and their subsidiaries and affiliates covered by the CRA. The other 94% of higher-cost loans either were made by CRA-covered institutions that did not receive CRA credit for these loans, or were made by lenders not covered by the CRA. Using other data sources, these economists also found that CRA-related subprime loans appeared to perform better than other subprime loans. Quote, "Taken together, the available evidence seems to run counter to the contention that the CRA contributed in any substantive way to the current crisis," unquote, they wrote. Subsequent research has come to similar conclusions. For example, two economists at the San Francisco Fed, using a different methodology and analyzing data on the California mortgage market, found that only 16% of loans made by CRA-covered lenders were located in low and moderate-income census tracts versus over 20% for independent mortgage companies not covered by the CRA. Further, fewer than 30% of the loans made by CRA lenders in low-income communities were higher priced, even at the peak of the market. In contrast, about one-half of the loans originated by independent mortgage companies in these communities were higher priced. And after accounting for characteristics of the loans and the borrowers, such as income and credit score, the authors found that loans made by CRA-covered lenders in the low and moderate-income areas they serve were half as likely to default as similar loans made by independent mortgage companies, which are not subject to CRA and are subject to less regulatory oversight in general. Quote, "While certainly not conclusive, this suggests that the CRA, and particularly its emphasis on loans made within a lender's assessment area, helped to ensure responsible lending, even during a period of overall declines in underwriting standards," unquote, they concluded. Overall, in 2004, 2005, and 2006, CRA-covered banks and thrifts accounted for at least 60% of all mortgage lending, but only between 36% and 41% of higher-priced mortgages. Independent mortgage companies originated less than one-third of all mortgages, but about one-half of all higher-priced mortgages. Finally, lending by non-bank affiliates of CRA-covered depository institutions is counted toward CRA performance at the discretion of the bank or thrift. These affiliates accounted for another roughly 10% of mortgage lending, but about 12% of high-price lending. Bank of America provided the FCIC with performance data on its CRA qualifying portfolio, which represented only 7% of the bank's mortgage portfolio. In the end of the first quarter of 2010, 8% of the bank's $212 billion portfolio of residential mortgages was non-performing. 21% of the $15 billion CRA qualifying portfolio was non-performing at that date. John Reed, a former CEO of Citigroup, when asked whether he thought government policies, such as the CRA, played a role in the crisis, said that he didn't believe banks would originate, quote, a bad mortgage because they thought the government policy allowed it, unquote, unless the bank could sell off the mortgage to Fannie or Freddie, which had their own obligations in this arena. He said, quote, it's hard for me to answer. If the reason the regulators didn't jump up and down and yell at the low-doc, no-doc subprime mortgage was because they felt that they, Congress, had sort of pushed in that direction, then I would say yes, unquote. Quote, CRA could be a pain in the neck, unquote, the banker Louis Ranieri told the FCIC. Quote, but you know what? In my view, it always did much more good than it did anything. We did a lot. CRA made a big difference in communities. You were really putting money in the communities in ways that really stabilized the communities and made a difference, unquote. But lenders, including Countrywide, used pro-home ownership policies as a smokescreen to do away with underwriting standards such as requiring down payments, he said. Quote, the danger is that it gives air cover to all this kind of madness that had nothing to do with the housing goal, unquote. End of section 62. Section 63 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 11, Rating Downgrades, Never Before. Prior to 2004, the ratings of mortgage-backed securities at Moody's were monitored by the same analysts who had rated them in the first place. In 2004, Nicholas Weil, Moody's chief credit officer and team managing director, was charged with creating an independent surveillance team to monitor previously rated deals. In November 2006, the surveillance team began to see a rise in early payment defaults in mortgages originated by Fremont Investment and Loan, and downgraded several securities with underlying Fremont loans, or put them on watch for future downgrades. Quote, this was a very unusual situation, as never before had we put on watch deals rated in the same calendar year, unquote, Weil later wrote to Raymond McDaniel, the chairman and CEO of Moody's Corporation, and Brian Clarkson, the president of Moody's Investors Service. In early 2007, a Moody's special report, overseen by Weil, about the sharp increases in early payment defaults stated that the foreclosures were concentrated in subprime mortgage pools. In addition, more than 2.75% of the subprime mortgages securitized in the second quarter of 2006 were 60 days delinquent within 6 months, more than double the rate a year earlier, or 1.25%. The exact cause of the trouble was still unclear to the ratings agency, though. Quote, Moody's is currently assessing whether this represents an overall worsening of collateral credit quality or merely a shifting forward of eventual defaults, which may not significantly impact a pool's overall expected loss, unquote. For the next few months, the company published regular updates about the subprime mortgage market. Over the next 3 months, Moody's took negative rating actions on 4.5% of the outstanding subprime mortgage securities rated Baa. Then, on July 10, 2007, in an unprecedented move, Moody's downgraded 399 subprime mortgage-backed securities that had been issued in 2006 and put an additional 32 securities on watch. The $5.2 billion of securities that were affected, all rated Baa and lower, made up 19% of the subprime securities that Moody's rated Baa in 2006. For the time being, there were no downgrades on higher-rated tranches. Moody's attributed the downgrades to, quote, aggressive underwriting combined with prolonged, slowing home price appreciation, unquote, and noted that about 60% of the securities affected contained mortgages from one of 4 originators: Fremont Investment and Loan, Long Beach Mortgage Company, New Century Mortgage Corporation, and WMC Mortgage Corp., while later told the FCIC staff that Moody's issued a mass announcement, rather than downgrading a few securities at a time, to avoid creating confusion in the market. A few days later, Standard & Poor's downgraded 498 similar tranches. These initial downgrades were remarkable, not only because of the number of securities involved, but also because of the sharp rating cuts, an average of 4 notches per security, when 1 or 2 notches was more routine. For example, a single notch would be a downgrade from AA to AA-. Among the tranches downgraded in July 2007 were the bottom 3 mezzanine tranches, M9, M10, and M11, of the Citigroup deal that we've been examining, CMLTI 2006-NC2. By that point, nearly 12% of the original loan pool had prepaid, but another 11% were 90 or more days past due or in foreclosure. Investors across the world were assessing their own exposure and guessing at that of others, however indirect, to these assets. A report from Bear Stearns Asset Management detailed its exposure. One of its CDOs, Tall Ships, had direct exposure to our sample deal, owning $8 million of the M7 and M8 tranches. BSAM's high-grade hedge fund also had exposure through a $10 million credit default swap position with Lehman, referencing the M8 tranche. And BSAM's enhanced leverage hedge fund owned parts of the equity in independent CDO, which, in turn, owned the M9 tranche of our sample deal. In addition, these funds had exposure through their holdings of other CDOs that, in turn, owned tranches of the Citigroup deal. Then, on October 11th, Moody's downgraded another 2,506 tranches, $33.4 billion of subprime mortgage-backed securities, and placed 577 tranches, or $23.8 billion, on watch for potential downgrade. Now, the total of the securities downgraded and put on watch represented 13.4% of the original dollar volume of all 2006 subprime mortgage-backed securities that Moody's had rated. Of the securities placed on watch in October, 48 tranches, or $6.9 billion, were originally AAA rated, and 529, $16.9 billion, were AA rated. All told, in the first 10 months of 2007, 92% of the mortgage-backed security deals issued in 2006 had at least one tranche downgraded or put on watch. By this point in October, 13% of the loans in our case study deal, CMLTI 2006-NC2, were seriously delinquent, and some homes had already been repossessed. The M4 through M8 tranches were downgraded as part of the second wave of mass downgrades. 5 additional tranches would eventually be downgraded in April 2008. Before it was over, Moody's would downgrade 83% of all the 2006 AAA mortgage-backed securities tranches and all of the BAA tranches. For those securities issued in the second half of 2007, nearly all AAA and BAA tranches were downgraded. Of all tranches initially rated investment grade, that is, rated Baa3 or higher, 76% of those issued in 2006 were downgraded to junk, as were 89% of those from 2007. End of section 63. Section 64 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 11, CDOs, Climbing the Wall of Subprime Worry. In March 2007, Moody's reported that CDOs with high concentrations of subprime mortgage-backed securities could incur severe downgrades. In an internal email sent 5 days after the report, Group Managing Director of U.S. Derivatives, Yuri Yoshizawa, explained to Moody's Chairman McDaniel and to Executive Vice President Noel Kiernan that one managing director at Credit Suisse First Boston, quote, sees banks like Merrill, Citi, and UBS still furiously doing transactions to clear out their warehouses. He believes that they are creating and pricing the CDOs in order to remove the assets from the warehouses, but that they are holding on to the CDOs in hopes that they will be able to sell them later, unquote. Several months later, in a review of the CDO market titled, quote, Climbing the Wall of Subprime Worry, unquote, Moody's noted, quote, some of the first quarter's activity in 2007 was the result of some arrangers feverishly working to clear inventory and reduce their balance sheet exposure to the subprime class, unquote. Even though Moody's was aware that the investment banks were dumping collateral out of the warehouses and into CDOs, possibly regardless of quality, the firm continued to rate new CDOs using existing assumptions. Former Moody's executive Richard Michaelek testified to the FCIC, quote, it was a case of, with respect to why we didn't stop and change our methodology, there was a very conservative culture at Moody's, at least while I was there, that suggested that the only thing worse than quickly getting a new methodology in place is quickly getting the wrong methodology in place and having to unwind that and to fail to consider the unintended consequences, unquote. In July, McDaniel gave a presentation to the board on the company's 2007 strategic plan. His slides had such bleak titles as Spotlight on Mortgages, Quality Continues to Erode, House Prices Are Falling, Mortgage Payment Resets Are Mounting, and 1.3 million mortgage defaults forecast 2007 to 08. Despite all the evidence that the quality of the underlying mortgages was declining, Moody's did not make any significant adjustments to its CDO ratings assumptions until late September. Out of $51 billion in CDOs that Moody's rated after its mass downgrade of subprime mortgage-backed securities on July 10, 2007, 88% were rated AAA. Moody's had hoped that rating downgrades could be staved off by mortgage modifications. If their monthly payments became more affordable, borrowers might stay current. However, in mid-September, Eric Kolchinsky, a team managing director for CDOs, learned that a survey of servicers indicated that very few troubled mortgages were being modified. Worried that continuing to rate CDOs without adjusting for known deterioration in the underlying securities could expose Moody's to liability, Kolchinsky advised Yoshizawa that the company should stop rating CDOs until the securities downgrades were completed. Kolchinsky told the FCIC that Yoshizawa admonished him for making the suggestion. By the end of 2008, more than 90% of all tranches of CDOs had been downgraded. Moody's downgraded nearly all of the 2006 AAA and all of the BAA CDO tranches. And again, the downgrades were large. More than 80% of AAA CDO bonds and more than 90% of BAA CDO bonds were eventually downgraded to junk. End of section 64. Section 65 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Legal remedies. On the basis of the information, the housing bust exposed the flaws in the mortgages that had been made and securitized. After the crisis unfolded, those with exposure to mortgages and structured products, including investors, financial firms, and private mortgage insurance firms, closely examined the representations and warranties made by the mortgage originators and securities issuers. When mortgages were securitized, sold, or insured, certain representations and warranties were made to assure investors and insurers that the mortgages met stated guidelines. As mortgage securities lost value, investors found significant deficiencies in the securitizer's due diligence on the mortgage pools underlying the mortgage-backed securities, as well as in their disclosure about the characteristics of those deals. As private mortgage insurance companies found similar deficiencies in the loans they insured, they have denied claims to an unprecedented extent. Fannie and Freddie acquired or guaranteed millions of loans each year. They delegated underwriting authority to originators subject to a legal agreement, representations and warranties, that the loans met specified criteria. They then checked samples of the loans to ensure that these representations and warranties were not breached. If there was a breach, and the loans were ineligible for purchase, the GSE had the right to require the seller to buy back the loan, assuming, of course, that the seller had not gone bankrupt. As a result of such sampling, during the 3 years and 8 months ending August 31, 2010, Freddie and Fannie required sellers to repurchase 167,000 loans, totaling $34.8 billion. So far, Freddie has received $9.1 billion from sellers, and Fannie has received $11.8 billion, a total of $20.9 billion. The amount put back is notable in that it represents 21% of $163 billion in credit-related expenses recorded by the GSEs since the beginning of 2008 through September 2010. In testing to ensure compliance with its standards, Freddie reviews a small percentage of performing loans and a high percentage of foreclosed loans, including well over 90% of all loans that default in the first 2 years. In total, Freddie reviewed $76.8 billion of loans out of $1.51 trillion in loans acquired or guaranteed, and found $21.7 billion to be ineligible, meaning they did not meet representations and warranties. Among the performing loans that were sampled, over time an increasing percentage were found to be ineligible, rising from 10% for mortgages originated in 2005 to 23% in 2008. Still, Freddie put back very few of these performing loans to the originators. Among mortgages originated from 2005 to 2008, it found that 17% of the delinquent loans were ineligible, as were 27% of the loans in foreclosure. Most of these were put back to originators, again in cases in which the originators were still in operation. Sometimes, if the reasons for ineligibility were sufficiently minor, the loans were not put back. Overall, of the delinquent loans and loans in foreclosure sampled by Freddie, 20% were put back. In 2009 and 2010, Freddie put back significant loan volumes to the following lenders: Countrywide, $1.9 billion; Wells Fargo, $1.2 billion; Chase Home Financial, $1.1 billion; Bank of America, $476 million; and Ally Financial, $453 million. Using a method similar to Freddie's to test for loan eligibility, Fannie reviewed between 2% and 5% of the mortgages originated since 2005, sampling at the higher rates for delinquent loans. From 2007 through 2010, Fannie put back loans to the following large lenders: Bank of America, $6.9 billion; Wells Fargo, $2.3 billion; J.P. Morgan Chase, $2.2 billion; Citigroup, $1.5 billion; SunTrust Bank, $898 million; and Ally Financial, $838 million. In early January 2011, Bank of America reached a deal with Fannie and Freddie, settling the GSE's claims with a payment of more than $2.5 billion. Like Fannie and Freddie, private mortgage insurance, or PMI companies, have been finding significant deficiencies in mortgages. They are refusing to pay claims on some insured mortgages that have gone into default. This insurance protects the holder of the mortgage if a homeowner defaults on a loan, even though the responsibility for the premiums generally lies with the homeowner. By the end of 2006, PMI companies had insured a total of $668 billion in potential mortgage losses. As defaults and losses on the insured mortgages have been increasing, the PMI companies have seen a spike in claims. As of October 2010, the 7 largest PMI companies, which share 98% of the market, had rejected about 25% of the claims, or $6 billion of $24 billion brought to them because of violations of origination guidelines, improper employment and income reporting, and issues with property valuation. Separate from their purchase and guarantee of mortgages, over the course of the housing boom, the GSEs purchased $690 billion of subprime and Alt-A private label securities. The GSEs have recorded $46 billion in charges on securities from January 1, 2008 to September 30, 2010. Frustrated with the lack of information from the securities servicers and trustees, in many cases large banks, on July 12, 2010, the GSEs, through their regulator, the Federal Housing Finance Agency, issued 64 subpoenas to various trustees and servicers in transactions in which the GSEs lost money. Where they find that the non-performing loans in the pools have violations, the GSEs intend to demand that the trustees recognize their rights, including any rights to put loans back to the originator or wholesaler. While this strategy being followed by the GSEs is based in contract law, other investors are relying on securities law to file lawsuits, claiming that they were misled by inaccurate or incomplete prospectuses, and, in a number of cases, they're winning. As of mid-2010, court actions embroiled almost all major loan originators and underwriters. There were more than 400 lawsuits related to breaches of representations and warranties, by one estimate. These lawsuits, filed in the wake of the financial crisis, include those alleging untrue statements of material fact or material misrepresentations in the registration statements and prospectuses provided to investors who purchased securities. They generally allege violations of the Securities Exchange Act of 1934 and the Securities Act of 1933. Both private and government entities have gone to court. For example, the investment brokerage Charles Schwab has sued units of Bank of America, Wells Fargo, and UBS Securities. The Massachusetts Attorney General's office settled charges against Morgan Stanley and Goldman Sachs after accusing the firms of inadequate disclosure related to their sales of mortgage-backed securities. Morgan Stanley agreed to pay $102 million, and Goldman Sachs agreed to pay $60 million. To take another example, the Federal Home Loan Bank of Chicago has sued several defendants, including Bank of America, Credit Suisse Securities, Citigroup, and Goldman Sachs, over its $3.3 billion investment in private mortgage-backed securities, claiming they failed to provide accurate information about the securities. Similarly, Cambridge Place Investment Management has sued units of Morgan Stanley, Citigroup, HSBC, Goldman Sachs, Barclays, and Bank of America, among others, quote, on the basis of the information contained in the applicable registration statement, prospectus, and prospective supplements, unquote. End of section 65. Section 66 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Losses. Who owns residential credit risk? Through 2007 and into 2008, as the rating agencies downgraded mortgage-backed securities and CDOs, and investors began to panic, market prices for these securities plunged. Both the direct losses, as well as the market-wide contagion and panic that ensued, would lead to the failure or near failure of many large financial firms across the system. The drop in market prices for mortgage-related securities reflected the higher probability that the underlying mortgages would actually default, meaning that less cash would flow to the investors, as well as the more generalized fear among investors that this market had become illiquid. Investors valued liquidity because they wanted the assurance that they could sell securities quickly to raise cash if necessary. Potential investors worried they might get stuck holding these securities as market participants looked to limit their exposure to the collapsing mortgage market. As market prices dropped, mark-to-market accounting rules required firms to write down their holdings to reflect the lower market prices. In the first quarter of 2007, the largest banks and investment banks began complying with a new accounting rule, and for the first time, reported their assets in one of three valuation categories: Level 1 assets, which had observable market prices like stocks on the stock exchange; Level 2 assets, which were not as easily priced because they were not actively traded; and Level 3 assets, which were illiquid and had no discernible market prices or other inputs. To determine the value of Level 3, and in some cases Level 2 assets where market prices were unavailable, firms used models that relied on assumptions. Many financial institutions reported Level 3 assets that substantially exceeded their capital. For example, for the first quarter of 2007, Bear Stearns reported about $19 billion in Level 3 assets compared to $13 billion in capital. Morgan Stanley reported about $60 billion in Level 3 assets against capital of $38 billion, and Goldman reported about $48 billion and capital of $37 billion. Mark-to-market write-downs were required on many securities, even if there were no actual realized losses, and in some cases, even if the firms did not intend to sell the securities. The charges reflecting unrealized losses were based, in part, on credit rating agencies and investors' expectations that the mortgages would default. But only when those defaults came to pass would holders of the securities actually have realized losses. Determining the market value of securities that did not trade was difficult, was subjective, and became a contentious issue during the crisis. Why? Because the write-downs reduced earnings and capital and triggered collateral calls. These mark-to-market accounting rules received a good deal of criticism in recent years, as firms argued that the lower market prices did not reflect market values, but rather fire sale prices driven by forced sales. Joseph Grundfest, when he was a member of the SEC's Committee on Improvements to Financial Reporting, noted that at times, marking securities at market prices, quote, creates situations where you have to go out and raise physical capital in order to cover losses that, as a practical matter, were never really there, unquote. But not valuing assets based on market prices could mean that firms were not recording losses required by the accounting rules, and therefore were overstating earnings and capital. As the mortgage market was crashing, some economists and analysts estimated that actual losses, also known as realized losses, on subprime and Alt-A mortgages would total $200 to $300 billion. So far, by 2010, the figure has turned out not to be much more than that. As of year-end 2009, the dollar value of all impaired Alt-A and subprime mortgage-backed securities total about $300 billion. Securities are impaired when they have suffered realized losses or are expected to suffer realized losses imminently. While those numbers are small in relation to the $14 trillion U.S. economy, the losses had a disproportionate impact. Quote, subprime mortgages themselves are a pretty small asset class, unquote, Fed Chairman Ben Bernanke told the FCIC, explaining how in 2007 he and Treasury Secretary Henry Paulson had underestimated the repercussions of the emerging housing crisis. Quote, the stock market goes up and down every day, more than the entire value of the subprime mortgages in the country. But what created the contagion, or one of the things that created the contagion, was that the subprime mortgages were entangled in these huge securitized pools, unquote. The large drop in market prices of the mortgage securities had large spillover effects to the financial sector for a number of reasons. For example, as just discussed, when the prices of mortgage-backed securities and CDOs fell, many of the holders of those securities marked down the value of their holdings before they had experienced any actual losses. In addition, rather than spreading the risk of losses among many investors, the securitization market had concentrated them. Who owns residential credit risk? Two Lehman analysts asked in a September 2007 report. The answer? 3/4 of subprime and Alt-A mortgages had been securitized, and, quote, much of the risk in these securitizations is in the investment-grade securities and has been almost entirely transferred to AAA collateralized debt obligation or CDO holders, unquote. A set of large, systemically important firms with significant holdings or exposure to these securities would be found to be holding very little capital to protect against potential losses. And most of those companies would turn out to be considered by the authorities too big to fail in the midst of a financial crisis. The International Monetary Fund's Global Financial Stability Report, published in October 2008, examined where the declining assets were held and estimated how severe the write-downs would be. All told, the IMF calculated that roughly $10 trillion in mortgage assets were held throughout the financial system. Of these, $3.8 trillion were GSE mortgage-backed securities. The IMF expected losses of $80 billion, but investors holding these securities would lose no money because of the GSE's guarantee. Another $4.7 trillion in mortgage assets were estimated to be prime and non-prime mortgages held largely by the banks and the GSEs. These were expected to suffer as much as $170 billion in write-downs due to declines in market value. The remaining $1.5 trillion in assets were estimated to be mortgage-backed securities and CDOs. Write-downs on those assets were expected to be $500 billion. And even more troubling, more than one-half of these losses were expected to be borne by the investment banks, commercial banks, and thrifts. The rest of the write-downs from non-agency mortgage-backed securities were shared among institutions such as insurance companies, pension funds, the GSEs, and hedge funds. The October report also expected another $655 billion in write-downs on commercial mortgage-backed securities, CLOs, leveraged loans, and other loans and securities, with more than half coming from commercial mortgage-backed securities. Again, the commercial banks and thrifts and investment banks were expected to bear much of the brunt. Furthermore, when the crisis began, uncertainty, suggested by the sizable revisions in the IMF estimates, and leverage would promote contagion. Investors would realize they did not know as much as they wanted to know about the mortgage assets that banks, investment banks, and other firms held, or to which they were exposed. To an extent not understood by many before the crisis, financial institutions had leveraged themselves with commercial paper, with derivatives, and in the short-term repo markets, in part by using mortgage-backed securities and CDOs as collateral. Lenders would question the value of the assets that those companies had posted as collateral, at the same time that they were questioning the value of those companies' balance sheets. Even the highest-rated tranches of mortgage-backed securities were downgraded, and large write-downs were recorded on financial institutions' balance sheets based on declines in market value. However, although this could not be known in 2007, at the end of 2010, most of the AAA tranches of mortgage-backed securities have avoided actual losses in cash flow through 2010 and may avoid significant realized losses going forward. Overall, for 2005 to 2007 vintage tranches of mortgage-backed securities, originally rated AAA, despite the mass downgrades, only about 10% of Alt-A and 4% of subprime securities had been materially impaired, meaning that losses were imminent or had already been suffered by the end of 2009. See Figure 11.4. Figure 11.4 is titled Impaired Securities and bears this legend: Impairment of 2005 to 2007 vintage mortgage-backed securities, or MBS, and CDOs as of year-end 2009 by initial rating. A security is impaired when it is downgraded to C or CA, or when it suffers a principal loss. Figure 11.4 may be seen on page 229 of the printed report. Returning to the text. For the lower-rated BAA tranches, 96.5% of Alt-A and 95.5% of subprime securities were impaired. In all, by the end of 2009, $320 billion worth of subprime and Alt-A tranches had been materially impaired, including $132.6 billion originally rated AAA. The outcome would be far worse for CDO investors, whose fate largely depended on the performance of lower-rated mortgage-backed securities. More than 90% of BAA CDO bonds and 71.3% of AAA CDO bonds were ultimately impaired. The housing bust would not be the end of the story. As Chairman Bernanke testified to the FCIC, quote, "What I did not recognize was the extent to which the system had flaws and weaknesses in it that were going to amplify the initial shock from subprime and make it into a much bigger crisis," unquote. End of section 66. Section 67 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Commission conclusions on Chapter 11. The Commission concludes that the collapse of the housing bubble began the chain of events that led to the financial crisis. High leverage, inadequate capital, and short-term funding made many financial institutions extraordinarily vulnerable to the downturn in the market in 2007. The investment banks had leverage ratios, by one measure, of up to 40 to 1. This means that for every $40 of assets, they held only $1 of capital. Fannie Mae and Freddie Mac, the GSEs, had even greater leverage, with a combined 75 to 1 ratio. Leverage or capital inadequacy at many institutions was even greater than reported when one takes into account window dressing, off-balance sheet exposures such as those of Citigroup, and derivatives positions such as those of AIG. The GSEs contributed to, but were not a primary cause of, the financial crisis. Their $5 trillion mortgage exposure and market position were significant, and they were, without question, dramatic failures. They participated in the expansion of risky mortgage lending and declining mortgage standards, adding significant demand for less than prime loans. However, they followed, rather than led, the Wall Street firms. The delinquency rates on the loans that they purchased or guaranteed were significantly lower than those purchased and securitized by other financial institutions. The Community Reinvestment Act, or CRA, which requires regulated banks and thrifts to lend, invest, and provide services consistent with safety and soundness to the areas where they take deposits, was not a significant factor in subprime lending. However, community lending commitments not required by the CRA were clearly used by the lending institutions for public relations purposes. End of Section 67, end of Chapter 11. Section 68 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 12, Early 2007, Spreading Subprime Worries. Over the course of 2007, and the abrupt shutdown of subprime lending led to losses for many financial institutions, runs on money market funds, tighter credit, and higher interest rates. Unemployment remained relatively steady, hovering just below 4.5% until the end of the year, and oil prices rose dramatically. By the end of 2007, home prices had declined almost 4% from their peak in 2006. Early evidence of the coming storm was the 1.5% drop in November 2006 of the ABX index, a Dow Jones-like index for credit default swaps on BBB tranches of mortgage-backed securities issued in the first half of 2006. That drop came after Moody's and S&P put on negative watch selected tranches in one deal backed by mortgages from one originator, Fremont Investment and Loan. In December, the same index fell another 3% after the mortgage companies Own It Mortgage Solutions and Sebring Capital ceased operations. Senior risk officers of the 5 largest investment banks told the Securities and Exchange Commission that they expected to see further subprime lender failures in 2007. Quote, "There's a broad recognition that, with the refinancing and real estate booms over, the business model of many of the smaller subprime originators is no longer viable," unquote, SEC analysts told Director Eric Seary in a January 4, 2007 memorandum. That became more and more evident. In January, Mortgage Lenders Network announced it had stopped funding mortgages and accepting applications. In February, New Century reported bigger than expected mortgage credit losses, and HSBC, the largest subprime lender in the United States, announced a $1.8 billion increase in its quarterly provision for losses. In March, Fremont stopped originating subprime loans after receiving a cease and desist order from the Federal Deposit Insurance Corporation. In April, New Century filed for bankruptcy. These institutions had relied for their operating cash on short-term funding through commercial paper and the repo market. But commercial paper buyers and banks became unwilling to continue funding them, and repo lenders became less and less willing to accept subprime and Alt-A mortgages or mortgage-backed securities as collateral. They also insisted on ever shorter maturities, eventually of just 1 day, an inherently destabilizing demand, because it gave them the option of withholding funding on short notice if they lost confidence in the borrower. Another sign of problems in the market came when financial companies began to report more detail about their assets under the new mark-to-market accounting rule, particularly about mortgage-related securities that were becoming illiquid and hard to value. The sum of more illiquid Level 2 and 3 assets at these firms was, quote, eye-popping in terms of the amount of leverage the banks and investment banks had, unquote, according to Jim Chanos, a New York hedge fund manager. Chanos said that the new disclosures also revealed for the first time that many firms retained large exposures from securitizations. Quote, you clearly didn't get the magnitude, and the market didn't grasp the magnitude until spring of '07, when the figures began to be published. And then it was as if someone rang a bell, because almost immediately upon the publication of these numbers, journalists began writing about it, and hedge funds began talking about it, and people began speaking about it in the marketplace, unquote. In late 2006 and early 2007, some banks moved to reduce their subprime exposures by selling assets and buying protection through credit default swaps. Some, such as Citigroup and Merrill Lynch, reduced mortgage exposure in some areas of the firm, but increased it in others. Banks that had been busy for nearly 4 years creating and selling subprime-backed collateralized debt obligations, or CDOs, scrambled in about that many months to sell or hedge whatever they could. They now dumped these products into some of the most ill-fated CDOs ever engineered. Citigroup, Merrill Lynch, and UBS particularly were forced to retain larger and larger quantities of the super senior tranches of these CDOs. The bankers could always hope, and many apparently even believed, that all would turn out well with these super seniors, which were, in theory, the safest of all. With such uncertainty about the market value of mortgage assets, trades became scarce, and setting prices for these instruments became difficult. Although government officials knew about the deterioration in the subprime markets, they misjudged the risks posed to the financial system. In January 2007, SEC officials noted that investment banks had credit exposure to struggling subprime lenders, but argued that, quote, none of these exposures are material, unquote. The Treasury and Fed insisted throughout the spring and early summer that the damage would be limited. Quote, the impact on the broader economy and financial markets of the problems in the subprime market seem likely to be contained, unquote. Fed Chairman Ben Bernanke testified before the Joint Economic Committee of Congress on March 28th. That same day, Treasury Secretary Henry Paulson told a House Appropriations Subcommittee, quote, from the standpoint of the overall economy, my bottom line is we're watching it closely, but it appears to be contained, unquote. End of section 68. Section 69 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 12, Section Goldman, Let's Be Aggressive Distributing Things. In December 2006, following the initial decline in ABX BBB indices, and after 10 consecutive days of trading losses on its mortgage desk, executives at Goldman Sachs decided to reduce the firm's subprime exposure. Goldman marked down the value of its mortgage-related products to reflect the lower ABX prices and began posting daily losses for this inventory. Responding to the volatility in the subprime market, Goldman analysts delivered an internal report on December 13, 2006, regarding, quote, the major risk in the mortgage business, unquote, to Chief Financial Officer David Viniar and Chief Risk Officer Craig Broderick. The next day, executives determined that they would get, quote, closer to home, unquote, meaning that they wanted to reduce their mortgage exposure, sell what could be sold as is, repackage and sell everything else. Kevin Gazvoda, the managing director for Goldman's fixed income, currency, and commodities business line, instructed the sales team to sell asset-backed security and CDO positions even at a loss, quote, please refocus on retained new issue bond positions and move them out. There will be big opportunities the next several months, and we don't want to be hamstrung based on old inventory. Refocus efforts and move stuff out, even if you have to take a small loss, unquote. In a December 15th email, Viniar described the strategy to Tom Montag, the co-head of Global Securities, quote, on ABX, the position is reasonably sensible, but it's just too big. Might have to spend a little to size it appropriately. On everything else, my basic message was let's be aggressive distributing things, because there will be very good opportunities as the market goes into what is likely to be even greater distress, and we want to be in position to take advantage of them, unquote. Subsequent emails suggest that the, quote, everything else meant mortgage-related assets. On December 20th, in an internal email with broad distribution, Goldman's Stacy Bash-Pauley, a partner and the co-head of fixed income sales, noted that the firm, unlike others, had been able to find buyers for the super senior and equity tranches of CDOs, but the mezzanine tranches remained a challenge. The best target, she said, would be to put them in other CDOs. Quote, we've been thinking collectively as a group about how to help move some of the risk. While we've made great progress moving the tail risks, super senior and equity, we think it's critical to focus on the mezz risk that has been built up over the past few months. Given some of the feedback we've received so far from investors, it seems that CDOs might be the best target for moving some of this risk, but clearly in limited size and timing right now not ideal, unquote. It was becoming harder to find buyers for these securities. Back in October, Goldman Sachs traders had complained that they were being asked to, quote, distribute junk that nobody was dumb enough to take the first time around, unquote. Despite the first of Goldman's business principles, that, quote, our clients' interests always come first, unquote, documents indicate that the firm targeted less sophisticated customers in its efforts to reduce subprime exposure. In a December 28th email discussing a list of customers to target for the year, Goldman's Fabrice Touré, then a vice president on the structured product correlation trading desk, said to, quote, focus efforts on buy and hold rating-based buyers, unquote, rather than sophisticated hedge funds that, quote, will be on the same side of the trade as we will, unquote. The same side of the trade as Goldman was the selling or shorting side, those who expected the mortgage market to continue to decline. In January, Daniel Sparks, the head of Goldman's mortgage department, extolled Goldman's success in reducing its subprime inventory, writing that the team had, quote, structured like mad and traveled the world and worked their tails off to make some lemonade from some big old lemons, unquote. Touré acknowledged that there were, quote, more and more leverage in the system, and, writing of himself in the third person, said he was, quote, standing in middle of all these complex, highly levered, exotic trades he created without necessarily understanding all the implications of those monstrosities, unquote. On February 11th, Goldman CEO Lloyd Blankfein questioned Montag about the $20 million in losses on residual positions from old deals, asking, quote, "Could or should we have cleaned up these books before? And are we doing enough right now to sell off cats and dogs in other books throughout the division?" Unquote. The numbers suggest that the answer was yes. They had cleaned up pretty well, even given a $20 million write-off and billions of dollars of subprime exposure still retained. In the first quarter of 2007, its mortgage business earned a record $266 million, driven primarily by short positions, including a $10 billion short position on the bellwether ABX BBB index, whose drop the previous November had been the red flag that got Goldman's attention. In the following months, Goldman reduced its own mortgage risk while continuing to create and sell mortgage-related products to its clients. From December 2006 through August 2007, it created and sold approximately $25.4 billion of CDOs, including $17.6 billion of synthetic CDOs. The firm used the cash CDOs to unload much of its own remaining inventory of other CDO securities and mortgage-backed securities. Goldman had been criticized and sued for selling its subprime mortgage securities to clients while simultaneously betting against those securities. Sylvan Raines, a structured finance expert at R&R Consulting in New York, reportedly called Goldman's practice, quote, "the most cynical use of credit information that I have ever seen," unquote, and compared it to, quote, "buying fire insurance on someone else's house and then committing arson," unquote. During an FCIC hearing, Goldman CEO Lloyd Blankfein was asked if he believed it was a proper legal or ethical practice for Goldman to sell clients mortgage securities that Goldman believed would default, while simultaneously shorting them. Blankfein responded, quote, "I do think that the behavior is improper, and we regret the result. The consequence is that people have lost money," unquote. The next day, Goldman issued a press release declaring Blankfein did not state that Goldman's, quote, "practices with respect to the sale of mortgage-related securities were improper." Blankfein was responding to a lengthy series of statements followed by a question that was predicated on the assumption that a firm was selling a product that it thought was going to default. Mr. Blankfein agreed that if such an assumption was true, the practice would be improper. Mr. Blankfein does not believe, nor did he say, that Goldman Sachs had behaved improperly in any way, unquote. In addition, Goldman President and Chief Operating Officer Gary Cohn testified, quote, "During the 2 years of the financial crisis, Goldman Sachs lost $1.2 billion in its residential mortgage-related business. We did not bet against our clients, and these numbers underscore that fact," unquote. Indeed, Goldman's short position was not the whole story. The daily mortgage value at risk measure, or VAR, which tracked potential losses if the market moved unexpectedly, increased in the 3 months through February. By February, Goldman's company-wide VAR reached an all-time high, according to SEC reports. The dominant driver of the increase was the one-sided bet on the mortgage markets continuing to decline. Preferring to be relatively neutral, between March and May, the Mortgage Securities Desk reduced its short position on the ABX index. Between June and August, it again reversed course, increasing its short position by purchasing protection on mortgage-related assets. The Basis Yield Alpha Fund, a hedge fund and Goldman client, that claims to have invested $11.25 million in Goldman's Timberwolf CDO, sued Goldman for fraud in 2010. The Timberwolf deal was heavily criticized by Senator Carl Levin and other members of the Permanent Subcommittee on Investigations during an April 2010 hearing. The Basis Yield Alpha Fund alleged that Goldman designed Timberwolf to quickly fail so that Goldman could offload low-quality assets and profit from betting against the CDO. Within 2 weeks of the fund's investment, Goldman began making margin calls on the deal. By the end of July 2007, it had demanded more than $35 million. According to the hedge fund, Goldman's demands forced it into bankruptcy in August 2007. Goldman received about $40 million from the liquidation. Goldman denies basis yield alpha fund's claims, and CEO Blankfein dismissed the notion that Goldman misled investors. Quote, "I will tell you, we only dealt with people who knew what they were buying. And of course, when you look after the fact, someone's going to come along and say they really didn't know," unquote, he told the FCIC. In addition to selling its subprime securities to customers, the firm took short positions using credit default swaps. It also took short positions on the ABX indices and some of the financial firms with which it did business. Like every market participant, Goldman marked or valued its securities after considering both actual market trades and surveys of how other institutions valued the assets. As the crisis unfolded, Goldman marked mortgage-related securities at prices that were significantly lower than those of other companies. Goldman knew that those lower marks might hurt those other companies, including some clients, because they could require marking down those assets and similar assets. In addition, Goldman's marks would get picked up by competitors in dealer surveys. As a result, Goldman's marks could contribute to other companies recording mark-to-market losses. That is, the reported value of their assets could fall, and their earnings would decline. The markdowns of these assets could also require that companies reduce their repo borrowings or post additional collateral to counterparties to whom they had sold credit default swap protection. In a May 11th email, Craig Broderick, who, as Goldman's chief risk officer, was responsible for tracking how much of the company's money was at risk, noted to colleagues that the mortgage group was, quote, "in the process of considering making significant downward adjustments to the marks on their mortgage portfolio, especially CDOs and CDO squared. This will potentially have a big profit and loss impact on us, but also to our clients, due to the marks and associated margin calls on repos, derivatives, and other products. We need to survey our clients and take a shot at determining the most vulnerable clients, knock-on implications, etc. This is getting lots of 30th floor attention right now," unquote. Broderick was right about the impact of Goldman's marks on clients and counterparties. The first significant dispute about these marks began in May 2007. It concerned the two high-flying, mortgage-focused hedge funds run by Bear Stearns Asset Management, or BSAM. End of section 69. Section 70 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 12, Bear Stearns' Hedge Funds. Looks pretty damn ugly. In 2003, Ralph Chaffee and Andrew Tannen, who had structured CDOs at Bear Stearns, were busy managing BSAM's high-grade structured credit strategies fund. When they added the higher leveraged, higher risk enhanced fund in 2006, they became even busier. By April 2007, internal BSAM risk exposure reports showed about 60% of the high-grade fund's collateral to be subprime mortgage-backed CDOs, assets that were beginning to lose market value. In a diary kept in his personal email account because he, quote, didn't want to use his work email anymore, unquote, Tannen recounted that in 2006, a wave of fear set over him when he realized that the enhanced fund was going to subject investors to blow-up risk and, quote, we could not run the leverage as high as I thought we could, unquote. This blow-up risk, coupled with bad timing, proved fatal for the enhanced fund. Shortly after the fund opened, the ABX BBB- index started to falter, falling 4% in the last 3 months of 2006, then another 8% in January and 25% in February. The market's confidence fell with the ABX. Investors began to bail out of both enhanced and high grade. Chaffee and Tannen stepped up their marketing. On March 7, 2007, Tannen said in an email to investors, quote, "We see an opportunity here. Not crazy opportunity, but prudent opportunity. I am putting in additional capital. I think you should as well," unquote. On a March 12th conference call, Tannen and Chaffee assured investors that both funds have plenty of liquidity, and they continued to use the investment of their own money as evidence of their confidence. Tannen even said he was increasing his personal investment, although, according to the SEC, he never did. Despite their avowals of confidence, Chaffee and Tannen were in full red alert mode. In April, Chaffee redeemed $2 million of his own $6.1 million investment in enhanced leverage and transferred the funds to a third hedge fund he managed. They tried to sell the toxic CDO securities held by the hedge funds. They had little success selling them directly on the market. But there was another way. In late May, BSAM put together a CDO squared deal that would take $4 billion of CDO assets off the hedge fund's books. The senior-most tranches, worth $3.2 billion, were sold as commercial paper to short-term investors, such as money market mutual funds. Critically, Bank of America guaranteed those deals with a liquidity put for a fee. Later, commercial paper investors would refuse to roll over this particular paper. Bank of America ultimately lost more than $4 billion on this arrangement. 19% is doomsday. Nearly all hedge funds provide their investors with market value reports, at least monthly, based on computed mark-to-market prices for the fund's various investments. Industry standards generally called for valuing readily traded assets, such as stocks, at the current trading price, while assets in very slow markets were marked by surveying price quotes from other dealers, factoring in other pricing information, and then arriving at a final net asset value. For mortgage-backed investments, marking assets was an extremely important exercise because the market values were used to inform investors and to calculate the hedge fund's total fund value for internal risk management purposes, and because these assets were held as collateral for repo and other lenders. Crucially, if the value of a hedge fund's portfolio declined, repo and other lenders might require more collateral. In April, J.P. Morgan told Alan Schwartz, Bear Kearns' co-president, that the bank would be asking the BSAM hedge funds to post additional collateral to support its repo borrowing. Dealer marks were slow to keep up with movements in the ABX indices. Even as the ABX BBB index recovered some in March, rebounding 6%, marks by brokerage dealers finally started to reflect the lower values. On April 2, 2007, Goldman sent Bear Stearns marks ranging from 65 cents to 100 cents on the dollar, meaning that some securities were worth as little as 65% of their initial value. On Thursday, April 19th, in preparation for an investor call the following week, BSAM analysts informed Chaffee and Tannen that, in their view, the value of the fund's portfolios had declined sharply. On Sunday, Tannen sent an email from his personal account to Chaffee's personal account, arguing that both hedge funds should be closed and liquidated. Quote, "Looks pretty damn ugly. If we believe the runs the analyst has been doing are anywhere close to accurate, I think we should close the funds now. If the runs are correct, then the entire subprime market is toast," unquote. But by the following Wednesday, Chaffee and Tannen were back on the same upbeat page. At the beginning of the conference call, Tannen told investors, quote, The key sort of big picture point for us at this point is our confidence that the structured credit market, and the subprime market in particular, has not systemically broken down. We're very comfortable with exactly where we are, unquote. Chaffee also assured investors that the funds would likely finish the year with positive returns. On May 1, 2007, the two hedge funds had attracted more than $60 million in new funds, but more than $28 million was redeemed by investors. That same day, Goldman sent BSAM marks ranging from 55 cents to 100 cents on the dollar. Chaffee disputed Goldman's marks, as well as marks from Lehman, Citigroup, and J.P. Morgan. On May 16th, in a preliminary estimate, Chaffee told investors that the net asset value of the enhanced leverage fund was down 6.6% in April. In computing the final numbers later that month, he requested that BSAM's pricing committee instead use fair value marks based on his team's modeling, which implied losses that were $25 to $50 million less than losses using Goldman's marks. On June 4th, although Goldman's marks were considered low, the pricing committee decided to continue to average dealer marks rather than to use fair value. The committee also noted that the decline in net asset value would be greater than the 6.6% estimate because, quote, many of the positions that were marked down received dealer marks after release of the estimate, unquote. The decline was revised from 6.6% to 19%. According to Chaffee, a number of factors contributed to the April revision, and Goldman's marks were one factor. After these meetings, Chaffee emailed one committee member, quote, "There is no market. It's all academic anyway. 19% is doomsday," unquote. On June 7th, BSAM announced the 19% drop and froze redemptions. Canary in the mine shaft. When J.P. Morgan contacted Bear's co-president, Alan Schwartz, in April about its upcoming margin call, Schwartz convened an executive committee meeting to discuss how repo lenders were marking down positions and making margin calls on the basis of those new marks. In early June, Bear met with BSAM's repo lenders to explain that BSAM lacked cash to meet margin calls and to negotiate a 60-day reprieve. Some of these very same firms had sold, enhanced, and high-grade some of the same CDOs and other securities that were turning out to be such bad assets. Now all 10 refused Schwartz's appeal. Instead, they made margin calls. As a direct result, the two funds had to sell collateral at distressed prices to raise cash. Selling the bonds led to a complete loss of confidence by the investors, whose requests for redemptions accelerated. Shortly after BSAM froze redemptions, Merrill Lynch seized more than $850 million of its collateral posted by Bear for its outstanding repo loans. Merrill was able to sell just $181 million of the seized collateral at auction by July 5th, and at discounts to its face value. Other repo lenders were increasing their collateral requirements or refusing to roll over their loans. This run on both hedge funds left both BSAM and Bear Stearns with limited options. Although it owned the asset management business, Bear's equity positions in the two BSAM hedge funds were relatively small. On April 26th, Bear's co-president, Warren Spector, approved a $25 million investment into the enhanced leverage fund. Bear Stearns had no legal obligation to rescue either the funds or their repo lenders. However, those lenders were the same large investment banks that Bear Stearns dealt with every day. Moreover, any failure of entities related to Bear Stearns could raise investors' concerns about the firm itself. Thomas Marano, the head of the mortgage trading desk, told FCIC staff that the constant barrage of margin calls had created chaos at Bear. In late June, Bear Stearns dispatched him to engineer a solution with Richard Marin, BSAM CEO. Marano now worked to understand the portfolio. including what it might be worth in a worst-case scenario when significant amounts of assets had to be sold. Bear Stearns' conclusion? High grade still had positive value, but enhanced leverage did not. On the basis of that analysis, Bear Stearns committed up to $3.2 billion and ultimately loaned $1.6 billion to take out the high-grade fund repo lenders and became the sole repo lender to the fund. Enhanced leverage was on its own. During a June Federal Open Market Committee, or FMOC, meeting, members were informed about the subprime market and the BSAM hedge funds. The staff reported that the subprime market was, quote, very unsettled and reflected deteriorating fundamentals in the housing market, unquote. The liquidation of subprime securities at the two BSAM hedge funds was compared to the troubles faced by long-term capital management in 1998. Chairman Bernanke noted that the problems the hedge funds experienced were a good example of how leverage can increase liquidity risk, especially in situations in which counterparties were not willing to give them time to liquidate and possibly realize whatever value might be in the positions. But it was also noted that the BSAM hedge funds appeared to be, quote, relatively unique among sponsored funds in their concentration in subprime mortgages. Some members were concerned about the lack of transparency around hedge funds, the consequent lack of market discipline on valuations of hedge fund holdings, and the fact that the Federal Reserve could not systematically collect information from hedge funds because they were outside its jurisdiction. These facts caused members to be concerned about whether they understood the scope of the problem. During the same meeting, FMOC members noted that the size of the credit derivatives market, its lack of transparency, and activities related to subprime debt could be a gathering cloud in the background of policy. Meanwhile, Bear Stearns executives who supported the high-grade bailout did not expect to lose money. However, that support was not universal. CEO James Kane and Earl Heaton, the former senior managing director of Bear Stearns and BSAM, were opposed because they did not want to increase shareholders' potential losses. Their fears proved accurate. By July, the two hedge funds had shrunk to almost nothing. High-grade fund was down 91%. Enhanced leverage fund, 100%. By July 31st, both had filed for bankruptcy. Chaffee and Tannen would be criminally charged with fraud in their communications with investors, but they were acquitted of all charges in November 2009. Civil charges brought by the SEC were still pending as of the date of this report. Looking back, Morano told the FCIC, quote, "We caught a lot of flack for allowing the funds to fail, but we had no option," unquote. In an internal email in June, Bill Jamieson of Federated Investors, one of the largest of all mutual fund companies, referred to the Bear Stearns hedge fund as the, quote, "canary in the mine shaft," unquote, and predicted more market turmoil. As the two funds were collapsing, repo lending tightened across the board. Many repo lenders sharpened their focus on the valuation of any collateral with potential subprime exposure and on the relative exposures of different financial institutions. They required increased margins on loans to institutions that appeared to be exposed to the mortgage market. They often required Treasury securities as collateral. In many cases, they demanded shorter lending terms. Clearly, the AAA-rated mortgage-backed securities and CDOs were not considered the super-safe investments in which investors and some dealers had only recently believed. Kane called Specter into the office and asked him to resign. On Sunday, April 5th, Specter submitted his resignation to the board. End of Section 70. Section 71 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Rating agencies. It can't be, all of a sudden. While BSAM was wrestling with its two ailing flagship hedge funds, the major credit rating agencies finally admitted that subprime mortgage-backed securities would not perform as advertised. On July 10, 2007, they issued comprehensive rating downgrades and credit watch warnings on an array of residential mortgage-backed securities. These announcements foreshadowed the actual losses to come. S&P announced that it had placed 612 tranches backed by U.S. subprime collateral, or some $7.35 billion in securities, on negative watch. S&P promised to review every deal in its ratings database for adverse effects. In the afternoon, Moody's downgraded 399 mortgage-backed securities issued in 2006, backed by U.S. subprime collateral, and put an additional 32 tranches on watch. These Moody's downgrades affected about $5.2 billion in securities. The following day, Moody's placed 184 tranches of CDOs, with an original face value of about $5 billion, on watch for possible downgrade. 2 days after its original announcement, S&P downgraded 498 of the 612 tranches it had placed on negative watch. Fitch Ratings, the smallest of the three major credit rating agencies, announced similar downgrades. These actions were meaningful for all who understood their implications. While the specific securities downgraded were only a small fraction of the universe, less than 2% of mortgage-backed securities issued in 2006, investors knew that more downgrades might come. Many investors were critical of the rating agencies, lambasting them for their belated reactions. By July 2007, by one measure, housing prices had already fallen about 4% nationally from their peak in the spring of 2006. On a July 10th conference call with S&P, the hedge fund manager, Steve Eisman, questioned Tom Warwick, the managing director of S&P's Residential Mortgage-Backed Securities Group. Eisman asked, quote, "I'd like to know why now. I mean, the news has been out on subprime now for many months. The delinquencies have been a disaster now for many months. Your ratings have been called into question now for many months. I'd like to understand why you're making this move today and why didn't you do this many months ago? I mean, it can't be that all of a sudden the performance has reached a level where you woken up." Unquote. Warwick responded that S&P took action as soon as possible, given the information at hand. Unquote. The rating agency's downgrades, in tandem with the problems at Bear Stearns' hedge funds, had a further chilling effect on the markets. The ABX BBB- index fell another 33% in July, confirming and guaranteeing even more problems for holders of mortgage securities. Enacting the same inexorable dynamic that had taken down the Bear Stearns funds, repo lenders increasingly required other borrowers that had put up mortgage-backed securities as collateral to put up more, because their value was unclear or depressed. Many of these borrowers sold assets to meet these margin calls, and each sale had the potential to further depress prices. If at all possible, the borrowers sold other assets in more liquid markets for which prices were readily available, pushing prices downward in those markets too. End of section 71. Section 72 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. AIG, well bigger than we ever planned for. Of all the possible losers in the looming rout, AIG should have been among the most concerned. After several years of aggressive growth, AIG's financial products subsidiary had written $79 billion in over-the-counter credit default swap, or CDS, protection on super senior tranches of multi-sector CDOs, backed mostly by subprime mortgages. In a phone call made July 11th, the day after the downgrades, Andrew Forster, the head of credit trading at AIG Financial Products, told Alan Frost, the executive vice president of Financial Products Marketing Group, that he had to analyze exposures because, quote, every effin' rating agency we've spoken to came out with more downgrades, and that he was increasingly concerned. Quote, about a month ago, I was like, suicidal. The problem that we're going to face is that we're going to have just enormous downgrades on the stuff that we've got. Everyone tells me that it's trading and it's 2 points lower and all the rest of it. And how come you can't mark your book? So it's definitely going to give it renewed focus. I mean, we can't. We have to mark it. We're effed, basically, unquote. Forster was likely worried that most of AIG's credit default swap contracts required that collateral be posted to the purchasers, should the market value of the referenced securities decline by a certain amount, or should rating agencies downgrade AIG's long-term debt. That is, collateral calls could be triggered even if there were no actual cash losses in, for example, the super senior tranches of CDOs, upon which the protection had been written. Remarkably, top AIG executives, including CEO Martin Sullivan, CFO Stephen Benzinger, Chief Risk Officer Robert Lewis, Chief Credit Officer Kevin McGinn, and Financial Services Division CFO Elias Habayeb, told FCIC investigators that they didn't even know about the terms of these swaps until the collateral calls started rolling in during July. Office of Thrift Supervision regulators who supervised AIG on a consolidated basis didn't know either. Frost, who was the chief credit default swap salesman at AIG Financial Products, did know about the terms and said he believed they were standard for the industry. Joseph Cassano, the division CEO, also knew about the terms. And the counterparties knew, of course. On the evening of July 26th, Goldman Sachs, which held $21 billion of AIG's super senior credit default swaps, sent news of the first collateral call in the form of an email. Andrew Davelman to Frost. Davelman, sorry to bother you on vacation. Margin call coming your way. Want to give you a heads up. Frost, 18 minutes later. On what? Davelman, 1 minute later. $20 billion of super senior. The next day, Goldman made the collateral call official by forwarding an invoice requesting $1.8 billion. On the same day, Goldman purchased $100 million of 5-year protection in the form of credit default swaps against the possibility that AIG might default on its obligations. Frost never responded to Davelman's email, and when he returned from vacation, he was instructed not to have any involvement in the issue, because Cassano wanted Forster to take the lead in resolving the dispute. AIG's models showed there would be no defaults on any of the bond payments that AIG's swaps insured. The Goldman executives considered those models irrelevant because the contracts required collateral to be posted if market value declined, irrespective of any long-term cash losses. Goldman estimated that the average decline in the market value of the bonds was 15%. So first Bear Stearns' hedge funds, and now AIG was getting hit by Goldman's marks on mortgage-backed securities. Like Chaffee and his colleagues at Bear Stearns, Frost and his colleagues at AIG disputed Goldman's marks. On July 30th, Forster was told by another AIG trader that, quote, AIG would be in fine shape if Goldman wasn't handing its head out there, unquote. The margin call was, quote, something that hit out of the blue, and it's an effing number that's well bigger than we ever planned for, unquote. He acknowledged that dealers might say the marks, quote, could be anything from 80 to sort of, 95, unquote, because of the lack of trading, but said Goldman's marks were ridiculous. In testimony to the FCIC, Viniar said Goldman had stood ready to sell mortgage-backed securities to AIG at Goldman's own marks. AIG's Forster stated that he would not buy the bonds at even 90 cents on the dollar, because values might drop further. Additionally, AIG would be required to value its own portfolio of similar assets at the same price. Forster said, quote, "In the current environment, I still wouldn't buy them, because they could probably go low. We can't mark any of our positions, and obviously that's what saves us, having this enormous mark-to-market. If we start buying the physical bonds back, then any accountant is going to turn around and say, 'Well, John, we know you traded at 90. You must be able to mark your bonds then,'" unquote. Tough, lengthy negotiations followed. Goldman was not budging on its collateral demands, according to Tom Athan, a managing director at AIG Financial Products, describing a conference call with Goldman executives on August 1. Quote, "I played almost every card I had. Legal wording, market practice, intent of the language, meaning of the contract, and also stressed the potential damage to the relationship. And GS said this has gone to the highest levels at GS, and they feel that this is a test case," unquote. Goldman Sachs and AIG would continue to argue about Goldman's marks, even as AIG would continue to post collateral that would fall short of Goldman's demands, and Goldman would continue to purchase CDS contracts against the possibility of AIG's default. Over the next 14 months, more such disputes would cost AIG tens of billions of dollars and help lead to one of the biggest government bailouts in American history. End of section 73. Section 74 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Commission conclusions on Chapter 12. That entities such as Bear Stearns' hedge funds and AIG Financial Products that had significant subprime exposure were affected by the collapse of the housing bubble first, creating financial pressures on their parent companies. The commercial paper and repo markets, two key components of the shadow banking lending markets, quickly reflected the impact of the housing bubble collapse because of the decline in collateral asset values and concern about financial firms' subprime exposure. End of section 74 and of chapter 12.
Section 74 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 13, Summer 2007, Disruptions in Funding, Intro. In the summer of 2007, as the prices of some highly rated mortgage securities crashed and Bear's hedge funds imploded, broader repercussions from the declining house market were still not clear. "I don't think the subprime mess poses any threat to the overall economy," Treasury Secretary Henry Paulson told Bloomberg on July 26. Meanwhile, nervous market participants were looking under every rock for any sign of hidden or latent subprime exposure. In late July, they found it in the market for asset-backed commercial paper, ABCP, a crucial, usually boring backwater of the financial sector. This kind of financing allowed companies to raise money by borrowing against high-quality short-term assets. By mid-2007, hundreds of billions out of the $1.2 trillion U.S. ABCP market were backed by mortgage-related assets, including some with subprime exposure. As noted, the rating agencies had given all of these ABCP programs their top investment-grade ratings, often because of liquidity puts from commercial banks. When the mortgage securities market dried up and money market mutual funds became skittish about broad categories of ABCP, the banks would be required under these liquidity puts to stand behind the paper and bring the assets onto their balance sheets, transferring losses back into the commercial banking system. In some cases, to protect relationships with investors, banks would support programs they had sponsored, even when they had made no prior commitment to do so. End of section 74. Section 75 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 13, IKB of Germany, Real Money Investors. The first big casualty of the run on asset-backed commercial paper was a German bank, IKB Deutsche Industriebank AG. Since its foundation in 1924, IKB had focused on lending to mid-sized German businesses, but in the past decade, management diversified. In 2002, IKB created an off-balance sheet commercial paper program called Rhineland to purchase a portfolio of structured finance securities backed by credit card receivables, business loans, auto loans, and mortgages. It made money by using less expensive short-term commercial paper to purchase higher-yielding long-term securities, a strategy known as securities arbitrage. By the end of June, Rhineland owed 14 billion euro, $18.9 billion of assets, 95% of which were CDOs and CLOs, collateralized loan obligations, that is, securitized leveraged loans, and at least 8 billion euro, $10.8 billion of that was protected by IKB through liquidity puts. Importantly, German regulators at the time did not require IKB to hold any capital to offset potential Rhineland losses. As late as June 2007, when so many were bailing out of the structured products market, IKB was still planning to expand its off-balance sheet holdings and was willing to take long positions in mortgage-related derivatives such as synthetic CDOs. This attitude made IKB a favorite of the investment banks and hedge funds that were desperate to take the short side of the deal. In early 2007, when Goldman was looking for buyers for Abacus 2007 AC1, the synthetic CDO mentioned in Part 3, it looked to IKB. An employee of Paulson & Co., the hedge fund that was taking the short side of the deal, bluntly said that real money investors, such as IKB, were outgunned. The market is not pricing the subprime, residential mortgage-backed securities, wipeout scenario, the Paulson employee wrote in an email. In my opinion, this situation is due to the fact that rating agencies, CDO managers, and underwriters have all the incentives to keep the game going, while real money investors have neither the analytical tools nor the institutional framework to take action before the losses that one could anticipate based on the news available everywhere are actually realized. IKB subsequently purchased 150 million of the A1 and A2 tranches of the Abacus CDO and placed them in Rhineland. It would lose 100% of that investment. In mid-2007, Rhineland's asset-backed commercial paper was held by a number of American investors, including the Montana Board of Investments, the City of Oakland, California, and the Robbinsdale Area School District in suburban Minneapolis. On July 20, IKB reassured its investors that ratings downgrades of mortgage-backed securities would have only a limited impact on its business. However, within days, Goldman Sachs, which regularly helped Rhineland raise money in the commercial paper market, told IKB that it would not sell any more Rhineland paper to its clients. On Friday, July 27, Deutsche Bank, recognizing that the ABCP markets would soon abandon Rhineland and that IKB would have to provide substantial support to the program, decided that doing business with IKB was too risky and cut off its credit lines. These were necessary for IKB to continue running its business. Deutsche Bank also alerted the German bank regulators to IKB's critical state. With the regulators' encouragement, IKB's largest shareholder, KfW Bankengruppe, announced on July 30 that it would bail out IKB. On August 7, Rhineland exercised its liquidity puts with IKB. Rhineland's commercial paper investors were able to get rid of the paper, and KfW took the hit instead, with its losses expected to eventually reach 95%. The IKB episode served notice that exposures to toxic mortgage assets were lurking in the portfolios of even risk-averse investors. Soon, panic seized the short-term funding markets, even those that were not exposed to risky mortgages. There was a recognition, I'd say an acute recognition, that potentially some of the asset-backed commercial paper conduits could have exposure to those areas. As a result, investors in general, without even looking into the underlying assets, decided, I don't want to be in any asset-backed commercial paper. I don't want to invest in a fund that may have those positions. Stephen Meyer, Global Cash Investment Officer at State Street Global Advisors, testified to the FCIC. From its peak of $1.2 billion on August 8th, the asset-backed commercial paper market would decline by almost $400 billion by the end of 2007. End of section 75. Section 76 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 13, Countrywide. That's our 9/11. On August 2nd, 3 days after the IKB rescue, Countrywide CEO Angelo Mozillo realized that his company was unable to roll its commercial paper or borrow on the repo market. When we talk about August 2nd at Countrywide, that's our 9/11, he said. We worked 7 days a week trying to figure this thing out and trying to work with the banks. Our repurchase lines were coming due billions and billions of dollars. Mozillo emailed Lyle Gramley, a former Fed governor and a former Countrywide director. Fear in the credit markets is now tending towards panic. There is little to no liquidity in the mortgage market with the exception of Fannie and Freddie. Any mortgage product that is not deemed to be conforming either cannot be sold into the secondary markets or are subject to egregious discounts. On August 2nd, despite the internal turmoil at Countrywide, CFO Eric Siraki told investors that Countrywide had significant short-term funding liquidity cushions and ample liquidity sources of our bank. It is important to note that the company has experienced no disruption in financing its ongoing daily operations, including placement of commercial paper. Moody's reaffirmed its A3 ratings and stable outlook on the company. The rating agencies and the company itself would quickly reverse their positions. On August 6, Mozillo reported to the board during a specially convened meeting that, as the meeting minutes recorded, quote, the secondary market for virtually all classes of mortgage securities, both prime and non-prime, had unexpectedly and with almost no warning seized up, and the company was unable to sell high-quality mortgage-backed securities. End quote. President and COO David Sambol told the board, quote, management can only plan on a week-by-week basis due to the tenuous nature of the situation, end quote. Mozillo reported that although he continued to negotiate with banks for alternative sources of liquidity, the unprecedented and unanticipated absence of a secondary market could force the company to draw down on its backup credit lines. Shortly after the Countrywide board meeting, the Fed's Federal Open Market Committee members discussed the considerable financial turbulence in the subprime mortgage market and that some firms, including Countrywide, were showing some strain. They noted that the data did not indicate a collapse of the housing market was imminent, and that if the more optimistic scenarios proved to be accurate, they might look back and be surprised that the financial events did not have a stronger impact on the real economy. But the FOMC members also expressed concern that the effects of subprime developments could spread to other sectors and noted that they had been repeatedly surprised by the depth and duration of the deterioration of these markets. One participant, in a paraphrase of a quote he attributed to Winston Churchill, said that no amount of rewriting of history would exonerate those present if they did not prepare for the more dire scenarios discussed in the staff presentations. Several days later, on August 14, Countrywide released its July 2007 operational results, reporting that foreclosures and delinquencies were up and that loan production had fallen by 14% during the preceding months. A company spokesman said layoffs would be considered. On the same day, Fed staff who had supervised Countrywide's holding company until the bank switched to a thrift charter in March 2007 sent a confidential memo to the Fed's Board of Governors warning about the company's condition. The company is heavily reliant on an originate-to-distribute model, and given current market conditions, the firm is unable to securitize or sell any of its non-conforming mortgages. Countrywide's short-term funding strategy relied heavily on commercial paper, CP, and especially on ABCP. In current market conditions, the viability of that strategy is questionable. The ability of the company to use mortgage securities as collateral in repo transactions is consequently uncertain in the current market environment. As a result, it could face severe liquidity pressures. Those liquidity pressures conceivably could lead eventually to possibly insolvency. Countrywide asked its regulator, the Office of Thrift Supervision, if the Fed could provide assistance, perhaps by waiving a Fed rule and allowing Countrywide's thrift subsidiary to support its holding company by raising money from insured depositors, or perhaps through discount window lending, which would require the Fed to accept risky mortgage-backed securities as collateral, something it never had done and would not do until the following spring. The Fed did not intervene. Substantial statutory requirements would have to be met before the board could authorize lending to the holding company or mortgage subsidiary, staff wrote. The Federal Reserve had not lent to a non-bank in many decades, and such lending in the current circumstances seemed highly improbable. The following day, lacking any other funding, Mozillo recommended to his board that the company notify lenders of its intention to draw down $11.5 billion on backup lines of credit. Mozillo and his team knew that the decision could lead to ratings downgrades. The only option we had was to pull down those lines, he told the FCIC. We had a pipeline of loans, and we either had to say to the borrowers, the customers, we're out of business, we're not going to fund, and there's great risk to that litigation risk we had committed to fund. When it's between your ass and your image, you hold on to your ass. On the same day that Countrywide's board approved the $11.5 billion drawdown, but before the company announced it publicly, the Merrill Lynch analyst Kenneth Bruce, who had reissued his buy rating on the company's stock 2 days earlier, switched to sell with a negative outlook because of Countrywide's funding pressures, adding, if the market loses confidence in its ability to function properly, then the model can break. If liquidations occur in a weak market, then it is possible for Countrywide to go bankrupt. The next day, as news of Bruce's call spread, Countrywide informed markets about the drawdown. Moody's downgraded its senior unsecured debt rating to the lowest tier of investment grade. Countrywide shares fell 11%, closing at $18.95. For the year, the company's stock was down 50%. The bad news led to an old-fashioned bank run. Mozillo singled out an August 16th Los Angeles Times article covering Bruce's report, which, he said, caused a run on our bank of $8 billion on Monday. The article spurred customers to withdraw their funds by noting specific addresses of Countrywide branches in Southern California, Mozillo told the FCIC. A reporter came out with a photographer and, interviewed the people in line, and he created, it was just horrible. Horrible for the people, horrible for us. Totally unnecessary, Mozillo said. 6 days later, on August 22nd, Bank of America announced it would invest $2 billion for a 16% stake in Countrywide. Both companies denied rumors that the nation's biggest bank would soon acquire the mortgage lender. Mozillo told the press, there was never a question about our survival. He said the investment reinforced Countrywide's position as one of the strongest and best-run companies in the country. In October, Countrywide reported a net loss of $1.2 billion, its first quarterly loss in 25 years. As charge-offs on its mortgage portfolio grew, Countrywide raised provisions for loan losses to $934 million from only $38 million 1 year earlier. On January 11, 2008, Bank of America issued a press release announcing a definitive agreement to purchase Countrywide for approximately $4 billion. It said the combined entity would stop originating subprime loans and would expand programs to help distressed borrowers. End of section 76. Section 77 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 13, BNP Paribas, The Ringing of the Bells. Meanwhile, problems in the U.S. financial markets hit the largest French bank. On August 9, BNP Paribas SA suspended redemptions from 3 investment funds that had plunged 20% in less than 2 weeks. Total assets in those funds were $2.2 billion, with a third of that amount in subprime securities rated AA or higher. The bank said it would also stop calculating a fair market value for the funds because, the complete evaporation of liquidity in certain market segments of the U.S. securitization market has made it impossible to value certain assets fairly regardless of their quality or credit rating. In retrospect, many investors regarded the suspension of the French funds as the beginning of the 2007 liquidity crisis. August 9th was the ringing of the bell for short-term funding markets. Paul McCulley, a managing director at PIMCO, told the FCIC, "The buyers went on a buyer strike and simply weren't rolling. That is, they stopped rolling over their commercial paper and instead demanded payment on their loans." On August 9th, the interest rates for overnight lending of A1 rated asset-backed commercial paper rose from 5.39% to 5.75%, the highest level since January 2001. It would continue rising unevenly, hitting 6.14% in August 10, 2007. Figure 13.1 shows how, in response, lending declined. In August alone, the asset-backed commercial paper market shrank by $190 billion, or 20%. On August 6, subprime lender American Home Mortgage's asset-backed commercial paper program invoked its privilege of postponing repayment, trapping lenders' money for several months. Lenders quickly withdrew from programs with similar provisions, which shrank that market from $35 billion to $4 billion between May and August. The paper that did sell had significantly shorter maturities, reflecting creditors' desire to reassess their counterparties' creditworthiness as frequently as possible. The average maturity of all asset-backed commercial paper in the United States fell from about 31 days in late July to about 23 days by mid-September, though the overwhelming majority was issued for just 1 to 4 days. Disruptions quickly spread to other parts of the money market. In a flight to quality, investors dumped their repo and commercial paper holdings and increased their holdings in seemingly safer money market funds and treasury bonds. Market participants, unsure of each other's potential subprime exposures, scrambled to amass funds for their own liquidity. Banks became less willing to lend to each other. A closely watched indicator of interbank lending rates called the 1-month LIBOR-OIS spread increased, signifying that banks were concerned about the credit risk involved in lending to each other. On August 9th, it rose sharply, increasing 3- to 4-fold over historical values, and by September 7th, it climbed by another 150%. In 2008, it would peak much higher. The panic in the repo, commercial paper, and interbank markets was met by immediate government action. On August 10, the day after BNP Paribas suspended redemptions, the Fed announced that it would provide liquidity as necessary to facilitate the orderly functioning of financial markets, and the European Central Bank infused billions of euros into overnight lending markets. On August 17, the Fed cut the discount rate by 50 basis points from 6.25% to 5.75%. This would be the first of many such cuts aimed at increasing liquidity. The Fed also extended the term of discount window lending to 30 days, from the usual overnight or very short-term period, to offer banks a more stable source of funds. On the same day, the Fed's FOMC released a statement acknowledging the continued market deterioration and promising that it was prepared to act as needed to mitigate the adverse effects on the economy. End of section 77. Section 78 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 13, SIVs, an Oasis of Calm. In August, the turmoil in asset-backed commercial paper markets hit the market for structured investment vehicles, or SIVs, even though most of these programs had little subprime mortgage exposure. SIVs had a stable history since their introduction in 1988. These investments had weathered a number of credit crises, even through early summer of 2007, as noted in a Moody's report issued on July 20, 2007, titled SIVs, an Oasis of Calm in the Subprime Maelstrom. Unlike typical asset-backed commercial paper programs, SIVs were funded primarily through medium-term notes, bonds maturing in 1 to 5 years. SIVs held significant amounts of highly liquid assets and marked those assets to market prices daily or weekly, which allowed them to operate without explicit liquidity support from their sponsors. The SIV sector tripled in assets between 2004 and 2007. On the eve of the crisis, there were 36 SIVs with almost $400 billion in assets. About 1/4 of that money was invested in mortgage-backed securities or in CDOs, but only 6% was invested in subprime mortgage-backed securities and CDOs holding mortgage-backed securities. Not surprisingly, the first of SIVs to fail were concentrated in subprime mortgage-backed securities, mortgage-related CDOs, or both. These included Chain Finance, managed by London-based Chain Capital Management, Rhinebridge, another IKB program, Golden Key, and Mainsail II, both structured by Barclays Capital. Between August and October, each of these four was forced to restructure or liquidate. Investors soon ran from even the safer SIVs. The media was quite happy to sensationalize the collapse of the next leaking SIV or the next SIV-positive institution, then Moody's managing director Henry Taub told the FCIC. The situation was complicated by the SIV's lack of transparency. In a context of opacity about where risk resides, a general distrust has contaminated many asset classes. What had once been liquid is now illiquid. Good collateral cannot be sold or financed at anything approaching its true value, Moody's wrote on September 5th. Even high-quality assets that had nothing to do with the mortgage market were declining in value. One SIV marked down a CDO to 7 cents on the dollar while it was still rated AAA. To raise cash, managers sold assets. But selling high-quality assets into a declining market depressed the prices of these unimpaired securities and pushed down the market values of other SIV portfolios. By the end of November, SIVs still in operation had liquidated 23% of their portfolios on average. Sponsors rescued some SIVs. Other SIVs restructured or liquidated. Some investors had to wait a year or more to receive payments and even then recouped only some of their money. In the case of Rhinebridge, investors lost 45% and only gradually received their payments over the next year. Investors in one SIV, Sigma, lost more than 95%. As of fall 2010, not a single SIV remained in its original form. The subprime crisis had brought to its knees a historically resilient market in which losses due to subprime mortgage defaults had been, if anything, modest and localized. End of section 78. Section 79 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 13, Money Funds and Other Investors. Drinking from a Fire Hose. The next dominoes were the money market funds and other funds. Most were sponsored by investment banks, bank holding companies, or mutual fund complexes such as Fidelity, Vanguard, and Federated. Under SEC regulations, money market funds that serve retail investors must keep two sets of accounting books, one reflecting the price they paid for securities and the other the fund's mark-to-market value, the shadow price in market parlance. However, funds do not have to disclose the shadow price unless the fund's net asset value, NAV, has fallen by 0.5% below $1 to $0.995 per share. Such a decline in market value is known as breaking the buck and generally leads to a fund's collapse. It can happen, for example, if just 5% of a fund's portfolio is in an investment that loses just 10% of its value, so a fund manager cannot afford big risks. But SIVs were considered very safe investments. They always had been, and were widely held by money market funds. In fall 2007, dozens of money market funds faced losses on SIVs and other asset-backed commercial paper. To prevent their funds from breaking the buck, at least 44 sponsors, including large banks such as Bank of America, U.S. Bancorp, and SunTrust, purchased SIV assets from their money market funds. Similar dramas played out in the less regulated realm of the money market sector known as enhanced cash funds. These funds serve not retail investors but rather qualified purchasers, which may include wealthy investors who invest $25 million or more. Enhanced cash funds fall outside most SEC regulations and disclose requirements. Because they have much higher investment thresholds than retail funds and because they face less regulation, investors expect somewhat riskier investing in higher returns. Nonetheless, these funds also aim to maintain a $1 net asset value. As the market turned, some of these funds did break the buck while the sponsors of others stepped in to support their value. The $5 billion GE Asset Management Trust Enhanced Cash Trust, a GE-sponsored fund that managed GE's own pension and employee benefit assets, ran aground in the summer. It had 50% of its assets in mortgage-backed securities. When the fund reportedly lost $200 million and closed in November 2007, investors redeemed their interests at 96 cents. Bank of America supported its strategic cash portfolio, the nation's largest enhanced cash fund with $40 billion in assets at its peak, after one of that fund's largest investors withdrew $20 billion in November 2007. An interesting case study is provided by the meteoric rise and decline of the Credit Suisse Institutional Money Market Prime Fund. The fund sought to attract investors through internet-based trading platforms called portals, which supplied an estimated $300 billion to money market funds and other funds. Investors use these portals to quickly move their cash to the highest-yielding fund. Posting a higher return could attract significant funds. One money market fund manager later compared the use of portal money to drinking from a fire hose. But the money could vanish just as quickly. Their Credit Suisse fund posted the highest returns in the industry during the 12 months before the liquidity crisis and increased its assets from about $5 billion in the summer of 2006 to more than $25 billion in the summer of 2007. To deliver those high returns and attract investors, though it focused on structured finance products, including CDOs and SIVs, such as Chain. When investors became concerned about such assets, they yanked about $10 billion out of the fund in August 2007 alone. Credit Suisse, the Swiss bank that sponsored the fund, was forced to bail it out, purchasing $5.7 billion of assets in August. The episode highlights the risks of money market funds relying on hot money. That is, institutional investors who move quickly in and out of funds in search of the highest returns. The losses on SIVs and other mortgage-tainted investments also battered local government investment pools across the country, some of which held billions of dollars in these securities. Pooling provides municipalities, school districts, and other government agencies with economies of scale, investment diversification, and liquidity. In some cases, participation is mandatory. With $27 billion in assets, Florida's local government investment pool was the largest in the country and intended to operate like a highly liquid, low-risk money market fund with securities like cash, certificates of deposit, U.S. Treasury bills, and bonds issued by other U.S. government agencies, as an investigation by the state legislature noted. But by November 2007, because of ratings downgrades, the fund held at least $1.5 billion in securities that no longer met the state's requirements. It had more than $2 billion in SIVs and other distressed securities, of which about $725 million had already defaulted. And it held $650 million in Countrywide certificates of deposit with maturities that stretched out as far as June 2008. In early November, following a series of news reports, the fund suffered a run. Local governments withdrew $8 billion in just 2 weeks. Orange and Pinellas counties pulled out their entire investments. On November 29, the fund's managers stopped all withdrawals. Florida's was the hardest hit, but other state investment pools also took significant losses on SIVs and other mortgage-related holdings. End of section 79. Section 80 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Commission conclusions on Chapter 13. The Commission concludes that the shadow banking system was permitted to grow to rival the commercial banking system with inadequate supervision and regulation. That system was very fragile due to high leverage, short-term funding, risky assets, inadequate liquidity, and the lack of a federal backstop. When the mortgage market collapsed and financial firms began to abandon the commercial paper and repo lending markets, some institutions depending on them for funding their operations failed or, later in the crisis, had to be rescued. These markets and other interconnections created contagion as the crisis spread even to markets and firms that had little or no direct exposure to the mortgage market. In addition, regulation and supervision of traditional banking had been weakened significantly, allowing commercial banks and thrifts to operate with fewer constraints and to engage in a wider range of financial activities, including activities in the shadow banking system. The financial sector, which grew enormously in the years leading up to the financial crisis, wielded great political power to weaken institutional supervision and market regulation of both the shadow banking system and the traditional banking system. This deregulation made the financial system especially vulnerable to the financial crisis and exacerbated its efforts. End of Section 80.
Section 81 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 14. Late 2007 to early 2008. Billions in subprime losses. Intro. While a handful of banks were bailing out their money market funds and commercial paper programs in the fall of 2007, the financial sector faced a larger problem. Billions of dollars in mortgage-related losses on loans, securities, and derivatives with no end in sight. Among U.S. firms, Citigroup and Merrill Lynch reported the most spectacular losses, largely because of their extensive collateralized debt obligation (CDO) businesses, writing down a total of $23.8 billion and $24.7 billion, respectively, by the end of the year. Billions more in losses were reported by large financial institutions such as Bank of America, $9.7 billion, Morgan Stanley, $10.3 billion, JP Morgan, $5.3 billion, and Bear Stearns, $2.6 billion. Insurance companies, hedge funds, and other financial institutions collectively had taken additional mortgage-related losses of about $100 billion. The large write-downs strained these firms' capital and cash reserves. Further, market participants began discriminating between firms perceived to be relatively healthy and others about which they were not so sure. Bear Stearns and Lehman Brothers were at the top of the suspect list. By year-end 2007, the cost of 5-year protection against default on their obligations in the credit default swap market stood at, respectively, $176,000 and $119,000 annually for every $10 million, while the cost for the relatively stronger Goldman Sachs stood at $68,000. Meanwhile, the economy was beginning to show signs of stress. Facing turmoil in financial markets, declining home prices, and oil prices above $75 a barrel, consumer spending was slowing. The Federal Reserve lowered the overnight bank borrowing rate from 5.25% earlier in the year to 4.75% in September, 4.5% in October, and then 4.25% in December. End of Section 81. Section 82 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 14. Merrill Lynch, Dawning Awareness Over the Curse of the Summer. On October 24, Merrill Lynch stunned investors when it announced that third-quarter earnings would include a $6.9 billion loss on CDOs and $1 billion on subprime mortgages, $7.9 billion in total, the largest Wall Street write-down to that point, and nearly twice the $4.5 billion loss that the company had warned investors to expect just 3 weeks earlier. 6 days later, the embattled CEO, Stanley O'Neill, a 21-year Merrill veteran, resigned. Much of this write-down came from the firm's holdings of the super senior tranches of mortgage-related CDOs that Merrill had previously thought to be extremely safe. As late as fall 2006, its management had been bullish on growth and bullish on the subprime asset class. but later that year, the signs of trouble were becoming difficult even for Merrill to ignore. Two mortgage originators, to which the firm had extended credit lines, failed. Ownit, in which Merrill also had a small equity stake, and Mortgage Lenders Network. Merrill seized the collateral backing those loans, $1.5 billion from mortgage lenders and $1.2 billion from Ownit. Merrill, like many of its competitors, started to ramp up its sales efforts, packaging its inventory of mortgage loans and securities into CDOs with new vigor. Its goal was to reduce the firm's risk by getting those loans and securities off its balance sheet. Yet it found that it could not sell the super senior tranches of those CDOs at acceptable prices. It therefore had to take down senior tranches into inventory in order to execute deals, leading to the accumulation of tens of billions of dollars of those tranches on Merrill's books. Dow Kim, the then co-president of Merrill's investment banking segment, told FCIC staff that the buildup of the retained super senior tranches in the CDO positions was actually part of a strategy begun in late 2006 to reduce the firm's inventory of subprime and Alt-A mortgages. Sell the lower-rated CDO tranches, retain the super senior tranches. Those had been his instructions to his managers at the end of 2006, Kim recalled. He believed that this strategy would reduce overall credit risk. After all, the super senior tranches were theoretically the safest pieces of those investments. To some degree, however, the strategy was involuntary. His people were having trouble selling these investments, and some were even sold at a loss. Initially, the strategy seemed to work. By May, the amount of mortgage loans and securities to be packaged into CDOs had declined to $3.5 billion from $12.8 billion in March. According to a September 2007 internal Merrill presentation, the net amount in retained super senior CDO tranches had increased from $9.3 billion in September 2006 to $25.4 billion by March 2007 and $28.9 billion by May. But as the mortgage market came under increasing pressure and as the market value of even super senior tranches crumbled, the strategy would come back to haunt the firm. Merrill's first quarter earnings for 2007, net revenues of $9.9 billion, were its second highest quarterly results ever, including a record for the fixed income, currencies, and commodities business, which housed and retained CDO positions. These results were announced during a conference call with analysts, an event that investors and analysts rely on to obtain important information about the company and that, like other public statements, is subject to federal securities laws. Merrill's then CFO, Jeffrey Edwards, indicated that the company's results would not be hurt by the dislocation in the subprime market because revenues from subprime mortgage-related activities comprised less than 1% of our net revenues over the past 5 quarters, and because Merrill's risk management capabilities are better than ever and crucial to our success in navigating turbulent markets. Providing further assurances, he stated, "We believe the issues in this narrow slice of the market remain contained and have not negatively impacted other sectors." However, Edwards did not disclose the large increase in retained super senior CDO tranches or the difficulty of selling those tranches, even at a loss, though specific questions on the subject were raised. In July, Merrill followed its strong first quarter report with another for the second quarter that enabled the company to achieve record net revenues, net earnings, and net earnings per diluted share for the first half of 2007. During the conference call announcing the results, the analyst Glenn Schorr of UBS, a large Swiss bank, asked the CFO to provide some color around myth versus reality on Merrill's exposure to retained CDO positions. As he had 3 months earlier, Edwards stressed Merrill's risk management and the fact that the CDO business was a small part of Merrill's overall business. He said that there had been significant reductions in Merrill's retained exposures to lower-rated segments of the market, although he did not disclose that the total amount of Merrill's retained CDOs had reached $30.4 billion by June. Edwards declined to provide details about the company's exposure to subprime mortgage CDOs and any inventory of mortgage-backed securities to be packaged into CDOs. We don't disclose our capital allocations against any specific or even broader group, Edwards said. On July 22, after the super senior tranches had been accumulating for many months, Merrill executives first officially informed its board about the buildup. At a presentation to the board's finance committee, Dale Latanzio, co-head of the American branch of the fixed income, currencies, and commodities business, reported a net exposure of $32 billion in CDO-related assets, essentially all of them rated AAA, with exposure to the lower-rated asset class significantly reduced. This net exposure was the amount of CDO positions left after the subtraction of the hedges, guarantees in one form or another that Merrill had purchased to pass along its ultimate risk to third parties willing to provide that protection and take that risk for the fee. AIG and the small club of Monoline Insurers were significant suppliers of these guarantees, commonly done as credit default swaps. In July 2007, Merrill had begun to increase the amount of CDS protection to offset the retained CDO positions. Latanzio told the committee, management decided in the beginning of this year to significantly reduce exposure to lower-rated assets in the subprime asset class and instead migrate exposure to senior and super senior tranches. Edwards did not see any problems. As Kim insisted, everyone at the firm and most people in the industry felt that super senior was super safe. Former CEO O'Neill told FCIC investigators he had not known that the company was retaining the super senior tranches of the CDOs until Latanzio's presentation to the Finance Committee. He was startled, if only because he had been under the impression that Merrill's mortgage-backed assets business had been driven by demand. He had assumed that if there were no new customers, there would be no new offerings. If customers demanded the CDOs, why would Merrill have to retain CDO tranches on the balance sheet? O'Neill said he was surprised about the retained positions, but stated that the presentation, analysis, and estimation of potential losses were not sufficient to sound alarm bells. Latanzio's report in July indicated that the retained positions had experienced only $73 million in losses. Over the next 3 months, the market value of the super senior tranches plummeted and losses ballooned. O'Neill told the FCIC, it was a dawning awareness over the course of the summer and through September as the size of the losses were being estimated. On October 21, Merrill executives gave its board a detailed account of how the firm found itself with what was by that time $15.2 billion in net exposure to the super senior tranches, down from a peak in July of $32.2 billion because the firm had increasingly hedged, written off, and sold its exposure. On October 24, Merrill announced its third-quarter earnings, a stunning $7.9 billion mortgage-related write-down, contributing to a net loss of $2.3 billion. Merrill also reported, for the first time, its $15.2 billion net exposure to retained CDO positions. Still, in their conference call with analysts, O'Neill and Edwards refused to disclose the gross exposures, excluding the hedges from the monolines and AIG. I just don't want to get into the details behind that, Edwards said. Let me just say that what we have provided again, we think, is an extraordinarily high level of disclosure and it should be sufficient. According to the Securities and Exchange Commission, by September 2007, Merrill had accumulated $55 billion of gross retained CDO positions, almost 4 times the $15.2 billion of net CDO positions reported during the October 24 conference call. On October 30, when O'Neill resigned, he left with a severance package worth $161.5 million, on top of the $91.4 million in total compensation he earned in 2006 when his company was still expanding its mortgage banking operations. Kim, who oversaw the strategy that left Merrill with billions in losses, had left in May 2007 after being paid $40 million for his work in 2006, which was a profitable year for Merrill as a firm. By late 2007, the viability of the Monoline Insurers, from which Merrill had purchased almost $100 billion in hedges, had come into question, and the rating agencies were downgrading them, as we will see in more detail shortly. The SEC had told Merrill that it would impose a punitive capital charge on the firm if it purchased additional credit default protection from the financially troubled monolines. Recognizing that the monolines might not be good for all the protection purchased, Merrill began to put aside loss allowances starting with $2.6 billion in January 17, 2008. By the end of 2008, Merrill would put aside a total of $13 billion related to monolines and had recorded total write-downs on nearly $44 billion of other mortgage-related exposures. End of section 82. Section 83 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 14. Citigroup, that would not in any way have excited my attention. 5 days after O'Neill's October 30 departure from Merrill Lynch, Citigroup announced that its total subprime exposure was $55 billion, which was $42 billion more than it had told investors just 3 weeks earlier. Citigroup also announced it would be taking an $8 to $11 billion loss on its subprime mortgage-related holdings and that Chuck Price was resigning as its CEO. Like O'Neill, Prince had learned late of his company's subprime-related CDO exposures. Prince and Robert Rubin, chairman of the executive committee of the board, told the FCIC that before September 2007, they had not known that Citigroup's investment banking division had sold some CDOs with liquidity puts and retained the super senior tranches of others. Prince told the FCIC that even in hindsight, it was difficult for him to criticize any of his team's decisions. If someone had elevated to my level that we were putting on a $2 trillion balance sheet, $40 billion of AAA-rated, zero-risk paper that would not in any way have excited my attention, Prince said. It wouldn't have been useful for someone to come to me and say, now we have got $2 trillion in the balance sheet of assets. I want to point out to you there is a 1 in a billion chance that this $40 billion could go south. That would not have been useful information. There is nothing I can do with that because there is that level of chance on everything. In fact, the odds were much higher than that. Even before the mass downgrades of CDOs in late 2007, a AAA tranche of a CDO had a 1 in 10 chance of being downgraded within 5 years of its original rating. Certainly, Citigroup was a large and complex organization. That $2 trillion balance sheet and $1.2 trillion off-balance sheet was spread among more than 2,000 operating subsidiaries in 2007. Prince insisted that Citigroup was not too big to manage, but it was an organization in which one unit would decide to reduce mortgage risk while another unit increased it. And it was an organization in which senior management would not be notified of $43 billion in concentrated exposure, 2% of the company's balance sheet, and more than a third of its capital because it was perceived to be zero-risk paper. Citigroup's Financial Control Group had argued in 2006 that the liquidity puts that Citigroup had written on its CDOs had been priced for investors too cheaply in light of the risks. Also in early 2006, Susan Mills, a managing director in the securitization unit, which bought mortgages from other companies and bundled them for sale to investors, took note of rising delinquencies in the subprime market and created a surveillance group to track loans that her unit purchased. By mid-2006, her group saw a deterioration in loan quality and an increase in early payment defaults. That is, more borrowers were defaulting within a few months of getting a loan. From 2005 to 2007, Mills recalled before the FCIC the early payment default rates nearly tripled from 2% to 5% or 6%. In response, the securitization unit slowed down its purchase of loans, demanded higher quality mortgages, and conducted more extensive due diligence on what it bought. However, neither Mills nor other members of the unit shared any of this information with other divisions in Citigroup, including the CDO desk. Around March or April 2007, in contrast with the securitization desk, Citigroup's CDO desk increased its purchases of mortgage-backed securities because it saw the distressed market as a buying opportunity. Effective communication across businesses was lacking, the company's regulators later observed. Management acknowledged that, in looking back, it should have made the mortgage deterioration known earlier throughout the firm. The global consumer group saw signs of subprime issues and avoided losses, as did mortgage-backed securities traders, but CDO structures business did so belatedly. There was no dialogue across businesses. Co-head of the CDO desk, Janice Warren, told the FCIC that she first saw weaknesses in the underlying market in early 2007. In February, when the ABX-HE BBB 06-2 fell to 37% below par, the CDO desk decided to slow down on the financing of mortgage securities for inventory to produce CDOs. Shortly thereafter, however, the same ABX index started to rally, rising to 26% below par in March and holding around that level through May. So the CDO desk reversed course and accelerated its purchases of inventory in April, according to Nestor Dominguez, Warren's co-head on the CDO desk. Dominguez said he didn't see the market weakening until the summer, when the index fell to less than 60% below par. Murray Burns, the Citigroup risk officer assigned to the CDO business, approved the CDO desk's request to temporarily increase its limits on purchasing collateral. Burns observed, in hindsight, that rather than looking at the widening spreads as an opportunity, Citigroup should have reassessed its assumptions and examined whether the decline in the ABX was a sign of strain in the mortgage market. He admitted complacency about the desk's ability to manage its risk. The Risk Management Division also increased the CDO desk's limits for retaining the most senior tranches from $30 billion to $35 billion in the first half of 2007. As at Merrill, traders and risk managers at Citigroup believed that the super senior tranches carried little risk. Citigroup's regulators later wrote, "An acknowledgement of the risk in its super senior AAA CDO exposure was perhaps Citigroup's biggest miss. As management felt comfortable with the credit risk of these tranches, it began to retain large positions on the balance sheet. As the subprime market began to deteriorate, the risk perceived in these tranches increased, causing large write-downs. Ultimately, losses at Citigroup from mortgages, Alt-A mortgage-backed securities, and mortgage-related CDOs would total about $58 billion, nearly half of Citigroup's capital at the end of 2006. About $8 billion of that loss related to protection purchased from the Monoline Insurers. Barnes' decision to increase the CDO risk limits was approved by his superior, Ellen Duke. Barnes and Duke reported to David Bushnell, the chief risk officer. Bushnell, whom Prince called the best risk manager on Wall Street, told the FCIC that he did not remember specifically approving the increase, but that, in general, the risk management function did approve higher risk limits when a business line was growing. He described a firm-wide initiative to increase Citigroup's structured products business. Perhaps what is most remarkable about the conflicting strategies employed by the securitization and CDO desks is that the respective risk officers attended the same weekly independent risk meetings. Duke reflected that she was not overly concerned when the issue came up, saying she and her risk team were seduced by structuring and failed to look at the underlying collateral. According to Burns, the CDO desk didn't look at the CDO's underlying collateral because it lacked the ability to see loan performance data such as delinquencies and early payment defaults. Yet the surveillance unit in Citigroup's securitization desk might have been able to provide some insights based on its own data. Barnes told the FCIC that Citigroup's risk management tended to be managed along business lines, noting that he was only 2 offices away from his colleague who covered the securitization business and yet didn't understand the nuances of what was happening to the underlying loans. He regretted not reaching out to the consumer bank to get the pulse of mortgage origination. That has never happened since the Depression. Prince and Rubin appeared to believe, up until the fall of 2007, that any downside risk in the CDO business was minuscule. I don't think anybody focused on the CDOs. This was one business in a vast enterprise, and until the trouble developed, it wasn't one that had any particular profile. Rubin, in Prince's words, a very important member of the board, told the FCIC. You know, Tom Mahiras was in charge of trading. Tom was an extremely well-regarded trading figure on the street. And this is what traders do. They handle these kinds of problems. Mahiras, the co-head of Citigroup's investment bank, told the FCIC that he spent a small fraction of 1% of his time thinking about or dealing with the CDO business. Citigroup's risk management function was simply not very concerned about housing market risks. According to Prince, Bushnell and others told them, in effect, gosh, housing prices would have to go down 30% nationwide for us to have not a problem with mortgage-backed securities, CDOs, but for us to have problems. And that has never happened since the Depression. Housing prices would be down much less than 30% when Citigroup began having problems because of write-downs and the liquidity puts it had written. By June 2007, national house prices had fallen 4.5%, and about 16% of subprime adjustable rate mortgages were delinquent. Yet Citigroup still did not expect that the liquidity puts could be triggered, and it remained unconcerned about the value of its retained super senior tranches of CDOs. On June 4, 2007, Citigroup made a presentation to the SEC about subprime exposure in its CDO business. The presentation noted that Citigroup did not factor two positions into this exposure, $14.6 billion in super senior tranches and $23.2 billion in liquidity puts. The presentation explained that the liquidity puts were not a concern. The risk of default is extremely unlikely, and certain market events must also occur for us to be required to fund. Therefore, we view these positions to be even less risky than the super senior book. Just a few weeks later, the July 2007 failure of the two Stearns hedge funds spelled trouble. Commercial paper written against three Citigroup underwritten CDOs, for which Stearns Asset Management was the asset manager and on which Citigroup had issued liquidity puts, began losing value and their interest rates began rising. The liquidity puts would be triggered if interest rates on the asset-backed commercial paper rose above a certain level. The Office of the Comptroller of the Currency, the regulator of Citigroup's national bank subsidiary, had expressed no apprehensions about the liquidity puts in 2003. But by December of 2007, OCC examiner in charge, John Lyons, told the FCIC the OCC became concerned. Buying the commercial paper would drain $25 billion of the company's cash and expose it to possible balance sheet losses at a time when markets were increasingly in distress. But given the rise in rates, Lyons also said that Citigroup did not have the option to wait. Over the next 6 months, Citigroup purchased all $25 billion of the paper that had been subject to its liquidity puts. On a July 20 conference call, CFO Gary Crittenden told analysts and investors that the company's subprime exposures had fallen from $24 billion at the end of 2006 to $13 billion on June 30. But he made no mention of the super senior exposures and liquidity puts. I think our risk team did a nice job of anticipating that this was going to be a difficult environment and so set about in a pretty concentrated effort to reduce our exposure over the last 6 months, he said. A week later, on a July 27 call, Crittenden reiterated that subprime exposure had been cut. So I think we've had good risk management that has been anticipating some market dislocation here. By August, as market conditions worsened, Citigroup's CDO desk was revaluing its super senior tranches, though it had no effective model for assigning value. However, as the market congealed, then froze, the paucity of actual market prices for these tranches demanded a model. The New York Fed later noted that the model for super senior CDOs, based on fundamental economic factors, could not be fully validated by Citigroup's current validation methodologies, yet it was relied upon for reporting exposures. Barnes, the CDO risk officer, told the FCIC that sometime that summer he met with the co-heads of the CDO desk to express his concern about possible losses on both the unsold CDO inventory and the retained super senior tranches. The message got through. Nestor Dominguez told the FCIC, "We began extensive discussions about the implications of the dramatic decline of the underlying subprime markets and how that would feed into the super senior positions." Also, at this time, for the first time, such concerns reached Mahiras. He justified his lack of prior knowledge of the billions of dollars in inventory and super senior tranches by pointing out that the business was appropriately supervised by experienced and highly competent managers and by an independent risk group, and that I was properly apprised of the general nature of our work in this area and its attendant risks. The exact dates are not certain, but according to Bushnell, he remembers a discussion at a business heads meeting about the growing mark-to-market volatility on those super senior tranches in late August or early September, well after Citigroup started to buy the commercial paper backing the super senior tranches of the CDOs that BSAM managed. This was also when Chairman and CDO Prince first heard about the possible amount of open positions on the super senior CDO tranches that Citigroup held. It wasn't presented at the time in a startling fashion, but then it got bigger and bigger and bigger, obviously, over the next 30 days. In late August, Citigroup's valuation model suggested that losses under super senior tranches might range from $15 million to $2 billion. This number was recalculated as $300 to $500 million in mid-September as the valuation methodology was refined. In the weeks ahead, those numbers would skyrocket. DEFCON calls. To get a handle on potential losses from the CDOs and liquidity puts, starting on September 9, Prince convened a series of meetings and later nightly DEFCON calls with members of his senior management team. They included Rubin, Mahiras, Crittenden, and Bushnell, as well as Lou Caden, the chief administrative officer. Rubin was in Korea during the first meeting, but Caden kept him informed. Rubin later emailed the Prince. According to Lou, Tom Mahiras never did provide a clear and direct answer on the super seniors. If that is so, and the meeting did not bring that to a head, isn't that deeply troubling not as to what happened? That is a different question that is also troubling, but as to providing full and clear information and analysis now. Prince disagreed, writing, "I thought for first meeting it was good. We weren't trying to get to final answers." A second meeting was held September 12 after Rubin was back in the country. This meeting marked the first time Rubin recalled hearing of the super senior and liquidity put exposure. He later commented, "As far as I was concerned, they were all one thing, because if there was a put back to Citi under any circumstance, however remote that circumstance might be, you hadn't fully disposed of the risk." And of course, the circumstance was not remote, since billions of dollars in subprime mortgage assets had already come back onto Citigroup's books. Prince told the FCIC that Mahiras had assured him throughout the meetings and the DEFCON calls that the super seniors posed no risk to Citigroup even as the market deteriorated. He added that he had become increasingly uneasy with Mahiras' assessment. Tom had said and said till his last day at work, October 11, "We are never going to lose a penny on these super seniors. We are never going to lose a penny on these super seniors." And as we went along, and I was more and more uncomfortable with these and more uncomfortable with Tom's conclusions on ultimate valuations, that is when I really began to have some very serious concerns about what was going to happen. Despite Prince's concerns, Citigroup remained publicly silent about the additional subprime exposure from the super senior positions and liquidity puts, even as if pre-announced some details of its third quarter earnings on October 1, 2007. On October 11, the rating agencies announced the first in a series of downgrades on thousands of securities. In Prince's view, these downgrades were the precipitating event in the financial crisis. On the same day, Prince restructured the investment bank, a move that led to the resignation of Mahiras. 4 days later, the question of the super senior CDOs and liquidity puts was specifically raised at the Board of Directors Corporate Audit and Risk Management Committee meeting and brought up to the full board. A presentation concluded that total subprime exposure in the investment bank was $13 billion, with an additional $16 billion in direct super senior and $27 billion in liquidity and par puts. Citigroup's total subprime exposure was $56 billion, nearly half of its capital. The calculation was straightforward, but during an analysts' conference call that day, Crittenden omitted any mention of the super senior and liquidity put-related exposure, as he told participants that Citigroup had under $13 billion in subprime exposure. A week later, on Saturday, October 27, Prince learned from Crittenden that the company would have to report subprime-related losses of $8 to $11 billion. On Monday, he tendered his resignation to the board. He later reflected, "When I drove home and Gary called me and told me it wasn't going to be $200 or $300 million, but it was going to be $8 billion, I will never forget that call. I continued driving, and I got home. I walked in the door. I told my wife. I said, here's what I just heard, and if this turns out to be true, I am resigning." On November 4, Citigroup revealed the accurate subprime exposure, now estimated at $55 billion, and it disclosed the subprime-related losses. Though Prince had resigned, he remained on Citigroup's payroll until the end of the year, and the board of directors gave him a generous parting compensation package, $11.9 million in cash and $24 million in stock, bringing his total compensation to $79 million from 2004 to 2007. The SEC later sued Citigroup for its delayed disclosures. To resolve the charges, the bank paid $75 million. The New York Fed would later conclude there was little communications on the extensive level of subprime exposure posed by super senior CDO. Senior management, as well as the independent risk management function charged with monitoring responsibilities, did not properly identify and analyze these risks in a timely fashion. Prince's replacements as chairman and CEO, Richard Parsons and Bikram Pandit, were announced in December. Rubin would stay until January 2009, having been paid more than $150 million from 2000 to 2009 during his tenure at the company, including his role as chairman of the executive committee, a position that carried no operational responsibilities, Rubin told the FCIC. "My agreement with Citi provided that I have no management of personnel or operations." John Reed, former co-CEO of Citigroup, attributed the firm's failures in part to a culture change that occurred when the bank took on Salomon Brothers as part of the 1998 Travelers merger. He said that Salomon executives were used to taking big risks and had a history of making a lot of money but then getting into trouble. End of section 83. Section 84 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 14. AIG's Dispute with Goldman. There Could Never Be Losses. Beginning on July 26, 2007, when Goldman's devilman sent the email that disrupted the vacation of AIG's Alan Frost, the dispute between Goldman and AIG over the need for collateral to back credit default swaps captured the attention of the senior management of both companies. For 14 months, Goldman pressed its case and sent AIG a formal demand letter every single business day. It would pursue AIG relentlessly with demands for collateral based on marks that were initially well below those of other firms, while AIG and its management struggled to come to grips with the burgeoning crisis. The initial collateral call was a shock to AIG's senior executives, most of whom had not even known that the credit default swaps with Goldman contained collateral call provisions. They had known there were enormous exposures, $79 billion, backed in large part by subprime and Alt-A loans in 2007, compared with the parent company's total reported capital of $95.8 billion, but executives said they had never been concerned. The mantra at AIG Financial Products had always been, in any experience, that there could never be losses, Vice President of Accounting Policy Joseph St. Denis said. Then came the first collateral call. St. Denis told FCIC staff that he was so stunned when he got the news that he had to sit down. The collateral provision surprised even Jim Park, the executive who had insisted 18 months earlier that AIG stop writing the swaps. He told the FCIC that rule number 1 at AIG FP was to never post collateral. This was particularly important in the credit default swap business, he said, because it was the only unhedged business that AIG ran. But Jake Sun, the general counsel of the financial product subsidiary who reviewed the swap contracts before they were executed, told the FCIC that the provisions were standard both at AIG and in the industry. Frost, who was the first to learn of the collateral call, agreed and said that other financial institutions also commonly did deals with collateral posting provisions. Pierre Bicotis, the Paris-based head of the AIG Financial Products Enterprise Risk Management Department, told the FCIC that collateral provisions were indeed common in derivatives contracts, but surprising in the super senior CDs contracts, which were considered safe. Insurance supervisors did not permit regulated insurance companies like MBIA and AMBAC to pay out except when the insured entity suffered an actual loss, and therefore those companies were forbidden to post collateral for a decline in the market value or unrealized losses. Because AIG Financial Products was not regulated as an insurance company, it was not subject to this prohibition. As disturbing as the senior AIG executive surprise out the collateral provisions was their firm's inability to assess the validity of Goldman's numbers. AIG Financial Products did not have its own model or otherwise try to value the CDO portfolio that it guaranteed through credit default swaps, nor did it hedge its exposure. June Park explained that hedging was seen as necessary in part because of the mistaken belief that AIG would have to pay counterparties only if holders of the super senior tranches incurred actual losses. He also said that purchasing a hedge from UBS, the Swiss bank, was considered, but that Andrew Forster, the head of credit trading at AIG Financial Products, rejected the idea because it would cost more than the fees that AIG Financial Products was receiving to write the CDS protection. "We're not going to pay a dime for this," Forster told Park. Therefore, AIG Financial Products relied on an actuarial model that did not provide a tool for monitoring the CDO's market value. The model was developed by Gary Gordon, then a finance professor at the University of Pennsylvania's Wharton School, who began working as a consultant to AIG Financial Products in 1996 and was close to its CEO, Joe Cassano. The Gordon model had determined with 99.85% confidence that the owners of the super senior tranches of the CDOs insured by AIG Financial Products would never suffer real economic losses even in an economy as troubled as the worst post-World War II recession. The company's auditors, PricewaterhouseCoopers (PwC), who were apparently also not aware of the collateral requirements, concluded that the risk of default on AIG's portfolio has been effectively removed, and as a result, from a risk management perspective, there are no substantive economic risks in the portfolio, and as a result, the fair value of the liability stream on these positions from a risk management perspective could reasonably be considered to be zero. In speaking with the FCIC, Cassano was adamant that the CDS book was effectively hedged. He said that AIG could never suffer losses on the swaps because the CDS contracts were written only on the super senior tranches of top-rated securities with high attachment points. That is, many securities in the CDOs would have to default in order for losses to reach the super senior tranches, and because the bulk of the exposure came from loans made before 2006, when he thought underwriting standards had begun to deteriorate. Indeed, according to Gene Park, Cassano put a halt to a $150 million hedge in which AIG had taken a short position in the ABX index. As Park explained, Joe stopped that because after we put on the first 150, the market moved against us. We were losing money on the 150 million. Joe said, "You know, I don't think the world is going to blow up. I don't want to spend that money. stop it. Despite the limited market transparency in the summer of 2007, Goldman used what information there was, including information from ABX and other indices, to estimate what it considered to be realistic prices. Goldman also spoke with other companies to see what values they assigned to these securities. Finally, Goldman looked to its own experience. In most cases, when the bank bought credit protection on an investment, it turned around and sold credit protection on the same investment to other counterparties. These deals yielded more price information. Until the dispute with Goldman, AIG relied on the Gordon model, which did not estimate the market value of underlying securities. So Goldman's marks caught AIG by surprise. When AIG pushed back, Goldman almost immediately reduced its July 27 collateral demand from $1.8 billion to $1.2 billion, a move that underscored the difficulty of finding reliable market prices. The new demand was still too high in AIG's view, which was corroborated by third-party marks. Goldman's valued the CDOs between 80 and 97 cents on the dollar, while Merrill Lynch, for example, valued the same securities between 95 and 100 cents. On August 7, Cassano told PwC that there was little or no price transparency and that it was difficult to determine whether collateral calls were indicative of true market levels moving. AIG managers did call other dealers holding similar bonds to check their marks in order to help its case with Goldman, but those marks were not actionable. That is, the dealers would not actually execute transactions at the quoted prices. The above estimated values do not represent actual bids or offers by Merrill Lynch, was the disclaimer in a listing of estimated market values provided by Merrill to AIG. Goldman Sachs disputed the reliability of such estimates. Without being flippant. On August 9, for the first time, AIG executives publicly disclosed the $79 billion in credit default swaps on the super senior tranches of CDOs during the company's second quarter earnings call. They acknowledged that the great majority of the underlying bonds, thus insured $64 billion, were backed by subprime mortgages. Of this amount, $19 billion was written on CDOs predominantly backed by risky BBB-rated collateral. On the call, Cassano maintained that the exposures were no problem. It is hard for us, without being flippant, to even see a scenario within any kind of realm or reason that would see us losing $1 in any of those transactions. He concluded, "We see no issues at all emerging. We see no dollar of loss associated with any of the CDO business. Any reasonable scenario that anyone can draw, and when I say reasonable, I mean a severe recession scenario that you can draw out for the life of the securities." Senior Vice President and Chief Risk Officer Robert Lewis seconded that reassurance. "We believe that it would take declines in housing values to reach depression proportions, along with default frequencies never experienced, before our AAA and AA investments would be impaired." These assurances focused on the risk that actual mortgage defaults would create real economic losses on the company's credit default swap positions. But more important at the time were the other tremendous risks that AIG executives had already discussed internally. No one on the conference call mentioned Goldman's demand for $1.2 billion in collateral, the clear possibility that future, much larger collateral calls could jeopardize AIG's liquidity, or the risk that AIG would be forced to take an enormous mark on its existing book, the concern Forster had noted. The day after the conference call, AIG posted $450 million in cash to Goldman, its first collateral posting since Goldman had requested the $1.2 billion. As Frost wrote to Forster in an August 16, 2007 email, the idea was to get everyone to chill out. For one thing, some AIG executives, including Cassano, had late summer vacations planned. Cassano signed off on the $450 million good faith deposit before leaving for a cycling trip through Germany and Austria. The parties executed a side letter making clear that both disputed the amount. For the time being, two companies that have been doing business together for decades agreed to disagree. On August 14, Frost went to Goldman's office to start the dialogue, which had stalled while Cassano and other key executives were on vacation. 2 days later, Frost wrote to Forster, "Trust me, this is not the last margin call we are going to debate." He was right. By September 11, Société Générale, known more commonly as SocGen, had demanded $40 million in collateral on CDS it had purchased from AIG Financial Products. UBS had demanded $67 million, and Goldman had upped its demand by $300 million. The SocGen demand was based on an 82.5 bid price provided by Goldman, which AIG disputed. Tom Athan, managing director at AIG Financial Products, told Forster that SocGen received marks from GS on positions that would result in big collateral calls, but SG disputed them with JS. Several weeks later, Cassano told AIG Financial Services CFO Elias Habayev that he believed the SocGen margin call had been spurred by Goldman, and that AIG disputed the call and had not heard from SocGen again on that specific call. In the second week of October, the rating agencies announced hundreds of additional downgrades affecting tens of billions of dollars of subprime mortgage-backed securities and CDOs. By November 2, Goldman's demand had almost doubled to $2.8 billion. On November 6, Bensinger, the CFO, informed AIG's audit committee that financial products had received margin calls from 5 counterparties and was disputing every single one. This stance was rooted in the company's continuing belief that Goldman had set values too low. AIG's position was corroborated, at least in part, by the wide disparity in marks from other counterparties. At one point, Merrill Lynch and Goldman made collateral demands on the very same CDS positions, but Goldman's marks were almost 35% lower than Merrill's. Goldman insisted that his marks represented the constantly evolving additional information from our market-making activities, including trades that we had executed, market activity we observed, price changes in comparable securities and derivatives, and the current prices of relevant liquid indices. Trading in the ABX would fall from over 400 trades per week through the end of September 2007 to less than 250 per week in the fourth quarter of 2007. Trading in the Tab X, which focuses on lower-rated tranches, dropped from roughly 50 trades per week through mid-July to almost zero by mid-August. But Cassano believed that the quick reduction in Goldman's first collateral demand from $1.8 billion on July 27 to $1.2 billion on August 2, and the interim agreement on the $450 million deposit confirmed that Goldman was not as certain of its marks as it later insisted. According to Cassano, Michael Sherwood, co-CEO of Goldman Sachs International, told him that Goldman didn't cover ourselves in glory during this period, but that the market's starting to come our Goldman's way. Cassano took those comments as an implicit admission that Goldman's initial marks had been aggressive. More love notes. In mid-August, Forster told Frost in an email that Goldman was pursuing a strategy of aggressively marking down assets to cause maximum pain to their competitors. PricewaterhouseCoopers, which served as auditor for both AIG and Goldman during this period, knew full well that AIG had never before marked these positions to market. In the third quarter of 2007, with the collateral demands piling up, PwC prompted AIG to begin developing a model of its own. Prior to the Goldman margin call, PwC had concluded that compensating controls made up for AIG's not having a model. Among those was notice from counterparties that collateral was due. In other words, one of AIG's risk management tools was to learn of its own problems from counterparties who did have the ability to mark their own positions to market prices and then demand collateral from AIG. The decision to develop a valuation model was not unanimous. In mid-September, Cassano and Forster met with Habayev and others to discuss marking the positions down and actually recording valuation losses in AIG's financial statements. Cassano still thought the valuation process unnecessary because the possibility of defaults was remote. He sent Forster and others emails describing requests from Habayev as more love notes, asking us to go through the same drill of drafting answers. Nevertheless, by October, and in consultation with PwC, AIG started to evaluate the pricing model for subprime instruments developed and used by Moody's. Cassano considered the Moody's model only a gut check until it was fully validated internally. AIG coupled this model with generic CDO tranche data sold by JP Morgan that were considered to be relatively representative of the market. Of course, by this time, and for several preceding months, there was no active market for many of these tranches. Everyone understood that this was not the perfect solution, but AIG and its auditors thought it could serve as an interim step. The makeshift model was up and running in the third quarter. Confident in our marks. On November 7, when AIG reported its third quarter earnings, it disclosed that it was taking a $352 million charge related to its super senior credit default swap portfolio and a further unrealized market valuation loss through October 2007 of approximately $350 million before tax on that portfolio. On a conference call, CEO Sullivan assured investors that the insurance company had active and strong risk management. He said, AIG continues to believe that it is highly unlikely that AIG FP will be required to make payments with respect to these derivatives. Cassano added that AIG had more than enough resources to meet any of the collateral calls that might come in. While the company remained adamant that there would be no realized economic losses from the credit default swaps, it used the newly adopted and adapted Moody's model to estimate the $352 million charge. In fact, PwC had questioned the relevance of the model. It hadn't been validated in advance of the earnings release. It didn't take into account important structural information about the swap contracts, and there were questions about the quality of the data. AIG didn't mention those caveats on the call. 2 weeks later, on November 23, Goldman demanded an additional $3 billion in cash. AIG protested but paid $1.55 billion, bringing the total posted to $2 billion. 4 days later, Cassano circulated a memo from Forster listing the pertinent marks for the securities from Goldman Sachs, Merrill Lynch, Callion, Bank of Montreal, and SocGen. The marks varied widely from as little as 55% of the bond's original value to virtually full value. Goldman's estimated values were much lower than those of other dealers. For example, Goldman valued one CDO, the Dunhill CDO, at 75% of par, whereas Merrill valued it at 95% of par. The Orient Point CDO was valued at 60% of par by Goldman, but at 95% of par by Merrill. Forster suggested that the marks validated AIG's long-standing contention that there is no one dealer with more knowledge than the others or with a better deal flow of trades, and all admit to guesstimating pricing. Cassano agreed. No one seems to know how to discern a market valuation price from the current opaque market environment, Cassano wrote to a colleague. This information is limited due to the lack of participants willing to even give indications on these obligations. 1 week later, Cassano called Sherwood in Goldman's London office and demanded reimbursement of $1.4 billion. He told both AIG and Goldman executives that independent third-party pricing for 70% of the 3,500 securities underlying the CDOs on which AIG FP had written CDS and AIG's own valuation for the other 30% indicated that Goldman's demand was unsupported, therefore Goldman should return the money. Goldman refused and instead demanded more. By late November, there was relative agreement within AIG and with its auditor that the Moody's model incorporated into AIG's valuation system was inadequate for valuing the super senior book, but there was no consensus on how that book should be valued. Inputting generic CDO collateral data into the Moody's model would result in a $1.5 billion valuation loss. Using Goldman's marks would result in a $5 billion valuation loss, which would wipe out the quarter's profits. On November 29, PwC auditors met with senior executives from AIG and the financial product subsidiary to discuss the whole situation. According to PwC meeting notes, AIG reported that disagreements with Goldman continued, and AIG did not have data to dispute Goldman's marks. Forster recalled that Sullivan said that he was going to have a heart attack when he learned that using Goldman's marks would eliminate the quarter's profits. Sullivan told FCIC staff that he did not remember this part of the meeting. AIG adjusted the number, and in doing so it chose not to rely on dealer quotes. James Bridgewater, the financial products executive vice president in charge of models, came up with the solution. Convinced that there was a calculable difference between the value of the underlying bonds and the value of the swap protection AIG had written on those bonds, Bridgewater suggested using a negative basis adjustment, which would reduce the unrealized loss estimate from $5.1 billion, Goldman's figure, to about $1.5 billion. With their auditor's knowledge, Cassano and others agreed that the negative basis adjustment was the way to go. Several documents given to the FCIC by PwC, AIG, and Cassano reflect discussions during and after the November 29 meeting. During the second meeting, at which only the auditor and parent company executives were present, financial products executives including Cassano and Forster did not attend, PwC expressed significant concerns about risk management specifically related to the evaluation of the credit default swap portfolio as well as to the company's procedures in posting collateral. AIG Financial Products had paid out $2 billion without active involvement from the parent company's enterprise risk management group. Another issue was the way in which AIG-FP had been managing the SS Super Senior valuation process, saying PwC will not get any more information until after the Investor Day presentation. The auditors laid out their concerns about conflicting strategies pursued by AIG subsidiaries. Notably, the securities lending subsidiary had been purchasing mortgage-backed securities using cash raised by lending securities that AIG held on behalf of its insurance subsidiaries. From the end of 2006 through September 2007, its holdings rose from $69 billion to $88 billion. Meanwhile, Financial Products, acting on its own analysis, had decided in 2006 to begin pulling back on writing credit default swaps on CDOs. In PwC's view, in allowing one subsidiary to increase exposure to subprime while another subsidiary worked to exit the market entirely, the parent company's risk management failed. PwC also said that the company's second quarter of 2007 financial disclosures would have been changed if the exposure of the securities lending business had been known. The auditors concluded that these items together raised control concerns around risk management, which could be a material weakness. Kevin Maginn, AIG's chief credit officer, shared these concerns about the conflicting strategies. In a November 20, 2007 email, Maginn wrote, "All units were apprised regularly of our concerns about the housing market. Some listened and responded. Others simply chose not to listen and then, to add insult to injury, not to spot the manifest signs." He concluded that this was akin to Nero playing the fiddle while Rome burns. On the opposite side, Sullivan insisted to the FCIC that the conflicting strategies in the securities lending business and at AIG Financial Products simply revealed that the two subsidiaries adopted different business models and did not constitute a risk management failure. On December 5, 6 days after receiving PwC's warnings, Sullivan boasted on another conference call about AIG's risk management systems and the company's oversight of the subprime exposure. "The risk we have taken in the U.S. residential housing sector is supported by sound analysis and a risk management structure. We believe the probability that it will sustain an economic loss is close to zero. We are confident in our marks and the reasonableness of our valuation methods." Charlie Gates, an analyst at Credit Suisse, a Swiss bank, asked directly about valuation and collateral disputes with counterparties to which AIG had alluded in its third quarter financial results. Cassano replied, "We have from time to time gotten collateral calls from people, and then we say to them, 'Well, we don't agree with your numbers,' and they go, 'Oh,' and they go away. And you say, 'Well, what was that?' It's like a drive-by in a way. And the other times they sat down with us, and none of this is hostile or anything. It's all very cordial, and we sit down and we try to find the middle ground and compare where we are." Cassano did not reveal the $2 billion collateral posted to Goldman, the several $100 million posted to other counterparties, and the daily demands from Goldman and the others for additional cash. The analysts and investors on the call were not informed about the negative basis adjustment used to derive the announced $1.5 billion maximum potential exposure. Investors therefore did not know that AIG's earnings were overstated by $3.6 billion, and they would not learn that information until February 11, 2008. Material weakness. By January 2008, AIG still did not have a reliable way to determine the market price of the securities on which it had written credit protection. Nevertheless, on January 16, Cassano sent an email to Michael Sherwood and CFO David Binyar at Goldman demanding that they return $1.1 billion of the $2 billion posted. He attached a spreadsheet showing that AIG valued many securities at par, as if there had been no decline in their value. That was simply not credible, Goldman executives told the FCIC. Meanwhile, Goldman had by then built up $1.45 billion in protection by purchasing credit default swaps on AIG to cover the difference between the amount of collateral they had demanded and the amount that AIG had paid. On February 6, 2008, PwC auditors met with Robert Willemstad, the chairman of AIG's board of directors. They informed him that the negative basis adjustment used to reach the $1.5 billion estimate disclosed on the December 5 investor call had been improper and unsupported, and was a sign that controls over the AIG financial products super senior credit default swap portfolio valuation process and oversight thereof were not effective. PwC concluded that this deficiency was a material weakness as of December 31, 2007. In other words, PwC would have to announce that the numbers AIG had already publicly reported were wrong. Why the auditors waited so long to make this pronouncement is unclear, particularly given that PwC had known about the adjustment in November. In the meeting with Willemstad, the auditors were broadly critical of Sullivan. Bensinger, whom they deemed unable to compensate for Sullivan's weaknesses, and Lewis, who might not have the skill sets to run an enterprise-wide risk management department. The auditors concluded that a lack of leadership, unwillingness to make difficult decisions regarding financial products in the past, and inexperience in dealing with these complex matters had contributed to the problem. Despite PwC's findings, Sullivan received $107 million over 4 years in compensation from AIG, including a severance package of $18 million. When asked about these figures at a FCIC hearing, he said, "I have no knowledge or recollection of those numbers whatsoever, sir. I certainly don't recall earning that amount of money, sir." The following day, PwC met with the entire AIG audit committee and repeated the analysis presented to Willemstad. The auditors said they could complete AIG's audit, but only if Cassano did not interfere in the process. Retaining Cassano was a management judgment, but the culture needed to change at FP. On February 11, AIG disclosed in an SEC filing that its auditor had identified the material weakness, acknowledging that it had reduced its December valuation loss estimates by $3.6 billion, that is, the difference between the estimates of $5.1 billion and $1.5 billion because of the unsupportable negative basis adjustment. The rating agencies responded immediately. Moody's and S&P announced downgrades, and Fitch placed AIG on ratings watch negative, suggesting that a future downgrade was possible. AIG's stock declined 12% for the day, closing at $44.74. At the end of February, Goldman held $2 billion in cash collateral, was demanding an additional $2.5 billion, and had upped to $2.15 billion its CDS protection against an AIG failure. On February 28, AIG disappointed Wall Street again, this time with dismal fourth quarter and fiscal year 2007 earnings. The company reported a net loss of $5.29 billion, largely due to $11.12 billion in valuation losses related to the super senior CDO credit default swap exposure and more than $2.6 billion in losses relating to the securities lending business mortgage-backed purchases. Along with the losses, Sullivan announced Cassano's retirement, but the news wasn't all bad for the former financial products chief. He made more than $300 million from the time he joined AIG Financial Products in January of 1987 until his retirement in 2008, including a $1 million a month consulting agreement after his retirement. In March, the Office of Thrift Supervision, the federal regulator in charge of regulating AIG and its subsidiaries, downgraded the company's composite rating from a 2, signifying that AIG was fundamentally sound, to a 3, indicating moderate to severe supervisory concern. The OTS still judged the threat to overall viability as remote. It did not schedule a follow-up review of the company's financial condition for another 6 months. By then, it would be too late. End of section 84. Section 85 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 14, Federal Reserve. The discount window wasn't working. Over the course of the fall, the announcements by Citigroup, Merrill, and others made it clear that financial institutions were going to take serious losses from their exposures to the mortgage market. Stocks of financial firms fell sharply. By the end of November, the S&P Financials Index had lost more than 16% for the year. Between July and November, asset-backed commercial paper declined about 30%, which meant that those assets had to be sold or funded by other means. Investment banks and other financial institutions faced tighter funding markets and increasing cash pressures. As a result, the Federal Reserve decided that its interest rate cuts and other measures since August had not been sufficient to provide liquidity and stability to financial markets. The Fed's discount window hadn't attracted much bank borrowing because of the stigma attached to it. The problem with the discount window is that people don't like to use it because they view it as a risk that they will be viewed as weak. William Dudley, then head of the Capital Markets Group at the New York Fed and currently its president, told the FCIC. Banks and thrifts prefer to draw on other sources of liquidity. In particular, during the second half of 2007, the Federal Home Loan Banks, which are government-sponsored entities that lend to banks and thrifts, accepting mortgages as collateral, boosted their lending by $235 billion to $875 billion, a 37% increase when the securitization market froze. Between the end of March and the end of December 2007, Washington Mutual, the largest thrift, increased its borrowing from the Federal Home Loan Banks from $28 billion to $73 billion. Countrywide increased its borrowing from $27 billion to $48 billion. Bank of America increased its borrowing from $38 billion to $56 billion. The Federal Home Loan Banks could thus be seen as the lender of next to last resort for commercial banks and thrifts, the Fed being the last resort. In addition, the loss of liquidity in the financial sector was making it more difficult for businesses and consumers to get credit, raising the Fed's concerns. From July to October, the percentage of loan officers reporting tightening standards on prime mortgages increased from 15% to about 40%. Over that time, the percentage of loan officers reporting tightening standards on loans to large and mid-sized companies increased from 8% to 19%, its highest level since 2003. The Federal Reserve pursued a whole slew of non-conventional policies. Very creative measures when the discount window wasn't working as hoped. Freddie, a Fed governor from 2006 to 2008, told the FCIC. These actions were very aggressive and they were extremely controversial. The first of these measures, announced on December 12, was the creation of the Term Auction Facility, TAF. The idea was to reduce the discount window stigma by making the money available to all banks at once through a regular auction. The program had some success, with banks borrowing $40 billion by the end of the year. Over time, the Fed would continue to tweak the TAF auctions, offering more credit and longer maturities. Another Fed concern was that banks and others who did have cash would hoard it. Hoarding meant foreign banks had difficulty borrowing in dollars and were therefore under pressure to sell dollar-denominated assets such as mortgage-backed securities. Those sales and fears of more sales to come weighed on the market prices of U.S. securities. In response, the Fed and other central banks around the world announced, also on December 12, new currency swap lines to help foreign banks borrow dollars. Under this mechanism, foreign central banks swapped currencies with the Federal Reserve, local currency for U.S. dollars, and lent these dollars to foreign banks. During the crisis, the U.S. banks were very reluctant to extend liquidity to European banks, Dudley said. Central banks had used similar arrangements in the aftermath of the 9/11 attacks to bolster the global financial markets. In late 2001, the swap lines totaled $88 billion. During the financial crisis 7 years later, they would reach $580 billion. The Fed hoped that the TAF and the swap lines would reduce strains on short-term money markets, easing some of the funding pressure on other struggling participants such as investment banks. Importantly, it wasn't just the commercial banks and thrifts, but the broader financial system that concerned the Fed, Dudley said. Historically, the Federal Reserve has always tended to supply liquidity to the banks with the idea that liquidity provided to the banking system can be lent on to solvent institutions in the non-bank sector. What we saw in this crisis was that didn't always take place to the extent that it had in the past. I don't think people going in really had a full understanding of the complexity of the shadow banking system, the role of structured investment vehicles and conduits, the backstops that banks were providing SIV conduits, either explicitly or implicitly. Burdened with capital losses and desperate to cover their own funding commitments, the banks were not stable enough to fill the void even after the Fed lowered interest rates and began the TAF auctions. In January 2008, the Fed cut rates again, and then again, twice within 2 weeks, a highly unusual move that brought the federal funds rate from 4.25% to 3%. The Fed also started plans for a new program that would use its emergency authority, the Term Security Lending Facility, though it wasn't launched until March. The TLSF was more a view that the liquidity that we were providing to the banks through the TAF was not leading to a significant diminishment of financial pressures elsewhere, Dudley told the FCIC. So maybe we should think about bypassing the banking system and try to come up with a vehicle to provide liquidity support to the primary dealer community more directly. On March 7, the Fed increased the total available in each of the biweekly TAF auctions from $30 billion to $50 billion and guaranteed at least that amount for 6 months. The Fed also liberalized its standard for collateral. Primary dealers, mainly the investment banks and the broker-dealer affiliates of larger commercial banks, could post that of government-sponsored enterprises, including GSE mortgage-backed securities, as collateral. The Fed expected to have $100 billion in such loans outstanding at any given time. Also, at this time, the U.S. Central Bank began contemplating a step that was revolutionary, a program that would allow investment banks, institutions over which the Fed had no supervisory or regulatory responsibility, to borrow from the discount window on terms similar to those available to commercial banks. End of section 85. Section 86 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 14. Monoline Insurers. We Never Expected Losses. Meanwhile, the rating agencies continued to downgrade mortgage-backed securities and CDOs through 2007. By January 2008, as a result of the stress in the mortgage market, S&P had downgraded 3,389 tranches of residential mortgage-backed securities and 1,383 tranches from 420 CDOs. MBIA and AMBAC, the two largest monoline insurers, had taken on a combined $265 billion of guarantees on mortgage securities and other structured products. Downgrades on the products that they insured brought the financial strength of these companies into question. After conducting stress analysis, S&P estimated in February 2008 that AMBAC would need up to $400 million in capital to cover potential losses on structured products. Such charges would affect the monoline's own credit ratings, which in turn could lead to more downgrades of the products they had guaranteed. Like many of the monolines, ACA, the smallest of them, kept razor-thin capital, less than $700 million, against its obligations that included $69 billion in credit default swaps on CDOs. In late 2007, ACA reported a net loss of $1.7 billion, almost entirely due to credit default swaps. This was news. The notion of zero loss tolerance was central to the viability of the monoline business model, and they and various stakeholders, the rating agencies, investors, and monoline creditors, had traditionally assumed that the monolines never would have to take a loss. As Alan Rosman, CEO of ACA, told FCIC staff, "We never expected losses. We were providing hedges on market volatility to institutional counterparties. We were positioned, we believed, to take the volatility because we didn't have to post collateral against the changes in market value to our counterparty, number one. Number two, we were told by the rating agencies that rated us that the mark-to-market variation was not important to our rating from a financial strength point of view at the insurance company." In early November, the SEC called the growing concern about Merrill's use of the monolines for hedging a concern that we also share. The large Wall Street firms attempted to minimize their exposure to the monolines, particularly ACA. On December 19, S&P downgraded ACA to junk status, rating the company CCC, which was fatal for a company whose CEO said that its rating is the franchise. Firms like Merrill Lynch would get virtually nothing for the guarantees they had purchased from ACA. Despite the stresses in the market, the SEC saw the monoline problems as largely confined to ACA. A January 2008 internal SEC document said, "While there is a clear sentiment that capital rising will need to continue, the fact that the guarantors, with the exception of ACA, are relatively insulated from liquidity-driven failures provides hope that events in this sector will unfold in a manageable manner." Still, the rating agencies told the monolines that if they wanted to retain their stellar ratings, they would have to raise capital. MBIA and AMBAC ultimately did raise $1.65 billion and $1.5 billion respectively. Nonetheless, S&P downgraded both to AA in June 2008. As the crisis unfolded, most of the monolines stopped writing new coverage. The subprime contagion spread through the monolines and into a previously unimpaired market, municipal bonds. The path of these falling dominoes is easy to follow. In anticipation of the monoline downgrades, investors devalued the protection the monolines provided for other securities, even those that had nothing to do with the mortgage-backed markets, including a set of investments known as auction rate securities, or ARS. An ARS is a long-term bond whose interest rate is reset at regularly scheduled auctions held every 1 to 7 weeks. Existing investors can choose to rebid for the bonds and new investors can come in. The debt is frequently municipal bonds. As of December 13, 2007, state and local governments had issued $165 billion in ARS, accounting for half of the $330 billion market. The other half were primarily bundles of student loans and debt of non-profits such as museums and hospitals. The key point: these entities wanted to borrow long-term but get the benefit of lower short-term rates, and investors wanted to get the safety of investing in these securities without tying up their money for a long time. Unlike commercial paper, this market had no explicit liquidity backstop from a bank, but there was an implicit backstop. Often, if there were not enough new buyers to replace the previous investors, the dealers running these auctions, including firms like UBS, Citigroup, and Merrill Lynch, would step in and pick up the shortfall. Because of these interventions, there were only 13 failures between 1984 and early 2007 in more than 100,000 auctions. Dealers highlighted those minuscule failure rates to convince clients that ARS were very liquid, short-term instruments even in times of stress. However, if an auction did fail, the previous ARS investors would be obligated to retain their investments. In compensation, the interest rates on the debt would reset, often much higher, but investors' funds would be trapped until new investors or the dealer stepped up or the borrower paid off the loan. ARS investors were typically very risk-averse and valued liquidity, and so they were willing to pay a premium for guarantees on the ARS investments from monolines. It necessarily followed that the monoline's growing problems in the latter half of 2007 affected the ARS market. Fearing that the monolines would not be able to perform under guarantees, investors fled. The dealers' interventions were all that kept the market going, but the stress became too great. With their own problems to contend with, the dealers were unable to step in and ensure successful auctions. In February, en masse, they pulled up stakes. The market collapsed almost immediately. On February 14, in one of the starkest market dislocations of the financial crisis, 80% of the ARS auctions failed. The following week, 67% failed. Hundreds of billions of dollars were trapped by ARS instruments as investors were obligated to retain their investments. And retail investors, individuals investing less than $1 million, small businesses, and charities, constituted more than $110 billion of this $330 billion market. Moreover, investors who chose to remain in the market demanded a premium to take on the risk. Between investor demands and interest rate resets, countless governments, infrastructure projects, and nonprofits on tight budgets were slammed with interest rates of 10% or higher. Problems in the ARS market cost Georgetown University, a borrower, $6 million. New York State was stuck with interest rates that soared from about 3.5% to more than 14% on $4 billion of its debt. The Port Authority of New York and New Jersey saw the interest rate on its debt jump from 4.3% to 20% in a single week in February. In 2008 alone, the SEC received more than 1,000 investor complaints regarding the failed ARS auctions. Investors argued that brokers had led them to believe that ARS were safe and liquid, essentially the equivalent of money market accounts, but with the potential for a slightly higher interest rate. Investors also reported that the frozen market blocked their access to money for short-term needs such as medical expenses, college tuition, and, for some small businesses and charities, payroll. By 2009, the SEC had settled with financial institutions including Bank of America, RBC Capital Markets, and Deutsche Bank to resolve charges that the firms misled investors. As a result, these and other banks made more than $50 billion available to pay off tens of thousands of ARS investors. End of section 86. Section 87 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Mario Pineda. Commission conclusions on Chapter 14. The Commission concludes that some large investment banks, bank holding companies, and insurance companies, including Merrill Lynch, Citigroup, and AIG, experienced massive losses related to the subprime mortgage market because of significant failures of corporate governance, including risk management. Executive and employee compensation systems at these institutions disproportionately rewarded short-term risk-taking. The regulators, the Securities and Exchange Commission for the large investment banks, and the banking supervisors for the bank holding companies and AIG failed to adequately supervise their safety and soundness, allowing them to take inordinate risk in activities such as non-prime mortgage securitization and over-the-counter OTC derivatives dealing, and to hold inadequate capital and liquidity. End of section 87.
Section 88 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 15, March 2008, The Fall of Bear Stearns, Intro. After its hedge funds failed in July 2007, Bear Stearns faced more challenges in the second half of the year. Taking out the repo lenders to the high-grade fund brought nearly $1.6 billion in subprime assets onto Bear's books, contributing to a $1.9 billion write-down on mortgage-related assets in November. That prompted investors to scrutinize Bear Stearns' finances. Over the fall, Bear's repo lenders, mostly money market mutual funds, increasingly required Bear to post more collateral and pay higher interest rates. Then, in just 1 week in March 2008, a run by these lenders, hedge fund customers, and derivatives counterparties led to Bear's having to be taken over in a government-backed rescue. Mortgage securitization was the biggest piece of Bear Stearns' most profitable division, its fixed income business, which generated 45% of the firm's total revenues. Growing fast was the Global Client Services division, which included Bear's prime brokerage operation. Bear Stearns was the second biggest prime broker in the country with a 21% market share in 2006, trailing Morgan Stanley's 23%. This business would figure prominently in the crisis. In mortgage securitization, Bear followed a vertically integrated model that made money at every step, from loan origination through securitization and sale. It both acquired and created its own captive originators to generate mortgages that Bear bundled, turned into securities, and sold to investors. The smallest of the 5 large investment banks, it was still a top 3 underwriter of private label mortgage-backed securities from 2000 to 2007. In 2006, it underwrote $36 billion in collateralized debt obligations of all kinds, more than double its 2005 figure of $14.5 billion. The total included $6.3 billion in CDOs that included mortgage-backed securities, putting it in the top 12 in that business. As was typical on Wall Street, the company's view was that Bear was in the moving business, not the storage business. That is, it sought to provide services to clients rather than take on long-term exposures of its own. Bear expanded its mortgage business despite evidence that the market was beginning to falter, as did other firms such as Citigroup and Merrill. As early as May 2006, Bear had lost $3 million relating to defaults on mortgages, which occurred within 90 days of origination, which had been rare in the decade. But Bear persisted, assuming the setback would be temporary. In February 2007, Bear even acquired Encore Credit, its third captive mortgage originator in the United States, doubling its capacity. The purchase was consistent with Bear's contrarian business model, buying into distressed markets and waiting for them to turn around. Only a month after the purchase of Encore, the Securities and Exchange Commission wrote in an internal report, Bear's mortgage business incurred significant market risk losses on its Alt-A mortgage assets. The losses were small, but the SEC reported that risk managers noted that these events reflect a more rapid and severe deterioration in collateral performance than anticipated in ex-ante models of stress events. End of section 88. Section 89 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 15, I requested some forbearance. Vacationing on Nantucket Island when the 2 Bear-sponsored hedge funds declared bankruptcy on July 31, 2007, former Bear Treasurer Robert Upton anticipated that the rating agencies would downgrade the company, raising borrowing costs. Bear funded much of its operations borrowing short-term in the repo market. It borrowed between $50 and $70 billion overnight. Even a threat of a downgrade by a rating agency would make financing more expensive starting the next morning. Investors, analysts, and the credit rating agencies closely scrutinized leverage ratios available at the end of each quarter. By November 2007, Bear's leverage ratio had reached nearly 38 to 1. By the end of 2007, Bear's Level 3 assets, illiquid assets difficult to value and to sell, were 269% of its tangible common equity. Thus, writing down these illiquid assets by 37% would wipe out tangible common equity. At the end of each quarter, Bear would lower its leverage ratio by selling assets, only to buy them back at the beginning of the next quarter. Bear and other firms booked these transactions as sales, even though the assets didn't stay off the balance sheet for long. in order to reduce the amount of the company's assets and lower its leverage ratio. Bear's former treasurer Upton called the move window dressing and said it ensured that creditors and rating agencies were happy. Bear's public filings reflected this to some degree. For example, its 2007 annual report said the balance sheet was approximately 12% lower than the average month-end balance over the previous 12 months. To forestall a downgrade, Upton spoke with the three main rating agencies, Moody's, Standard & Poor's, and Fitch, in early August. Several times in 2007, including April 9 and June 22, S&P had confirmed Bear's strong ratings, noting in April that Bear's risk profile is relatively conservative, and strong senior management oversight and a strong culture throughout the firm are the foundation of Bear's risk management process. On June 22, Moody's had also confirmed its A1 rating, and Fitch had confirmed its stable outlook. Now in early August, Upton provided them information about Bear and argued that management had learned its lesson about governance and risk management from the failure of the two hedge funds and was going to rely less on short-term unsecured funding and more on the repo market. Bear and other market participants did not foresee that Bear's own repo lenders might refuse to lend against risky mortgage assets and eventually not even against treasuries. I requested some forbearance from S&P, Upton told the FCIC. He did not get it. On August 3rd, just 3 days after the two Bear Stearns hedge funds declared bankruptcy, S&P highlighted the funds, Bear's mortgage-related investments, and its relatively small capital base as it placed Bear on a negative outlook. Asked how he felt about the rating agency's actions, Jimmy Kane, Bear's CEO until 2008, said, "A negative outlook can touch a number of parts of your business. It was like having a beautiful child and they have a disease of some sort that you never expect to happen, and it did. How did I feel? Lousy." To reassure investors that no more shoes would drop, Bear invited them on a conference call that same day. The call did not go well. By the end of the day, Bear's stock slid 6% to $108.35, 36% below its all-time high of $169.61 reached earlier in 2007. End of section 89. Section 90 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 15, We Were Suitably Skeptical. On Sunday, August 5th, 2 days after the conference call, Bear had another opportunity to make its case, this time with the SEC. The two SEC supervisors who visited the company that Sunday were Michael Macchiaroli and Matthew Eichner, respectively Associate Director and Assistant Director of the Division of Market Regulation. The regulators reviewed Bear's exposures to the mortgage market, including the $13 billion in adjustable rate mortgages on the firm's books that were waiting to be securitized. Bear executives gave assurances that inventory would shrink once investors returned in September from their retreats in the Hamptons. Obviously, regulators are not supposed to listen to happy talk and go away smiling, Eichner told the FCIC. $13 billion in ARMs is no joke. Still, Eichner did not believe the Bear executives were being disingenuous. He thought they were just emphasizing the upside. Alan Schwartz, the co-president who later succeeded Jimmy Kane as CEO, and Thomas Morano, head of Global Mortgages and Asset-Backed Securities, seemed unconcerned. But other executives were leery. Wendy de Monschau, the head of proprietary trading, urged Morano to trim the mortgage portfolio, as did Stephen Meyer, the co-head of stock sales and trading. According to Chief Risk Officer Michael Alex, former chairman Alan Greenberg would say the best hedge is a sale. Bear finally reduced the portfolio from $56 billion in the third quarter of 2007 to $46.1 billion in the fourth quarter, but it was too little, too late. That summer, the SEC felt Bear's liquidity was adequate for the immediate future, but supervisors were suitably skeptical, Eichner insisted. After the August 5th meeting, the SEC required that Bear Stearns report daily on Bear's liquidity. However, Eichner admitted that he and his agency had grossly underestimated the possibility of a liquidity crisis down the road. Every weeknight, Upton updated the SEC on Bear's $400 billion balance sheet, with specifics on repo and commercial paper. On September 27th, Bear Stearns raised approximately $2.5 billion in unsecured 10-year bonds. The reports slowed to once a week. The SEC's Inspector General later criticized the regulators, writing that they did not push Bear to reduce leverage or to make any efforts to limit Bear Stearns' mortgage securities concentration, despite awareness that risk management of mortgages at Bear Stearns had numerous shortcomings, including lack of expertise by risk managers in mortgage-backed securities and persistent understaffing, a proximity of risk managers to traders suggesting a lack of independence, turnover of key personnel during times of crisis, and the inability or unwillingness to update models to reflect changing circumstances. Michael Halloran, a senior advisor to SEC Chairman Christopher Cox, told the FCIC the SEC had ample information and authority to require Bear Stearns to decrease leverage and sell mortgage-backed securities as other financial institutions were doing. Halloran said that as early as the first quarter of 2007, he had asked Eric Seary, in charge of the SEC's Consolidated Supervised Entities Program, about Bear Stearns and Lehman Brothers. Why can't we make them reduce risk? According to Halloran, Seary said the SEC's job was not to tell the banks how to run their companies, but to protect their customers' assets. End of Section 90. Section 91 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 15, Turn into a Death Spiral. In August, after the rating agencies revised their outlook on Bear, Kane tried to obtain lines of credit from Citigroup and JP Morgan. Both banks acknowledged Bear had always been a very good customer and maintained they were interested in helping. We wanted to try to be belts and suspenders, said CFO Samuel Molinaro, as Bear attempted both to obtain lines of credit with banks and to reinforce traditional sources of short-term liquidity, such as money market funds. But Kane told the FCIC nothing happened. Why the large banks were not more willing to participate and provide lines during that period of time, I can't tell you, Molinaro said. A major money market fund manager, Federated Investors, had decided on October 1 to drop Bear Stearns from its list of approved counterparties for unsecured commercial paper, illustrating why unsecured commercial paper was traditionally seen as a riskier lifeline than repo. Throughout 2007, Bear Stearns reduced its unsecured commercial paper from $20.7 billion at the end of 2006 to only $3.9 billion at the end of 2007, and replaced it with secured repo borrowing, which rose from $69 billion to $102 billion. But Bear Stearns' growing dependence on overnight repo would create a different set of problems. The tri-party repo market used two clearing banks, JP Morgan and BNY Mellon. During every business day, these clearing banks return cash to lenders, take possession of borrowers' collateral, essentially keeping it in escrow, and then lend their own cash to borrowers during the day. This is referred to as unwinding, the repo transaction. It allows borrowers to change the assets posted as collateral every day. The transaction is then rewound at the end of the day when the lenders post cash to the clearing banks in return for the new collateral. The little regulated tri-party repo market had grown from $800 billion in average daily volume in 2002 to $1.7 trillion in 2005, $2.4 trillion in 2007, and $2.8 trillion by early 2008. It had become a very deep and liquid market. Even though most borrowers rolled repo overnight, it was also considered a very safe market because transactions were over-collateralized, loans were made for less than the collateral was worth. That was a general view before the onset of the financial crisis. As Bear increased its tri-party repo borrowing, it became more dependent on JP Morgan, the clearing bank. A risk that was little appreciated before 2007 was that JP Morgan and BNY Mellon could face large losses if a counterparty such as Bear defaulted during the day. Essentially, JP Morgan served as Bear's daytime repo lender. Even long-term repo loans have to be unwound every day by the clearing bank, if not by the lender. Seth Carpenter, an officer at the Federal Reserve Board, compared it to a mortgage that has to be refinanced every week. Imagine that your mortgage is only a week. Instead of a 30-year mortgage, you've got a 1-week mortgage. If everything's going fine, you get to the end of the week, you go out and you refinance that mortgage because you don't have enough cash on hand to pay off the whole mortgage. And then you get to the end of another week and you refinance that mortgage. And that's, for all intents and purposes, what repos are like for many institutions. During the fall, Federated Investors, which had taken Bear Stearns off its list of approved commercial paper counterparties, continued to provide secured repo loans. Fidelity Investments, another major lender, limited its overall exposure to Bear and shortened the maturities. In October, State Street Global Advisors refused any repo lending to Bear other than overnight. Often, backing Bear's borrowing were mortgage-related securities, and of these, $17.2 billion, more than Bear's equity, were Level 3 assets. In the fourth quarter of 2007, Bear Stearns reported its first quarterly loss, $379 million. Still, the SEC saw no evidence of any deterioration in the firm's liquidity position following the release and related negative press coverage. The SEC concluded Bear Stearns' liquidity pool remained stable. In the fall of 2007, Bear's board had commissioned the consultant Oliver Wyman to review the firm's risk management. The report, Risk Governance Diagnostic, Recommendations and Case for Economical Capital Development, was presented on February 5, 2008, to the Management Committee. Among its conclusions, risk assessment was infrequent and ad hoc, and hampered by insufficient and poorly aligned resources. Risk managers were not effectively positioned to challenge front office decisions, and risk management was understaffed and considered a low priority. Schwartz told the FCIC the findings did not indicate substantial deficiencies. He wasn't looking for positive feedback from the consultants because the Wyman report was meant to provide a roadmap of what the gold standard in risk management would be. In January 2008, before the report was completed, Kane resigned as CEO after receiving $93.6 million in compensation from 2004 through 2007. He remained as non-executive chairman of the board. Some senior executives sharply criticized him and the board. Thomas Marano told the FCIC that Kane played a lot of golf and bridge. Speaking of the board, Paul Friedman, a former senior managing director at Bear Stearns, said, "I guess because I'd never worked at a firm with a real board, it never dawned on me that at some point somebody would have or should have gotten the board involved in all of this." Although he told the FCIC that he made these comments in anger and frustration in the wake of Bear's failure. In its final report on Bear, the corporate library, which researches and rates firms for corporate governance, gave the company a D, reflecting a high degree of governance risk, resulting from high levels of concern related to the board and compensation. When asked if he had made mistakes while at Bear Stearns, Kane told the FCIC, "I take responsibility for what happened. I'm not going to walk away from the responsibility." At Bear, compensation was largely based on the return on equity in a given year. For senior executives, about half of each bonus was paid in cash, and about half in restricted stock that vested over 3 years and had to be held for 5. The formula for the size of each year's compensation pool was determined by a subcommittee of the board. Stockholders approved the performance compensation plan and capital accumulation plan for senior managing directors. Kane told the FCIC he set his own compensation and the compensation for all 5 members of the executive committee. According to Kane, no one, including the board, questioned his decisions. For 2007, even with its losses, Bear Stearns paid out 58% of revenues in compensation. Alex, who sat on the compensation committee, told FCIC staff the firm typically paid 50%, but that the percentage increased in 2007 because revenues fell. If management had lowered compensation proportionally, he said many employees might have quit. Base salaries for senior managers were capped at $250,000, with the remainder of compensation a discretionary mix of cash, restricted stock, and options. From 2000 through 2008, the top 5 executives at Bear Stearns took home over $326.5 million in cash and over $1.1 billion from stock sales, for more than a total of $1.4 billion. This exceeded the annual budget for the SEC. Alan Schwartz, who took over as CEO after Kane and had been a leading proponent of investing in the mortgage sector, earned more than $87 million from 2004 to 2007. Warren Spector, the co-president responsible for overseeing the two hedge funds that had failed, received more than $98 million during the same period. Although Spector was asked to resign, Bear never asked him to return any money. In 2006, Kane, Schwartz, and Spector each earned more than 10 times as much as Alex, the chief risk officer. Kane was out, Schwartz was in, and Bear Stearns continued hanging on in early 2008. Bear was still able to fund its balance sheet through repo loans, though the interest rates the firm had to pay had increased. Morano said he worried this increased cost would signal to the market that Bear was distressed, which could make our problems turn into a death spiral. End of section 91. Section 92 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 15, Duty to Protect Their Investors. On Wednesday, January 30th, 2008, Treasurer Upton reported an internal accounting error that showed Bear Stearns to have less than $5 billion in liquidity, triggering a report to the SEC. While the company identified the error, the SEC reinstituted daily reporting by the company of its liquidity. Lenders and customers were more and more reluctant to do business with the company. On February 15th, Bear Stearns had $36.7 billion in mortgages, mortgage-backed securities, and asset-backed securities on its balance sheet, down almost $10 billion from November. Nearly $26 billion were subprime or Alt-A mortgage-backed securities and CDOs. The hedge funds that were clients of Bear's prime brokerage services were particularly concerned that Bear would be unable to return their cash and securities. Lou Lebedin, the head of Bear's prime brokerage, told the FCIC that hedge fund clients occasionally inquired about the bank's financial condition in the latter half of 2007, but that such inquiries picked up at the beginning of 2008, particularly as the cost increased of purchasing credit default swap protection on Bear. The inquiries became withdrawals. Hedge funds started taking their business elsewhere. They felt there were too many concerns about us and felt that this was a short-term move, Lebedin said. Often they would tell us they'd be happy to bring the business back, but that they had the duty to protect their investors. Renaissance Technologies, one of Bear's biggest prime brokerage clients, pulled out all of its business. By April, Lebedin's prime brokerage operation would be holding $90 billion in assets under management, down more than 40% from $160 billion in January. Nonetheless, during the week of March 3rd, when SEC staff inspected Bear's liquidity pool, they identified no significant issues. The SEC found Bear's liquidity pool ranged from $18 billion to $20 billion. Bear opened for business on Monday, March 10th, with approximately $18 billion in cash reserves. The same day, Moody's downgraded 15 mortgage-backed securities issued by Bear Stearns Alt-A Trust, a special purpose entity. News reports on the downgrades carried abbreviated headlines stating, Moody's downgrades Bear Stearns, Upton said. Rumors flew and counterparties panicked. Bear's liquidity pool began to dry up, and the SEC was now concerned that Bear was being squeezed from all directions. While everything rolled during the day, that is, Bear's repo lenders renewed their commitments, SEC officials worried that this would probably not continue. On Tuesday, the Fed announced it would lend to investment banks and all other primary dealers. The Term Securities Lending Facility, TSLF, would make available up to $200 billion in Treasury securities, accepting as collateral GSE mortgage-backed securities and non-GSE mortgage-backed securities rated AAA. The hope was that lenders would lend to investment banks if the collateral was Treasuries rather than other highly rated but now suspect assets, such as mortgage-backed securities. The Fed also announced it would extend loans from overnight to 28 days, giving investment banks an added breather from the relentless need to unwind repos every morning. With the TSLF, the Fed would be setting a new precedent by extending emergency credit to institutions other than commercial banks. To do so, the Federal Reserve Board was required under Section 13.3 of the Federal Reserve Act To determine that there were unusual and exigent circumstances, the Fed had not invoked its Section 13.3 authority since the Great Depression. It was the Fed's first use of the authority since Congress had expanded the language of the Act in 1991 to allow the Fed to lend to investment banks. The Fed was taking the unusual step of declaring its willingness to soon open its checkbook to institutions it did not regulate and whose financial condition it had never examined. But the Fed would not launch the TSLF until March 27th, more than 2 weeks later, and it was not clear that Bear could last that long. The following day, Jim Embersit of the Federal Reserve Board checked on Bear's liquidity with the SEC. The SEC said Bear had $12.5 billion in cash, down from about $18 billion at the start of the week, and was able to finance all its bank loans and most of its equity securities through the repo market. He summarized, "The SEC indicates that no notable losses have been sustained and that the capital position of the firm is fine." Derivatives counterparties were increasingly reluctant to be exposed to Bear. In some cases, they unwound trades in which they faced Bear, and in others, they made margin or collateral calls. In Bear's last few years as an independent company, it had substantially increased its exposure to derivatives. At the end of fiscal year 2007, Bear had $13.4 trillion in notional exposure on derivatives contracts, compared with $8.7 trillion at 2006 fiscal year end, and $5.5 trillion at the end of 2005. Derivatives counterparties who worried about Bear's ability to make good on their payments could get out of their derivative positions with Bear through assignments or novations. Assignments allowed counterparties to assign their positions to someone else. If firm X has a derivatives contract with firm Y, then firm X can assign its position to firm Z, so that Z now is the one that has a derivatives contract with Y. Novations also allow counterparties to get out of their exposure to each other, but by bringing in a third party. Instead of X facing Y, X faces Z and Z faces Y. Both assignments and novations are routine transactions on Wall Street. But on Tuesday, Brian Peters of the New York Fed advised Eichner at the SEC that the New York Fed was seeing some HFs, hedge funds, wishing to assign trades the clients had done with Bear to other CPs, counterparties, so that Bear steps out. Counterparties did not want to have Bear Stearns as a derivatives counterparty anymore. Bear Stearns also encountered difficulties stepping into trades. Heyman Capital Partners, a hedge fund in Texas wanting to decrease its exposure to subprime mortgages, had decided to close out a relatively small $5 million subprime derivative position with Goldman Sachs. Bear Stearns offered the best bid, so Heyman expected to assign its position to Bear, which would then become Goldman's counterparty in the derivative. Heyman notified Goldman by a routine email on Tuesday, March 11 at 4:06 p.m. The reply 41 minutes later was unexpected. GS does not consent to this trade. That startled Kyle Bass, Heyman's managing partner. He told the FCIC he could not recall any counterparty rejecting a routine novation. Pressed for an explanation, Goldman the next morning offered no details. "Our trading desk would prefer to stay facing Heyman. We do not want to face Bear." Adding to the mystery, 16 minutes later, Goldman agreed to accept Bear Stearns as the counterparty after all. But the damage was done. The news hit the street that Goldman had refused a routine transaction with one of the other Big Five investment banks. The message, "Don't rely on Bear Stearns." CEO Alan Schwartz hoped an appearance on CNBC would reassure markets. Questioned about this incident, Schwartz said he had no knowledge of such a refusal and rhetorically asked, "Why do rumors start?" SEC Chairman Cox told reporters his agency was monitoring capital levels at Bear Stearns and other securities firms on a constant basis and has a good deal of comfort about the capital cushions at these firms at the moment. Still, the run on Bear accelerated. Many investors believed the Fed's announcement about its new loan program was directed at Bear Stearns, and they worried about the facilities not being available for several weeks. On Wednesday, March 12th, the SEC noted that Bear paid another $1.1 billion for margin calls from 142 nervous derivatives counterparties. Repo lenders who had already tightened the terms for their contracts over the preceding 4 or 5 months shortened the leash again, demanding more collateral from Bear Stearns. Worries about a default quickly mounted. By that evening, Bear's ability to borrow in the repo market was drying up. The SEC noted that some large and important money funds, including Fidelity and Mellon, had told Bear after the close of business Wednesday they might be hesitant to roll some funding tomorrow. The SEC said that though they believed the amounts were very manageable, between $1 and $2 billion, the withdrawals would not send a helpful signal to the market. But the issue was almost moot. Schwartz called New York Fed President Timothy Geithner that night to discuss possible Fed flexibility in the event that some repo lenders did pull away. Upton, the treasurer, said that before that week he had never worried about the disappearance of repo lending. By Thursday, he believed the end was near. Bear executives informed the board that the rumors were dissuading counterparties from doing business with Bear, that Bear was receiving and meeting significant margin calls, that $14 billion in repo was not going to roll over, and that there was a reasonable chance that there would not be enough cash to meet Bear's needs. Some repo lenders were already so averse to Bear that they stopped lending to the company at all, not even against Treasury collateral, Upton told the FCIC. Derivatives counterparties continued to run from Bear. By that night, liquidity had dwindled to a mere $2 billion. See Figure 15.1. Bear had run out of cash in 1 week. Executives and regulators continued to believe the firm was solvent, however. Former SEC Chairman Cox testified before the FCIC, at all times during the week of March 10 to 17, up to and including the time of its agreement to be acquired by J.P. Morgan, Bear Stearns had a capital cushion well above what is required. End of section 92. Section 93 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 15. The Government Would Not Permit a Higher Number. On Thursday evening, March 13th, Bear Stearns informed the SEC that it would be unable to operate normally on Friday. CEO Alan Schwartz called J.P. Morgan CEO Jamie Dimon to request a $30 billion credit line. Dimon turned him down, citing, according to Schwartz, J.P. Morgan's own significant exposure to the mortgage market. Because Bear also had a large, illiquid portfolio of mortgage assets, J.P. Morgan would not render assistance without government support. Schwartz spoke with Geithner again. Schwartz insisted Bear's problem was liquidity, not insufficient capital. A series of calls between Schwartz, Dimon, Geithner, and Treasury Secretary Henry Paulson followed. To address Bear's liquidity needs, the New York Fed made a $12.9 billion loan to Bear Stearns through J.P. Morgan on the morning of Friday, March 14. Standard & Poor's lowered Bear's rating 3 levels to BBB. Moody's and Fitch also downgraded the company. By the end of the day, Bear was out of cash. Its stock plummeted 47%, closing below 30. The markets evidently viewed the loan as a sign of terminal weakness. After markets closed on Friday, Paulson and Geithner informed Bear CEO Schwartz that the Fed loan to J.P. Morgan would not be available after the weekend. Without that loan, Bear could not conduct business. In fact, Bear Stearns had to find a buyer before the Asian markets opened Sunday night, or the game would be over. Schwartz, Molinaro, Alex, and others spent the weekend in due diligence meetings with J.P. Morgan and other potential buyers, including the private equity firm J.C. Flowers & Co. According to Schwartz, the participants determined J.P. Morgan was the only candidate with the size and stature to make a credible offer within 48 hours. As Bear Stearns' clearing bank for repo trades, J.P. Morgan held much of Bear Stearns' assets as collateral and had been assessing their value daily. This knowledge let J.P. Morgan move more quickly. On Sunday, March 16th, J.P. Morgan informed the New York Fed and the Treasury that it was interested in a deal if it included financial support from the Fed. The Federal Reserve Board, again finding unusual and exigent circumstances, as required under Section 13.3 of the Federal Reserve Act, agreed to purchase $29.97 billion of Bear's assets to get them off the firm's books through a new entity called Maiden Lane LLC, named for the street alongside the New York Fed. Those assets, mostly mortgage-related securities, other assets, and hedges from Bear's mortgage trading desk, would be under New York Fed management. To finance the purchases, J.P. Morgan made a $1.15 billion subordinated loan, and the New York Fed lent $28.82 billion. Because of its loan, J.P. Morgan bore the risk of the first $1.15 billion of losses. The Fed would bear any further losses up to $28.82 billion. The Fed's loan would be repaid as Maiden Lane sold the collateral. On Sunday night, with Maiden Lane in place, J.P. Morgan publicly announced a deal to buy Bear Stearns for $2 a share. Minutes of Bear's board meeting indicate that J.P. Morgan had considered $4 but cut it to $2 because the government would not permit a higher number. The Fed and the Treasury Department would not support a transaction where Bear Stearns equity holders received any significant consideration because of the moral hazard of the federal government using taxpayer money to bail out the investment bank's stockholders. 8 days later, on March 24, Bear Stearns and J.P. Morgan agreed to increase the price to $10. John Trinh, co-head of the Financial Institutions Mergers and Acquisitions Group at J.P. Morgan, told the FCIC they increased the price to make Bear shareholders' approval more likely. Bear CEO Schwartz told the FCIC the increase let Bear preserve the company's value to the greatest extent possible under the circumstances for our shareholders, our 14,000 employees, and our creditors. End of section 93. Section 94 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 15, It was heading to a black hole. The SEC regulators, Macchiaroli and Eichner, were as stunned as everyone else by the speed of Bear's collapse. Macchiaroli had had doubts as far back as August, he told the FCIC, but he and his colleagues expected Bear would be able to fund itself through the repo market, albeit at higher margins. Fed Chairman Ben Bernanke later called the Bear Stearns decision the toughest of the financial crisis. The $2.8 trillion tri-party repo market had really begun to break down, Bernanke said. As the fear increased, short-term lenders began demanding more collateral, which was making it more and more difficult for the financial firms to finance themselves and creating more and more liquidity pressures on them. And it was heading sort of to a black hole. He saw the collapse of Bear Stearns as threatening to freeze the tri-party repo market, leaving the short-term lenders with collateral they would try to dump on the market. You would have a big crunch in asset prices. Bear Stearns, which is not that big a firm, our view on why it was important to save it, you may disagree, but our view was that because it was so essentially involved in this critical repo financing market, that its failure would have brought down that market, which would have had implications for other firms, Bernanke told the FCIC. Geithner explained the need for government support for Bear's acquisition by J.P. Morgan as follows. The sudden discovery by Bear's derivative counterparties that important financial positions they had put in place to protect themselves from financial risk were no longer operative would have triggered substantial further dislocation in markets. This would have precipitated a rush by Bear's counterparties to liquidate the collateral they held against these positions and to attempt to replicate those positions in already very fragile markets. Paulson told the FCIC that Bear had both a liquidity problem and a capital problem. Could you just imagine the mess we would have had? If Bear had gone, there were hundreds, maybe thousands of counterparties that all would have grabbed their collateral, would have started trying to sell their collateral, drove down prices, create even bigger losses. There was huge fear about the investment banking model at that time. Paulson believed that if Bear had filed for bankruptcy, you would have had Lehman going almost immediately if Bear had gone, and just the whole process would have just started earlier. End of section 94. Section 95 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Commission conclusions on Chapter 15. The Commission concludes the failure of Bear Stearns and its resulting government-assisted rescue were caused by its exposure to risky mortgage assets, its reliance on short-term funding, and its high leverage. These were a result of weak corporate governance and risk management. Its executive and employee compensation system was based largely on return on equity, creating incentives to use excessive leverage and to focus on short-term gains, such as annual growth goals. Bear experienced runs by repo lenders, hedge fund customers, and derivatives counterparties, and was rescued by a government-assisted purchase by J.P. Morgan because the government considered it too interconnected to fail. Bear's failure was in part a result of inadequate supervision by the Securities and Exchange Commission, which did not restrict its risky activities and which allowed undue leverage and insufficient liquidity. End of Section 95.
Section 96 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 16, March to August 2008. Systemic Risk Concerns. Intro. J.P. Morgan's federally assisted acquisition of Bear Stearns averted catastrophe for the time being. The Federal Reserve had found new ways to lend cash to the financial system, and some investors and lenders believed the Bear episode has set a precedent for extraordinary government intervention. Investors began to worry less about a recession and more about inflation as the price of oil continued to rise, hitting almost $144 per barrel in July. At the beginning of 2008, the stock market had fallen almost 15% from its peak in the fall of 2007. Then, in May 2008, the Dow Jones climbed to 13,058, within 8% of the record 14,164 set in October 2007. The cost of protecting against the risk of default by financial institutions, reflected in the prices of credit default swaps, declined from the highs of March and April. In hindsight, the markets were surprisingly stable and almost seemed to be neutral a month after Bear Stearns, leading all the way up to September, said David Wong, Morgan Stanley's treasurer. Taking advantage of the brief respite in investor concern, the top 10 American banks and the 4 remaining big investment banks, anticipating losses, raised just under $100 billion and $40 billion respectively in new equity by the end of June. Despite this good news, bankers and the regulators were haunted by the speed of Bear Stearns' demise. And they knew that the other investment banks shared Bear's weaknesses: leverage, reliance on overnight funding, dependence on securitization markets, and concentrations in illiquid mortgage securities and other troubled assets. In particular, the run on Bear had exposed the dangers of tri-party repo agreements and the counterparty risk caused by derivatives contracts. And the word on the street, despite the assurances of Lehman's CEO Dick Fuld at an April shareholder meeting that the worst is behind us, was that Bear would not be the only failure. End of Section 96. Section 97 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 16. The Federal Reserve. When People Got Scared. The most pressing danger was the potential failure of the repo market, a market that grew very, very quickly with no single regulator having a purview of it. Former Treasury Secretary Henry Paulson would tell the FCIC. Market participants believed that the tri-party repo market was a relatively safe and durable source of collateralized short-term financing. It was on precisely this understanding that Bear had shifted approximately $30 billion of its unsecured funding into repos in 2007. But now it was clear that repo funding could be just as vulnerable to runs as were other forms of short-term financing. The repo runs of 2007, which had devastated hedge funds such as the 2 Bear Stearns asset management funds and mortgage originators such as Countrywide, had seized the attention of the financial community, and the run on Bear Stearns was similarly eye-opening. market participants and regulators now better appreciated how the quality of repo collateral had shifted over time from Treasury notes and securities issued by Fannie Mae and Freddie Mac to highly rated non-GSE mortgage-backed securities and collateralized debt obligations (CDOs). At its peak before the crisis, the riskier collateral accounted for as much as 30% of the total posted. In April 2005, the Bankruptcy Abuse Prevention and Consumer Protection Act of 2005 had dramatically expanded protections for repo lenders holding collateral such as mortgage-related securities that was riskier than government or highly rated corporate debt. These protections gave lenders confidence that they had clear, immediate rights to collateral if a borrower should declare bankruptcy. Nonetheless, Jamie Dimon, the CEO of JP Morgan, told the FCIC, when people got scared, they wouldn't finance the non-standard stuff at all. To the surprise of both borrowers and regulators, high-quality collateral was not enough to ensure access to the repo market. Repo lenders cared just as much about the financial health of the borrower as about the quality of the collateral. In fact, even for the same collateral, repo lenders demanded different haircuts from different borrowers. Despite the bankruptcy provisions in the 2005 Act, lenders were reluctant to risk the hassle of seizing collateral, even good collateral, from a bankrupt borrower. Stephen Meir of State Street testified to the FCIC. I would say the counterparties are a first line of defense, and we don't want to go through that uncomfortable process of having to liquidate collateral. William Dudley of the New York Fed told the FCIC, at the first sign of trouble, these investors in tri-party repo tend to run rather than take the collateral that they lent against. So high-quality collateral itself is not sufficient when and if an institution gets in trouble. Moreover, if a borrower in the repo market defaults, money market funds, frequent lenders in this market, may have to seize collateral that they cannot legally own. For example, a money market fund cannot hold long-term securities such as agency mortgage-backed securities. Typically, if a fund takes possession of such collateral, it liquidates the securities immediately, even, as was the case during the crisis, into a declining market. As a result, funds simply avoided lending against mortgage-related securities. In the crisis, investors didn't consider secured funding to be much better than unsecured, according to Daryl Hendricks, a managing director and global head of risk methodology at UBS, as well as the head of a private sector task force on the repo market organized by the New York Fed. As noted, the Fed had announced a new program, the Term Securities Lending Facility, TSLF, on the Tuesday before Bear's collapse, but it would not be available until March 27. The TSLF would lend a total up to $200 billion of Treasury securities at any one time to the investment banks and other primary dealers, the securities affiliates of the large commercial banks and investment banks that trade with the New York Fed, such as Citigroup, Morgan Stanley, or Merrill Lynch, for up to 28 days. The borrowers would trade highly rated securities, including debt in government-sponsored enterprises, in return for treasuries. The primary dealers could then use those treasuries as collateral to borrow cash in the repo market. Like the term auction facility for commercial banks described earlier, the TSLF would run as a regular auction to reduce the stigma of borrowing from the Fed. However, after Bear's collapse, Fed officials recognized that the situation called for a program that could be up and running right away, and they concluded that the TSLF alone would not be enough. So the Fed would create another program first. On the Sunday of Bear's collapse, the Fed announced the new Primary Dealer Credit Facility, again invoking its authority under 13.3 of the Federal Reserve Act to provide cash, not treasuries, to investment banks and other primary dealers on terms close to those that depository institutions, banks and thrifts, received through the Fed's discount window. The move came just about 45 minutes too late for Bear, Jimmy Kane, its former CEO, told the FCIC. Unlike the TSLF, which would offer treasuries for 28 days, the PDCF offered overnight cash loans in exchange for collateral. In effect, this program could serve as an alternative to the overnight tri-party repo lenders, potentially providing hundreds of billions of dollars of credit. So the idea of the PDCF then was anything that the dealer couldn't finance, the securities that were acceptable under the discount window. If they couldn't get financing in the market, they could get financing from the Federal Reserve, said Seth Carpenter, Deputy Associate Director in the Division of Monetary Affairs at the Federal Reserve Board. And that way, you don't have to worry. And by providing that support, other lenders know that they are going to be able to get their money back the next day. By charging the Federal Reserve's discount rate and adding additional fees for regular use, the Federal Reserve encouraged dealers to use the PDCF only as a last resort. In its first week in operation, this program immediately provided over $340 billion in cash to Stearns as bridge financing until the JP Morgan deal officially closed, Lehman Brothers, and the securities affiliate of Citigroup, among others. However, as the immediate post-bear concerns subsided, use of the facility declined after April and ceased completely by late July. Because the dealers feared that markets would see reliance on the PDCF as an indication of severe distress, the facility carried a stigma similar to the Fed's discount window. Paradoxically, when the PDCF was created to mitigate the liquidity flight caused by the loss of confidence in an investment bank, use of the PDCF was seen both within Lehman and possibly by the broader market as an event that could trigger a loss of confidence, noted the Lehman Bankruptcy Examiner. On May 2nd, the Fed broadened the kinds of collateral allowed in the TSLF to include other AAA-rated asset-backed securities such as auto and credit card loans. In June, the Fed's Dudley urged in an internal email that both programs be extended at least through the end of the year. PDCF remains critical to the stability of some of the investment banks, he wrote. Amounts don't matter here. It is the fact that the PDCF underpins the tri-party repo system. On July 30, the Fed extended both programs through January 30, 2009. End of section 97. Section 98 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 16. J.P. Morgan. Refusing to unwind would be unforgivable. The repo run on Bear also alerted the two repo clearing banks, J.P. Morgan, the main clearing bank for Lehman and Merrill Lynch, as it had been for Bear Stearns, and BNY Mellon, the main clearing bank for Goldman Sachs and Morgan Stanley, to the risks they were taking. Before Bear's collapse, the market had not really understood the colossal exposures that the tri-party repo market created for these clearing banks. As explained earlier, the unwind-rewind mechanism could leave JP Morgan and BNY Mellon with an enormous intraday exposure, an interim exposure, but no less real for its brevity. In an interview with the FCIC, Diamond said that he had not become fully aware of the risks stemming from his bank's tri-party repo clearing business until the bear crisis in 2008. A clearing bank had two concerns. First, if repo lenders abandoned an investment bank, it could be pressured into taking over the role of the lenders. Second, and worse, if the investment bank defaulted, it could be stuck with unwanted securities. If they defaulted intraday, we own the securities and we have to liquidate them. That's a huge risk to us, Diamond explained. To address those risks in 2008, for the first time both JP Morgan and BNY Mellon started to demand that intraday loans to tri-party repo borrowers, mostly the large investment banks, be over-collateralized. The Fed increasingly focused on the systemic risk posed by the two repo clearing banks. In the chain reaction scenario that it envisioned, if either JP Morgan or BNY Mellon chose not to unwind its trades one morning, the money funds and other repo lenders could be stuck with billions of dollars in repo collateral. Those lenders would then be in the difficult position of having to sell off large amounts of collateral in order to meet their own cash needs, an action that in turn might lead to widespread fire sales of repo collateral and runs by lenders. The PDCF provided overnight funding in case money market funds and other repo lenders refused to lend as they had in the case of Bear Stearns, but it did not protect against clearing banks refusing exposure to an investment bank during the day. On July 11, Fed officials circulated a plan, ultimately never implemented, that addressed the possibility that one of the two clearing banks would become unwilling or unable to unwind its trades. The plan would allow the Fed to provide troubled investment banks, such as Lehman Brothers, with $200 billion in tri-party repo financing during the day, essentially covering for JP Morgan or BNY Mellon if the two clearing banks would not or could not provide that level of financing. Fed officials made a case for the proposal in an internal memo. Should a dealer lose the confidence of his investors or clearing bank, their efforts to pull away from providing credit could be disastrous for the firm and also cast widespread doubt about the instrument as a nearly risk-free, liquid overnight investment. But the New York Fed's new plan shouldn't be necessary as long as the PDCF was there to back up the overnight lenders, argued Patrick Parkinson, then Deputy Director of the Federal Reserve Board's Division of Research and Statistics. We should tell JP Morgan that with the PDCF in place, refusing to unwind is unnecessary and would be unforgivable, he emailed Dudley and others. A week later, on July 20, Parkinson wrote to Fed Governor Kevin Warsh and Fed General Counsel Scott Alvarez that JP Morgan, because of his clearing role, was likely to be the first to realize that the money funds and other investors that provide tri-party financing to Lehman Brothers are pulling back significantly. Parkinson described the chain reaction scenario in which a clearing bank's refusal to unwind would lead to a widespread fire sale and market panic. Fear of these consequences is, of course, why we facilitated Bear's acquisition by JPMC, he said. Still, it was possible that the PDCF could prove insufficient to dissuade JP Morgan from refusing to unwind Lehman's repos, Parkinson said. Because a large portion of Lehman's collateral was ineligible to be funded by the PDCF, and because Lehman could fail during the day before the repos were settled, JP Morgan still faced significant risks. Parkinson noted that even if the Fed lent as much as $200 billion to Lehman, the sum might not be enough to ensure the firm's survival in the absence of an acquirer. If the stigma associated with PDCF borrowing caused other funding counterparties to stop providing funding to Lehman, the company would fail. End of section 98. Section 99 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 16. The Fed and the SEC. Weak liquidity position. Among the four remaining investment banks, one key measure of liquidity risk was the portion of total liabilities that the firms funded through the repo market, 15% to 20% for Lehman and Merrill Lynch, 10% to 15% for Morgan Stanley, and about 10% for Goldman Sachs. Another metric was the reliance on overnight repo, which matured in one day, or open repo, which can be terminated at any time. Despite efforts among the investment banks to reduce the portion of the repo financing that was overnight or open, the ratio of overnight and open repo funding to total repo funding still exceeded 40% for all but Goldman Sachs. Comparing the period between March and May to the period between July and August, Lehman's percentage fell from 45% to 40%, Merrill Lynch's fell from 46% to 43%, Morgan Stanley's fell from 70% to 55%, and Goldman's fell from 18% to 10%. Another measure of risk was the haircuts on repo loans, that is, the amount of excess collateral that lenders demanded for a given loan. Fed officials kept tabs on the haircuts demanded of investment banks, hedge funds, and other repo borrowers. As Fed analysts later noted, with lenders worrying that they could lose money on the securities they held as collateral, haircuts increased, doubling for some agency mortgage securities and increasing significantly even for borrowers with high credit ratings and on relatively safe collateral such as Treasury securities. On the day of Bear's demise, in an effort to get a better understanding of the investment banks, the New York Fed and the SEC sent teams to work on site at Lehman Brothers, Merrill Lynch, Goldman Sachs, and Morgan Stanley. According to Eric Siri, director of the SEC's Division of Trading and Markets, the initial rounds of meetings covered the quality of assets, funding, and capital. Fed Chairman Ben Bernanke would testify before a House committee that the Fed's primary role at the investment banks in 2008 was not as a regulator but as a lender through the new emergency lending facilities. Two questions guided the Fed's analysis. First, was each investment bank liquid? Did it have access to the cash needed to meet its commitments? Second, was it solvent? Was its net equity, the value of assets minus the value of liabilities, sufficient to cover probable losses? The U.S. Treasury also dispatched so-called SWAT teams to the investment banks in the spring of 2008. The arrival of officials from the Treasury and the Fed created a full-time on-site presence, something the SEC had never had. Historically, the SEC's primary concern with the investment banks had been liquidity risk because these firms were entirely dependent on the credit markets for funding. The SEC already required these firms to implement so-called liquidity models designed to ensure that they had sufficient cash available to sustain themselves on a standalone basis for a minimum of 1 year without access to unsecured funding and without having to sell a substantial amount of assets. Before the run on bear in the repo market, the SEC's liquidity stress scenarios, also known as stress tests, had not taken account of the possibility that a firm would lose access to secured funding. According to the SEC's theory, the SEC never thought that a situation would arise when an investment bank couldn't enter into a repo transaction backed by high-quality collateral, including treasuries. He told the FDIC that as the financial crisis worsened, the SEC began to see liquidity and funding risks as the most critical for the investment banks, and the SEC encouraged a reduction in reliance on unsecured commercial paper and an extension of the maturities of repo loans. The Fed and the SEC collaborated in developing two new stress tests to determine the investment bank's ability to withstand a potential run or a system-wide disruption in the repo market. The stress scenarios, called Bear Stearns and Bear Stearns Light, were developed jointly with the remaining investment banks. In May, Lehman, for example, would be $84 billion short of cash in the more stringent Bear Stearns scenario and $15 billion short under Bear Stearns Light. The Fed conducted another liquidity stress analysis in June. While each firm ran different scenarios that matched its risk profile, the supervisors tried to maintain comparability between the tests. The tests assumed that each firm would lose 100% of unsecured funding and a fraction of repo funding that would vary with the quality of its collateral. The stress tests, under just one estimated scenario, concluded that Goldman Sachs and Morgan Stanley were relatively sound. Merrill Lynch and Lehman Brothers failed. The two banks came out $22 billion and $15 billion short of cash, respectively. Each had only 78% of the liquidity it would need under the stress scenario. The Fed's internal report on the stress tests criticized Merrill's significant amount of illiquid fixed income assets and noted that Merrill's liquidity pool is low, a fact the company does not acknowledge. As for Lehman Brothers, the Fed concluded that Lehman's weak liquidity position is driven by its relatively large exposure to overnight commercial paper combined with significant overnight secured repo funding of less liquid assets. These less liquid assets included mortgage-related securities, now devalued. Meanwhile, Lehman ran stress tests of its own and passed with billions in excess cash. Although the SEC and the Fed worked together on the liquidity stress tests with equal access to the data, each agency has said that for months during the crisis, the other did not share its analysis and conclusions. For example, following Lehman's failure in September, the Fed told the bankruptcy examiner that the SEC had declined to share two horizontal cross-firm reviews of the bank's liquidity positions and exposures to commercial real estate. The SEC's response was that the documents were in draft form and had not been reviewed or finalized. Adding to the tension, the Fed's on-site personnel believed that the SEC on-site personnel did not have the background or expertise to adequately evaluate the data. This lack of communication was remedied only by a formal Memorandum of Understanding, MOU, to govern information sharing. According to former SEC Chairman Christopher Cox, one reason the MOU was needed was that the Fed was reluctant to share supervisory information with the SEC out of concern that the investment banks would not be forthcoming with information if they thought they would be referred to the SEC for enforcement. The MOU was not executed until July 2008, more than 3 months after the collapse of Stearns. End of section 99. Section 100 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 16. Derivatives. Early stages of assessing the potential systemic risk. The Fed's Parkinson advised colleagues in an internal August 8 email that the systemic risks of the repo and derivatives market demanded attention. We have given considerable thought to what might be done to avoid a fire sale of tri-party repo collateral. That said, the options under existing authority are not very attractive. Lots of risk to Fed taxpayer, lots of moral hazard. We are still at the early stages of assessing the potential systemic risk from closeout of OTC derivatives transactions by an investment bank's counterparties and identifying potential mitigants. The repo market was huge, but as discussed in early chapters, it was dwarfed by the global derivatives market. At the end of June 2008, the notional amount of the over-the-counter derivatives market was $673 trillion, and the gross market value was $20 trillion. See Figure 16.1. Adequate information about the risks in this market was not available to market participants or government regulators like the Federal Reserve. Because the market had been deregulated by statute in 2000, market participants were not subject to reporting or disclosure requirements, and no government agency had oversight responsibility. While the Office of the Comptroller of the Currency did report information on derivatives positions from commercial banks and bank holding companies, it did not collect such information from the large investment banks and insurance companies like AIG, which were also major OTC derivatives dealers. During the crisis, the lack of such basic information created heightened uncertainty. At this point in the crisis, regulators also worried about the interlocking relationships that derivatives created among the small number of large financial firms that act as dealers in the OTC derivatives business. A derivatives contract creates a credit relationship between parties, such that one party may have to make large and unexpected payments to the other based on sudden price or rate changes or loan defaults. If a party is unable to make those payments when they become due, that failure may cause significant financial harm to its counterparty, which may have offsetting obligations to third parties and depend on prompt payment. Indeed, most OTC derivatives dealers hedge their contracts with offsetting contracts. Thus, if they are owed payments on one contract, they most likely owe similar amounts on an offsetting contract, creating the potential for a series of losses or defaults. Since these contracts numbered in the millions and allowed a party to have virtually unlimited leverage, the possibility of sudden large and devastating losses in this market could pose a significant danger to market participants and the financial system as a whole. The Counterparty Risk Management Policy Group, led by former New York Fed President E. Gerald Corrigan and consisting of the major securities firms, had warned that the backlog in paperwork confirming derivatives trades and master agreements exposed firms to risk should corporate defaults occur. With urging from New York Fed President Timothy Geithner, by September 2006, 14 major market participants had significantly reduced the backlog and had ended the practice of assigning trades to third parties without the prior consent of their counterparties. Large derivatives positions and the resulting counterparty credit and operational risks were concentrated in a very few firms. Among U.S. bank holding companies, the following institutions held enormous OTC derivatives positions as of June 30, 2008. $94.5 trillion in notional amount for JP Morgan, $37.7 trillion for Bank of America, $35.8 trillion for Citigroup, $4.1 trillion for Wachovia, and $3.9 trillion for HSBC. Goldman Sachs and Morgan Stanley, which began to report their holdings only after they became bank holding companies in 2008, held $45.9 and $37 trillion respectively in notional amount of OTC derivatives in the first quarter of 2009. In 2008, the current and potential exposure to derivatives at the top 5 U.S. bank holding companies was on average 3 times greater than the capital they had on hand to meet regulatory requirements. The risk was even higher at the investment banks. Goldman Sachs, just after it changed its charter, had derivatives exposure more than 10 times capital. These concentrations of positions in the hands of the largest bank holding companies and investment banks posed risks for the financial system because of their interconnections with other financial institutions. Broad classes of OTC derivatives markets showed stress in 2008. By the summer of 2008, outstanding amounts of some types of derivatives had begun to decline sharply. As we will see, over the course of the second half of 2008, the OTC derivatives market would undergo an unprecedented contraction, creating serious problems for hedging and price discovery. The Fed was uneasy in part because derivatives counterparties had played an important role in the run on Bear and Stearns. The innovations and derivatives counterparties to assign their positions away from Bear, and the rumored refusal by Goldman to accept Bear as a derivatives counterparty were still a fresh memory across Wall Street. Chris Milburn, a portfolio manager at PIMCO, told the FCIC that the ability to innovate ceased to exist, and this was a key event in the demise of Bear and Stearns. Credit derivatives, in particular, were a serious source of worry. Of greatest interest were the sellers of credit default swaps, the Monoline Insurers and AIG, which backstopped the market in CDOs. In addition, the credit rating agency's decision to issue a negative outlook on the Monoline Insurers had jolted everyone because they guaranteed hundreds of billions of dollars in structured products. As we have seen, when their credit ratings were downgraded, the value of all the assets they guaranteed, including municipal bonds and other securities, necessarily lost some value in the market, a drop that affected the conservative institutional investors in those markets. In the vernacular of Wall Street, this outcome is the knock-on effect. In the vernacular of Main Street, the domino effect. In the vernacular of the Fed, systemic risk. End of section 100. Section 101 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 16. Banks. The markets were really dicey. By the fall of 2007, signs of strain were beginning to emerge among the commercial banks. In the fourth quarter of 2007, commercial banks' earnings declined to a 16-year low, driven by write-downs on mortgage-backed securities and CDOs, and by record provisions for future loan losses, as borrowers had increasing difficulty meeting their mortgage payments, and even greater difficulty was anticipated. The net charge-off rate, the ratio of failed loans to total loans, rose to its highest level since 2002, when the economy was coming out of the post-9/11 recession. Earnings continued to decline in 2008, at first more for big banks than small banks, in part because of write-downs related to their investment banking-type activities, including the package of mortgage-backed securities, CDOs, and collateralized loan obligations. Declines in market values require banks to write down the value of their holdings of these securities. As previously noted, several of the largest banks had also provided support to off-balance sheet activities, such as money market funds and commercial paper programs, bringing additional assets onto their balance sheets, assets that were losing value fast. Supervisors had begun to downgrade the ratings of many smaller banks in response to their high exposures in residential real estate construction, an industry that virtually went out of business as financing dried up in mid-2007. By the end of 2007, the FDIC had 76 banks, mainly smaller ones, on its problem list. Their combined assets totaled $22.2 billion. When large banks started to be downgraded in early 2008, they stayed off the FDIC's problem list, as supervisors rarely give the largest institutions the lowest ratings. The market for non-conforming mortgage securitizations, those backed by mortgages that did not meet Fannie Mae's or Freddie Mac's underwriting or mortgage size guidelines, had also vanished in the fourth quarter of 2007. Not only did these non-conforming loans prove harder to sell, but they also proved less attractive to keep on balance sheet as house price forecasts looked increasingly grim. Already, house prices had fallen about 7% for the year, depending on the measure. In the first quarter of 2008, real estate loans in the banking sector showed the smallest quarterly increase since 2003. IndyMac reported a 21% decline in loan production for that quarter from a year earlier because it had stopped making non-conforming loans. Washington Mutual, the largest thrift, discontinued all remaining lending through its subprime mortgage channel in April 2008. But those actions could not reduce the subprime and Alt-A exposure that these large banks and thrifts already had. And on these assets, the markdowns continued in 2008. Regulators began to focus on solvency, urging the banks to raise new capital. In January 2008, Citigroup secured a total of $14 billion in capital from Kuwait, Singapore, Saudi Prince Al Walid bin Talal, and others. In April, Washington Mutual raised $7 billion from an investor group led by the buyout firm TPG Capital. Wachovia raised $6 billion in capital at the turn of the year, and then an additional $8 billion in April 2008. Despite capital raises, though, the downgrades by banking regulators continued. The markets were really dicey during a significant part of this period, starting with August 2007. Roger Cole, then director of the Division of Banking Supervision and Regulation at the Federal Reserve Board, told the FCIC. The same was true for the thrifts. Michael Solomon, a managing director and risk management manager in the Office of Thrift Supervision, OTS, told the FCIC, it was hard for businesses, particularly small, mid-sized thrifts, to keep up with how quickly the ratings downgrades occurred during the crisis, and to change their business models and not get stuck without the chair when the music stopped. They got caught. The rating downgrades started, and by the time the thrift was able to do something about it, it was too late. Business models can't keep up with what we saw in 2008. As the commercial bank's health worsened in 2008, examiners downgraded even large institutions that had maintained favorable ratings and required several to fix their risk management process. These ratings downgrades and enforcement actions came late in the day, often just as firms were on the verge of failure. In cases that the FCIC investigated, regulators either did not identify the problems early enough or did not act forcefully enough to compel the necessary changes. Citigroup, time to come up with a new playbook. For Citigroup, supervisors at the New York Fed, who examined the bank holdings company, and at the Office of the Comptroller of the Currency, who oversaw the national bank subsidiary, finally downgraded the company and its main bank to less than satisfactory in April 2008, 5 months after the firm's announcement in November 2007 of billions of dollars in write-downs related to its mortgage-related holdings. The supervisors put the company under new enforcement actions in May and June. Only a year earlier, both the Fed and the OCC had upgraded the company after lifting all remaining restrictions and enforcement actions related to complex transactions that it had structured for Enron and to the actions of a subprime subsidiary, Citi Financial, discussed in an earlier chapter. The risk management assessment for 2006 is reflective of a control environment where the risks facing Citigroup continue to be managed in a satisfactory manner. The New York Fed's rating upgrade, delivered in its annual inspection report on April 9, 2007, had noted. During 2006, all formal restrictions and enforcement actions between the Federal Reserve and Citigroup were lifted. Board and senior management remain actively engaged in improving relevant processes. But the market disruption had jolted Citigroup's supervisors. In November 2007, the New York Fed led a team of international supervisors, the Senior Supervisors Group, in evaluating 11 of the largest firms to assess lessons learned from the financial crisis up to that point. Much of the toughest language was reserved for Citigroup. The firm did not have an adequate, firm-wide consolidated understanding of its risk factor sensitivities, the supervisors wrote in an internal November 19 memo describing meetings with Citigroup management. Stress tests were not designed for this type of extreme market event. Management had believed that CDOs and leveraged loans would be syndicated and that the credit risk in super senior AAA CDOs was negligible. In retrospect, Citigroup had two key problems: a lack of effective enterprise-wide management to monitor and control risks, and a lack of proper infrastructure and internal controls with respect to the creation of CDOs. The OCC appears to have identified some of these issues as early as 2005, but did not effectively act to rectify them. In particular, the OCC assessed both the liquidity puts and the super senior tranches as part of its reviews of the bank's compliance with the post-end run enforcement action, but it did not examine the risks of these exposures. As for the issues it did spot, the OCC failed to make forceful steps to require mandatory corrective action, and it relied on management's assurances in 2006 that the executives would strive to meet the OCC's goals for improving risk management. In contrast, documents obtained by the FCIC from the New York Fed give no indication that its examination staff had any independent knowledge of those two core problems. An evaluation of the New York's Fed supervision of Citigroup, conducted by examiners from other reserve banks, the December 2009 operations review of the New York Fed, which covered the previous 4 years, concluded: the supervision program for Citigroup has been less than effective. Although the dedicated supervisory team is well qualified and generally has sound knowledge of the organization, there have been significant weaknesses in the execution of the supervisory program. The team has not been proactive in making changes to the regulatory ratings of the firm, as evidenced by the double downgrades at the firm's financial component and related subcomponents at year-end 2007. Additionally, the supervisor program has lacked the appropriate level of focus on the firm's risk oversight and internal audit functions. As a result, there is currently significant work to be done in both of these areas. Moreover, the team has lacked a disciplined and proactive approach in assessing and validating actions taken by the firm to address supervisory issues. Timothy Geithner, Secretary of the Treasury and former President of the Federal Reserve Bank of New York, reflected on the Fed's oversight of Citigroup, telling the Commission, "I do not think we did enough as an institution with the authority we had to help contain the risks that ultimately emerged in that institution." In January 2008, an OCC review of the breakdown in the CDO business noted that the risk in the unit had grown rapidly since 2006, after the OCC's and Fed's lifting of supervisory agreements associated with various control problems at Citigroup. In April 2008, the Fed and OCC downgraded their overall ratings of the company and its largest bank subsidiary from 2 satisfactory to 3 less than satisfactory, reflecting weaknesses in risk management that were now apparent to the supervisors. Both Fed and OCC officials cited the Gramm-Leach-Bliley Act of 1999 as an obstacle that prevented each from obtaining a complete understanding of the risks assumed by large financial firms such as Citigroup. The act made it more difficult, though not impossible, for regulators to look beyond the legal entities under their direct purview into other areas of a large firm. Citigroup, for example, had many regulators across the world. Even the securitization businesses were dispersed across subsidiaries with different supervisors, including those from the Fed, OCC, SEC, OTS, and state agencies. In May and June 2008, Citigroup entered into memoranda of understanding with both the New York Fed and OCC to resolve the risk management weaknesses that the events of 2007 had laid bare. In the ensuing months, Fed and OCC officials said they were satisfied with Citigroup's compliance with their recommendations. Indeed, in speaking to the FCIC, Stephen Mansari, the senior relationship manager for Citigroup at the New York Fed from April to September 2008, complimented Citigroup on its assertiveness in executing its regulators' requests, aggressively replacing management, raising capital from investors in late 2007, and putting in place a number of much-needed internal fixes. However, Mansari went on, Citi was trapped in what was a pretty vicious systemic event, and for regulators it was time to come up with a new playbook. Wachovia, the Golden West acquisition was a mistake. At Wachovia, which was supervised by the OCC as well as the OTS and the Federal Reserve, a 2007 end-of-year report showed that credit losses in its subsidiary Golden West's portfolio of pick-and-pay adjustable rate mortgages, or option ARMs, were expected to rise to about 1% of the portfolio for 2008. In 2006, losses in this portfolio had been less than 0.1%. It would soon become clear that the higher estimate for 2008 was not high enough. The company would hike its estimate of the eventual losses on the portfolio to 9% by June and to 22% by September. Facing these and other growing concerns, Wachovia raised additional capital. Then, in April, Wachovia announced the loss of $350 million for the first 3 months of the year. Depositors withdrew about $15 billion in the following weeks, and lenders reduced their exposure to the bank, shortening terms, increasing rates, and reducing loan amounts. By June, according to Angus McBride, then Wachovia's Senior Vice President for Treasury and Balance Sheet Management, management had launched a liquidity crisis management plan in anticipation of an even more adverse market reaction to second quarter losses that would be announced in July. On June 2nd, Wachovia's board ousted CEO Ken Thompson after he had spent 32 years at the bank, 8 of them at its helm. At the end of the month, the bank announced that it would stop originating Golden West's pick-a-pay products and would waive all fees and prepayment penalties associated with them. On July 22, Wachovia reported an $8.9 billion second quarter loss. The new CEO, Robert Still, most recently an Undersecretary of the Treasury, announced the plan to improve the bank's financial condition, raise capital, cut the stock dividend, and lay off 10% to 12% of the staff. The rating agencies and supervisors ignored these reassurances. On the same day as the announcement, S&P downgraded the bank, and the Fed, after years of satisfactory ratings, downgraded Wachovia to 3 or less than satisfactory. The Fed noted that 2008 projections showed losses that could wipe out the recently raised capital. 2008 losses alone could exceed $3 billion, an amount that could cause a further ratings downgrade. The Fed directed Wachovia to re-evaluate and update its capital plans and its liquidity management. Despite having consistently rated Wachovia as satisfactory right up to the summer meltdown, the Fed now declared that many of Wachovia's problems were long-term in nature and resulted from delayed investment decisions and a desire to have business lines operate autonomously. The Fed bluntly criticized the board and senior management for an environment with inconsistent and inadequate identification, escalation, and coverage of all risk-taking activities, including deficiencies in stress testing and little accountability for errors. Wachovia management had not completely understood the level of risk across the company, particularly in certain non-bank investments, and management had delayed fixing these known deficiencies. In addition, the company's board had not sufficiently questioned investment decisions. Nonetheless, the Fed concluded that Wachovia's liquidity was currently adequate and that throughout the market disruption, management had minimized exposure to overnight funding markets. On August 4, the OCC downgraded Wachovia Bank and assessed its overall risk profile as high. The OCC noted many of the same issues as the Fed and added particularly strong remarks about the acquisition of Golden West, identifying that mortgage portfolio and associated real estate foreclosures as the heart of Wachovia's problem. The OCC noted that the board had acknowledged that the Golden West acquisition was a mistake. The OCC wrote that the market was focused on the company's weakened condition and that some large fund providers had already limited their exposure to Wachovia. Like the Fed, however, the OCC concluded that the bank's liquidity was adequate unless events undermined market confidence. And, like the Fed, the OCC approved of the new management and a new, more hands-on oversight role for the board of directors. Yet Wachovia's problems would continue, and in the fall, regulators would scramble to find a buyer for the troubled bank. Washington Mutual, management persistent lack of progress. Washington Mutual, often called WAMU, was the largest thrift in the country, with over $300 billion in assets at the end of 2007. At the time, $59 billion of the home loans on its balance sheet were option ARMs 2 times its capital and reserves, with a concentrated exposure in California. The reason WAMU liked option ARMs was simple. In 2005, in combination with other non-traditional mortgages such as subprime loans, they had generated returns up to 8 times those on GSE mortgage-backed securities. But that was then. WAMU was forced to write off $1.9 billion for the fourth quarter of 2007 and another $1.1 billion in the first quarter of 2008, mostly related to its portfolio of option ARMs. In response to these losses, the Office of Thrift Supervision, WAMU's regulator, required that the thrift address concerns about asset quality, earnings, and liquidity, issues that the OTS had raised in the past but that had not been reflected in supervisory ratings. It has been hard for us to justify doing much more than constantly nagging, chastising, through ROE, reports of examination, and meetings since they have not really been adversely impacted in terms of losses. The OTS's lead examiner at the company had commented in a 2005 email. Indeed, the non-traditional mortgage portfolio had been performing very well through 2005 and 2006. But with WAMU now taking losses, the OTS determined in February 27, 2008 that its condition required a downgrade in its rating from a 2 to a 3, or less than satisfactory. In March, the OTS advised that WAMU undertake strategic initiatives, that is, either find a buyer or raise new capital. In April, WAMU secured a $7 billion investment from a consortium led by the Texas Pacific Group, a private equity firm. But bad news continued for thrifts. On July 14, the OTS closed IndyMac Bank in Pasadena, California, making that company the largest ever thrift to fail. On July 22, 2008, WAMU reported a $3.3 billion loss in the second quarter. WAMU's depositors withdrew $10 billion over the next 2 weeks. And the Federal Reserve Home Loan Bank of San Francisco, which, as noted, had historically served with the other 11 federal home loan banks as an important source of funds for WAMU and others, began to limit WAMU's borrowing capacity. The OTS issued more downgrades in various assessment categories while maintaining the overall rating at 3. As the insurer of many of WAMU's deposits, the FDIC had a stake in WAMU's condition, and it was not as generous as the OTS in its assessment. It had already dropped WAMU's rating significantly in March 2008, indicating a high level of concern. The FDIC expressly disagreed with the OTS's decision to maintain the 3 overall rating, recommending a 4 instead. Ordinarily, 4 would have triggered a formal enforcement action, but none was forthcoming. In an August 2008 interview, William Isaac, who was chairman of the FDIC from 1981 until 1985, noted that the OTS and FDIC had competing interests. OTS, as primary regulator, tends to want to see if they can rehabilitate the bank and doesn't want to act precipitously as a rule. On the other hand, the FDIC's job is to handle the failures, and it, generally speaking, would rather be tougher on the theory that the sooner the problems are resolved, the less expensive the cleanup will be. FDIC Chairman Sheila Bair underscored this tension, telling the FDIC that our examiners much earlier were very concerned about the underwriting quality of WAMU's mortgage portfolio, and we were actively opposed by the OTS in terms of going in and letting our FDIC examiners do loan-level analysis. The Treasury's Inspector General would later criticize OTS's supervision of Washington Mutual. We concluded that OTS should have lowered WAMU's composite rating sooner and taken stronger enforcement action sooner to force WAMU's management to correct the problems identified by OTS. Specifically, given WAMU's management persistent lack of progress in correcting OTS-identified weaknesses, we believe OTS should have followed its own policies and taken formal enforcement action rather than informal enforcement action. Regulators, a lot of that pushback. In these examples and others that the Commission studied, regulators either failed or were late to identify the mistakes and problems of commercial banks and thrifts, or did not react strongly enough when they were identified. In part, this failure reflects the nature of bank examinations conducted during periods of apparent financial calm when institutions were reporting profits. In addition to their role as enforcers of regulation, regulators acted something like consultants, working with banks to assess the adequacy of their systems. This function was, to a degree, a reflection of the supervisor's risk-focused approach. The OCC Large Bank Supervision Handbook, published in January 2010, explains, under this approach, examiners do not attempt to restrict risk-taking, but rather determine whether banks identify, understand, and control the risks they assume. As the crisis developed, bank regulators were slow to shift gears. Senior supervisors told the FCIC it was difficult to express their concerns forcefully when financial institutions were generating record-level profits. The Fed's Roger Cole told the FCIC that supervisors did discuss issues such as whether banks were growing too fast and taking too much risk, but ran into pushback. Frankly, a lot of that pushback was given credence on the part of the firms by the fact that, like a Citigroup was earning $4 to $5 billion a quarter. And that is really hard for a supervisor to successfully challenge. When that kind of money is flowing out quarter after quarter after quarter, and their capital ratios are way above the minimums, it is very hard to challenge. Supervisors also told the FCIC that they feared aggravating a bank's already existing problems. For the large banks, the issuance of a formal public supervisory action taken under the federal banking statutes marked a severe regulatory assessment of the bank's risk practices, and it was rarely employed for banks that were determined to be going concerns. Richard Spillenkotten, the Fed's head of supervision until early 2006, attributed supervisor reluctance to a belief that the traditional non-public behind-the-scenes approach to supervision was less confrontational and more likely to induce bank management to cooperate, a desire not to inject an element of contentiousness into what was felt to be a constructive or equable relationship with management, and a fear that financial markets would overreact to public actions, possibly causing a run. Spillenkotten argued that these concerns were relevant, but that, at times, they can impede effective supervision and delay the implementation of needed corrective action. One of the lessons of this crisis is that the working presumption should be earlier and stronger supervisory follow-up. Douglas Rutter, the OCC's Senior Deputy Comptroller for Large Bank Supervision from 2001 to 2010, said that the regulators were hampered by inadequate information from the banks, but acknowledged that regulators did not do a good job of intervening at key points in the run-up to the crisis. He said that regulators, market participants, and others should have balanced their concerns about safety and soundness with the need to let markets work, noting, "We underestimated what systemic risk would be in the marketplace." Regulators also blamed the complexity of the supervisory system in the United States. The patchwork quilt of regulators created opportunities for banks to shop for the most lenient regulator and the presence of more than one supervisor at an organization. For example, a large firm like Citigroup could have the Fed supervising the bank holding company, the OCC supervising the national bank subsidiary, the SEC supervising the securities firm, and the OTS supervising the thrift subsidiary, creating the potential for both gaps in coverage and problematic overlap. Successive Treasury secretaries and congressional leaders have proposed consolidation of the supervisors to simplify this system over the years. Notably, Secretary Henry Paulson released the Blueprint for the Modernized Financial Regulatory Structure on March 31, 2008, 2 weeks after the Bear rescue, in which he proposed getting rid of the Thrift Charter, creating a federal charter for insurance companies, now regulated only by the states, and merging the SEC and CFTC. The proposals did not move forward in 2008. End of section 101. Section 102 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Commission conclusions on Chapter 16. The Commission concludes that the banking supervisors failed to adequately and proactively identify and police the weaknesses of the banks and thrifts or their poor corporate governance and risk management, often maintaining satisfactory ratings on institutions until just before the collapse. This failure was caused by many factors, including beliefs that regulation was unduly burdensome, that financial institutions were capable of self-regulation, and that regulators should not interfere with activities reported as profitable. Large commercial banks and thrifts, such as Wachovia and IndyMac, that had significant exposure to risk mortgage assets were subject to runs by creditors and depositors. The Federal Reserve realized far too late the systemic danger inherent in the interconnections of the unregulated over-the-counter OTC derivatives market and did not have the information needed to act. End of section 102.
Section 103 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 17, September 2008, The Takeover of Fannie Mae and Freddie Mac. Intro. From the fall of 2007 until Fannie Mae and Freddie Mac were placed into conservatorship on September 7, 2008, government officials struggled to strike the right balance between the safety and soundness of the two government-sponsored enterprises and their mission to support the mortgage market. The task was critical because the mortgage market was quickly weakening, home prices were declining, loan delinquencies were rising, and, as a result, the values of mortgage securities were plummeting. Lenders were more willing to refinance borrowers into affordable mortgages if these government-sponsored enterprises, GSEs, would purchase the new loans. If the GSEs bought more loans, that would stabilize the market, but it would also leave the GSEs with more risk on their already strained balance sheets. The GSEs were highly leveraged, owning and guaranteeing $5.3 trillion of mortgages with capital of less than 2%. When interviewed by the FCIC, former Treasury Secretary Henry Paulson acknowledged that after he was briefed on the GSEs upon taking office in June 2006, he believed that they were a disaster waiting to happen, and that one key problem was the legal definition of capital, which their regulator lacked discretion to adjust. Indeed, he said that some people referred to it as bullshit capital. Still, the GSEs kept buying more of the riskier mortgage loans and securities, which by fall 2007 constituted multiples of their reported capital. The GSEs reported billions of dollars of net losses on these loans and securities beginning in the third quarter of 2007. But many in Treasury believe the country needed the GSEs to provide liquidity to the mortgage market by purchasing and guaranteeing loans and securities at a time when no one else would. Paulson told the FCIC that after the housing market dried up in the summer of 2007, the key to getting through the crisis was to limit the decline in housing, prevent foreclosures, and ensure continued mortgage funding, all of which required that the GSEs remain viable. However, there were constraints on how many loans the GSEs could fund. They and their regulators had agreed to portfolio caps, limits on the loans and securities they could hold on their books, and a 30% capital surplus requirement. So, even as each company reported billions of dollars in losses in 2007 and 2008, their regulator, the Office of Federal Housing Enterprise Oversight, OFHEO, loosened those constraints. From the fall of 2007 to the conservatorships, it was a tightrope with no safety net. Former OFHEO Director James Lockhart testified to the FCIC. Unfortunately, the balancing act ultimately failed and both companies were placed into conservatorship, costing the U.S. taxpayers $151 billion so far. End of section 103. Section 104 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 17, A Good Time to Buy. In an August 1, 2007, letter to Lockhart, Fannie Mae CEO Daniel Mudd sought immediate relief from the portfolio caps required by the consent agreement executed in May 2006 following Fannie's accounting scandal. We have witnessed growing evidence of turmoil in virtually all sectors of the housing finance market, Mudd wrote, and the immediate crisis in subprime is indicative of a serious liquidity event impacting the entire credit market, not just subprime. As demand for purchasing loans dried up, large lenders like Countrywide kept loans that they normally securitized, and smaller lenders went under. A number of firms told Fannie that they would stop making loans if Fannie would not buy them. Mudd argued that a relaxed cap would let his company provide that liquidity. A moderate 10% increase in the Fannie Mae portfolio cap would provide us with flexibility and send a strong signal to the market that the GSEs are able to address liquidity events before they become crises. He maintained that the consent agreement allowed OFHEO to lift the cap to address market liquidity issues. Moreover, the company had largely corrected its accounting and internal control deficiencies, the primary condition for removing the cap. Finally, he stressed that the GSE's charter required Fannie to provide liquidity and stability to the market. Ultimately, Mudd concluded, this request is about restoring market confidence that the GSEs can fulfill their stabilizing role in housing. Fannie Mae executives also saw an opportunity to make money. Because there was less competition, the GSEs could charge higher fees for guaranteeing securities and pay less for loans and securities they wanted to own, enabling them, in theory, to increase returns. Tom Lund, a longtime Fannie Mae executive who led the firm's single-family business, told the FCIC that the market moved in Fannie Mae's favor after August 2007 as competitors dropped out and prices of loans and securities fell. Lund told FCIC staff that after the 2007 liquidity shock, Fannie had more comfort that the relationship between risk and price was correct. Robert Levin, the company's chief business officer, recalled, "It was a good time to buy." On August 10, OFHEO's Lockhart notified Fannie that increasing the portfolio cap would be premature, but the regulator would keep the request under active consideration. Lockhart wrote that he would not authorize changes because Fannie could still guarantee mortgages even if it couldn't buy them, and because Fannie remained a significant supervisory concern. In addition, Lockhart noted that Fannie could not prudently address the problems in the subprime and Alt-A mortgage market, and the company's charter did not permit it to address problems in the market for jumbo loans, mortgages larger than the GSE's loan limit. Although there had been progress in dealing with the accounting and internal control deficiencies, he observed much work remained. Fannie still had not filed financial statements for 2006 or 2007, a particularly troubling issue in unsettled markets. As Lockhart testified to the FCIC, it became clear by August 2007 that the turmoil was too big for the enterprises, the GSEs, to solve in a safe and sound manner. He was worried that fewer controls would mean more losses. They were fulfilling their mission, Lockhart told the FCIC, but they had no power to do more in a safe and sound manner. If their mission is to provide stability and lessen market turmoil, there was nothing in their capital structure that would allow them to do so. Lockhart had worried about the financial stability of the two GSEs and about OFHEO's ability to regulate the behemoths from the day he became director in May 2006. And he advocated for more regulatory powers for his largely toothless agency. Lockhart pushed for the power to increase capital requirements and to limit growth, and he sought authority over mission goals set by the Department of Housing and Urban Development, as well as litigation authority independent of the Department of Justice. His shopping list also included the authority to put Fannie and Freddie into receivership, a power held by bank regulators over banks, and to liquidate the GSEs if necessary. As it stood, OFHEO had the authority to place the GSEs in conservatorship, in effect to force a government takeover, but because it lacked funding to operate the GSEs as conservator, that authority was impracticable. The GSEs would deteriorate even further before Lockhart secured the powers he sought. End of section 104.